Good morning. It is 9 a.m. on Friday, January 21st. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sazi. And boy, do we have a lot to tell you about today. Let's start with the markets and the sell-off that is continuing here, particularly for the Nasdaq, down 0.8% after a mid-session, a dramatic mid-session reversal yesterday. The selling is continuing this morning. And just like that, the pandemic stock rally appears to be over. There's a re-rating underway for the companies whose businesses benefited the most over the past 2 years. One example, you see it there, it's Netflix. Those shares are tumbling after the company warned subscriber growth would slow. We'll dig into that in just a moment. And Peloton, it's cycling higher, at least for now, but that's after a 24% drop yesterday that sent its shares below its IPO price for the first time since April 2020. And one-time high-growth equities aren't alone this morning. We've got crypto that has also been tumbling. And this is not necessarily as unusual for crypto as it is for some of these stocks, but nonetheless just reflects the overall sentiment shift that we have seen in the market here, and we're going to dig into that shift throughout the show. But we have to start by digging into Netflix and those disappointing numbers from the company on a number of different fronts here. Now, with Netflix, of course, subscribers are always what tend to get the most attention. So let's run through those numbers quickly here. Fourth quarter subscribers up 8.3 million. That misses the company's own prior guide of 8.5 million. Also, the company saying in this current quarter, it's going to grow subscribers by 2.5 million. That's versus growth of 4 million a year earlier. So pretty dramatic a slowdown in that first quarter growth rate here. Also getting some attention, operating margin at 8.2% versus 14.4% a year earlier. That's the fourth quarter number there as the company spent more money on content. And Brian Sazi, some of the spending on content paid off. I mean, Netflix had some really big hits during the quarter and over the course of the year between Squid Game, Don't Look Up, also getting really big numbers. But it seems like it wasn't enough, particularly when you look across the globe.
No, and it really wasn't enough for Wall Street. As you're seeing with the stock reaction here in the pre-market, Julie, absolutely vicious. I've counted at least 4 downgrades by sell-side analysts this morning on Netflix after this quarter. Makes you wonder where the hell were they last week into this report. Nonetheless, there was a lot of concern here, and there's a lot of concerning takeaways, I think, from the earnings call. When you have Reed Hastings, the co-chief executive officer of Netflix, hopping on this very lengthy earnings call, saying that, hey, we're being impacted by increased competition. We're being impacted by the what he is calling a COVID hangover effect. And then, oh, yeah, we really can't measure the impact of any of this stuff and when it might end. Those are red flags. And I think that's why you see the likes of Pivotal Research. And I just wrote about this. The story's on the Yahoo Finance homepage right now. Why you have analysts calling Netflix shares dead money, potentially dead money right now, even after this very sharp pullback.
Well, I'm curious because I didn't get a chance to take a look at that note, Saz. Does Pivotal say it's dead money for how long? I mean, typically you'll get an analyst make a comment like that and say, you know, this is a period that's going to last X amount of time. Do they put a time frame on it?
Short term. It's one of those short-term tactical calls, I think, out of Pivotal where, you know, it's going to be hard to drive a bullish case around Netflix in the near term after a quarter like this and after a quarter where they came out and really warned of even slower growth in the first quarter here. So a lot to be concerned about. But again, Pivotal coming out saying a little bit more optimistic longer term, still view the business model as intact. And that model essentially is people leaving pay TV and signing up for streaming services. But again, just not a good conference call from Reed Hastings and company.
Yeah, at the same time, Hastings did express confidence in the longer term for the company also, right? That, yes, there is competition here, but that the company is going to manage to hold up. A couple of other things that we have to mention, of course, the raised prices, right? Netflix raising prices in the US and Canada last week, which was the first increase since 2020. And in the investor letter, sort of holding out the idea and the possibility of continued price increases, in particular, a couple of things that are increasing costs for Netflix. One of them is content. That's nothing new, right? The company has been spending on content. But secondly, currency effects as well, which it said hit its numbers last year as we've seen a strengthening dollar and as Netflix gets more and more of its revenue from overseas. So that then is worth less to it when it brings it back here to the U.S. So that's something also that's affecting the company that I think bears watching as well.
What also bears watching too, and that is a broader earnings season trend too as well, Julie. I'm glad you highlighted that $1 billion hit from the stronger dollar. It's not just Netflix. It's something we're going to be hearing about, I think, at length over the next few weeks as these multinationals report. But you have to wonder, on a week that started with Microsoft paying nearly $70 billion to buy Activision Blizzard, at what point does a Netflix come out here and make some form of acquisition to jumpstart its growth? Because they're essentially telling you in the US, their business may be near a peak, and it may be hard to get new subscribers in the US. So as an investor, you're starting to think, well, what could drive future growth for Netflix? Sure, there's an international component here, but if this company wants to be a big player in games, also live sports and other live sports and news, something that Hastings talked about and acknowledged that they're not really in right now. At what point do you open up your pocketbook and spend up big to help to build out this portfolio for Netflix?
Yeah, well, the company did introduce mobile gaming during the quarter, which is interesting. We're not getting a lot of detail as to, what significance that has now or how big it could be. Something else, they also introduced a site, and I don't know how to say this thing, TUDUM, 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 Tudum. I don't know what it's supposed to be pronounced like, but it's a site that they say extends stories and conversation, and it's a sort of a fan site for the shows, I guess, to sort of interact and increase engagement. That's going to be something I'm going to be watching. It's quite interesting. Just to put today's stock move in perspective, by the way, it is not unusual for Netflix to have big moves following earnings, right? The average move in the stock over the past 5 years following earnings has been 10%. And in some cases, it's been larger than that. To get a drop like this, though, you got to go back to 2012. And that was when Netflix was quite a different company and in a different place in its maturity level. But again, to put things in perspective, it went public back in May 2002. You want to take a guess as to how much the shares are up since it went public?
No, I don't want to sound dumb. Take it away, Julie.
47,000%.
Huh.
So I guess that
pretty good.
I don't know. It puts things in perspective a little bit. Okay.
Julie, I want to add too. I think real quickly. We have a lot of new investors on the Yahoo Finance platform still. A lot of people coming into this market, and this is another learning lesson I think for them. Shares of Netflix were down about 17% into this report. You saw a lot of analysts on the street lower their earnings estimates into this quarter because of a lot of concerns. There's a reason many times why a stock declines by double digits into an earnings report. And I understand there's been a broad tech market sell-off, but still, there's a fundamental aspect here that I think helped to drive Netflix shares down into this report. And we saw it play out in the quarter.
On the flip side, if people bought shares going into the report and they can hold on through today and through the next year, they might end up being rewarded. I don't know. Too soon to tell.
Is that a prediction?
Okay. I don't make predictions.
I know.
That's why I said
All right.
might, Saz. I don't speak in absolutes. Except when I'm talking about food, maybe. All right, let's talk about Peloton as well, because the thread that obviously ties these two together is that they benefited hugely during the pandemic, and now both are faltering. And even though Peloton is up this morning, it really appears to be kind of a rebound effect from yesterday's 24% drop. Here's what's going on here. CNBC reported yesterday that the company was temporarily halting production of its bikes because it had too much inventory, which is a complete reversal of the problem that it was having earlier in the pandemic when it could not make bikes quickly enough to keep up with demand. So that's really a big difference here. And then the company came out with an announcement late yesterday, came out with preliminary fiscal second quarter revenue, $1.14 billion, which is a little bit shy of estimates, and said its connected fitness subscribers last quarter are 2.77 million. That too is a little bit short of estimates, but again, the stock is getting boosted this morning. And in a memo to staff, the CEO, John Foley, said, quote, rumors that we are halting all production of bikes and treads are false, which seems to imply maybe they're halting some production of bikes. Tough to tell. But, it seems like with Netflix, there are sort of macro trends, right? With Peloton, maybe there's some macro stuff going on, but it also seems to be an execution issue.
That is a very good point. I think you cannot put Peloton and Netflix in the same class in terms of execution. What Netflix has done really since its founding is absolutely superb here. This is alarming stuff out of Peloton, and there's no other way to put it except the company is a hot mess right now. It really is. And Foley also talking about now there was a leaker inside of her company. I mean, this is not an FBI investigation here. This is Peloton. They make exercise equipment. To see them fully calling out a leaker, and they're saying that they found the leaker and they're taking legal action against them, is ridiculous. They should be solely focused on selling treadmills and bikes and coming out with the right price points for these things. Instead, now you have these just disappointing quarters from the company. You have concerns about their operating cash flow outlook moving forward. And now you see the likes, seeing some folks on Wall Street start to wonder, where is the accountability? Why have no executives left Peloton really after this really challenging set of 6 months? And then secondarily, at what point does an active investor might start kicking the tires on a Peloton? Here's a stock that's gone from about $167 in December of last year to below the IPO price right now, according to pre-market move, $24. So you have a stock trading before it's below its IPO price. It's terrible. I mean, there's been a lot of just value destruction here with Peloton.
Yeah, most definitely. And you mentioned the street and what's going on there in terms of opinions. There was one upgrade today that I noticed. That was Stifel upgrading the stock to buy from hold. The price target, though, being cut to $40 from $56. Cowen is still at an outperform, but cut its price target to $40 from $100. And of course, we're going to talk a little bit later on to Simeon Siegel, who now is the only underperform on the stock and has consistently been. From BMO, he cut his price target to $24 from $45. So definitely a lot of bearish sentiment surrounding the company this morning. And you mentioned, by the way, activism, right? There was one, the folks over at Citron Research yesterday talking about looking at Blue Apron as a potential target of something like a Peloton. I know, but I guess it makes sense. If you're going to be healthy, you're going to have the full package and maybe cook healthy too.
I'm surprised Blue Apron is still around. I mean, I'm just surprised there's still a ticker on the Yahoo Finance platform. I mean, there's a company that's really struggled massively since their ridiculous IPO in front of the New York Stock Exchange several years ago. It looked like they set up a farm. I still have the photo somewhere on my phone. It's ridiculous. Major red flag for that company. So not shocked to see it trading at about $7.
I used Blue Apron for a hot second. Several years ago, and wasn't for me in the end, but I get the appeal. All right, let's talk about what this all means in larger context, shall we? Because as I started off the show by saying, these are the pandemic era plays, right? You saw Netflix, of course, was a strong company going into the pandemic, but nonetheless got an extra boost. Peloton, which had fallen below that IPO price just before the pandemic, then went back above it. And we have so many other examples of this, from Zoom to DocuSign, that have been falling as of late. So these numbers and these reports really just sort of putting a punctuation mark, if you will, on the selling that we've been seeing recently. So take a look at the Wi-Fi Interactive, because I just wanted to take a look at a couple of different things here. First of all, the Nasdaq Composite. That, of course, is where the selling has been concentrated. And that incredible reversal, again, in yesterday's session, when the index was up as much as 1.5% and then fell by 1.3% by day's end, it is just an amazing one. We've been talking about the correction that the Nasdaq has had. The Nasdaq 100, by the way, also entered a correction yesterday, down now about 12%. Over this period of time. There was an interesting column by John Author, though, this morning on Bloomberg, where he said, what is the significance of a correction? What does it mean when you look at it in the longer context? The Nasdaq's had a bunch of corrections over the past 20 years, and yet it's still up 633%. So in other words, I think it's interesting to talk about, as I mentioned, for something like a Netflix, okay, should people have been selling along with the crowd going into it? Should they have been buying, looking toward the long term? It all depends on people's horizon, but I think it's something to think about here as we think about the long-term secular trend for technology in our economy, what role it plays, and whether this is the end of an era or it's a pause before the next era of next growth drivers. And I don't know the answer to that. I don't get paid enough for that, Brian Sazzi, but I think it's a question that investors need to be asking themselves.
No, definitely gave me some good thoughts to think about on the weekend. But I got a good note from Tom Essay over at Sevens Report Research, looking at, he raised this simple question: why are stocks dropping? And he's blaming the Fed. He goes on to discuss for 14 years the Fed has practiced a policy of gradual policy changes and a communication strategy that has really been devoid of any surprises. He says that is now changing, and it's changing in a big way, of course, as we near a potential interest rate hike in March. And as a result of these changing market dynamics, you have investors, you have analysts going back to their spreadsheets, putting in higher interest rates and coming back with a lower valuation on a lot of these tech names. And I continue to use Roku as the example. Stocks down about 54% over the past 3 months. It's still valued at about 88 times forward earnings. So there's a lot more, I think, multiple compression you can see come to a lot of these tech names.
There's one thing that I got to push back a little bit here, Saz. That's definitely part of the story, but that's not the whole story. Look at what yields have been doing over the past 5 days. They're down. They're not up. When the selling was happening yesterday, yields were not rising. So, you can blame the Fed to some degree, and you can blame concerns about liquidity coming out of the system. But you can't necessarily say there's not necessarily always a direct line between higher rates, lower stocks, lower rates. It doesn't always, there's not always that one-to-one correlation.
Oh, yeah, good point. Definitely a great point. I think what you saw probably over the first part of this month, the selling in tech reflected those Fed rate hikes. Now, as Netflix earnings show, the fundamental stories of a lot of these tech companies are not changing. It's not that they're not great plays or great longer-term bets. They're seeing slowing growth. And now I think you're likely to see the market price in slowing fundamentals at technology at the same time that you could see rates go up. Both of those are not good for the space.
Right. Yes, I think that's fair to say. Well, we're going to talk about this much more, both these specific names as well as these broader questions for the market. Before we go to break, we want to take a look at some of the worst performing Nasdaq 100 stocks for the week. You see here, we have seen some big declines. Peloton, only one of those. We're going to be back with more on this week's market action and what you should do now with those tech stocks.
The S&P 500 is closing in on its third consecutive weekly decline. If that goes down, it would mark the first time this has happened since September 2020. Let's talk more about this wild week for the markets with Mira Pandit, JP Morgan Asset Management Global Market Strategist. Mira, nice to see you as always. How much longer do we have left in the selling?
We are likely to end and enter into this different period from a market perspective in which the market is really grappling with this new reality that we're going to see less fiscal spending this year, not only less accommodation from a monetary perspective, but actually monetary tightening. And amidst that, we've seen a rapid rise in rates recently. Now, we did expect rates to move higher, and yet a lot of that has really been pulled forward to just the first few weeks of the year. So that's really stirring up markets. And ultimately, with less accommodation throughout the rest of the year, we do expect to see some more protracted periods of volatility. So how we're navigating that is really gearing towards quality and balance and making sure that we're not invested in any of those areas that are getting hit the hardest, like some of the frothy, more speculative areas of the market, and ensuring that areas with high valuations have the profits to back it up right now.
So Mira, what does that mean for tech holdings then? Do you stay away? Do you sell? Do you just put those on the back burner for a while?
Rates are putting some pressure on tech stocks, but that is just one piece of the puzzle, because where we're headed to is an environment of slower economic growth towards the end of the year, and investors are really going to be looking for opportunities for growth. So to the extent that some of these higher valuation stocks still are producing durable, consistent profits, we do still want long-term holdings in many of these areas, particularly because they are taking advantage of some of these huge secular growth themes. But we've also seen a lot of concentration in the market itself in some of these top stocks. So it's making sure that we have the right amount of exposure going forward.
Mary, we're just talking a little bit about this, but does the Fed deserve a large part of the blame for what we're seeing here in the tech stock sphere, but now increasingly in the S&P 500?
We're seeing a huge shift in Fed policy. Last year was a year where good news was good news, but also bad news was good news because you did have fiscal and monetary support to come and swoop in. And that's a very different tone and very different course of action that we're likely to see this year. So to some extent, yes, this policy shift is weighing on stocks more broadly, but it is going to create this environment where we're going to see a lot more differentiation on the basis of quality earnings within the stock market, where not everything is going to go up. Not everything is going to face a strong recovery, but we really need to make sure that we're careful about what we own. And further to that point, I think that the environment we were in last year was toggling between U.S. value and U.S. growth. And right now, with both down, I think it's a really important time to revisit that international allocation as well, because we've seen markets like Europe and Japan so far, roughly flat this year, emerging markets slightly up. So last year, in an environment where it was hard to resist U.S. stocks, this year we have to make sure we're properly diversified across international markets as well, and can be a different source of returns while U.S. markets are facing quite a bit of volatility.
So Mira, where do you think internationally is going to be the best opportunity of those that you talked about?
I think first out the gate, we're going to see areas like Europe and Japan come back. I think they're further along in the progress of their recovery. And indeed, both of those areas have a really high degree of cyclical exposure. If the US is about 1/3 exposed to cyclical sectors, in Europe and Japan, that's north of 50%. And remember that cyclicality is really levered to the recovery. So as we move from last year, the year of US recovery, to this year, the year of international recovery, those should be some of the stronger areas out the gate. And then we'll continue to keep tabs on emerging markets, which could start to see a turnaround later in the year.
All right, duly noted. Mira Pandit, JP Morgan Asset Management Global Market Strategist. Always good to see you. Have a good weekend. All right, coming up, we'll hit a few stocks moving on the Yahoo Finance platform. We have some Peloton, we have some Bitcoin, and one of the names we are locked in on, a giant oil field services company. Stick around.
Well, tech bulls are bracing for a tough open this morning. Netflix shares down 21% right now, Brian Sazi. I was looking back, and as I mentioned earlier, it was 2012 when Netflix shares fell 25% after one of its earnings reports. There have been some other big declines, double digits for sure, but I think that was the last big decline that we saw in response to the Netflix numbers. We've talked a lot about the Netflix numbers this morning and what was disappointing in them and all of the various downgrades that we have seen. We also, I think, got to keep an eye on some of the other streaming services and what this implies for them. Does this imply a lower demand for Disney Plus as well? Does it imply lower demand for some of the other streaming services? We obviously can't see a direct Hulu stock reaction, for example, but it's definitely something to consider.
Oh, right on. And we keep in mind, we have been tracking Disney really over the past few months. They have been highlighting slowing growth in Disney Plus. So that is one to watch as they report earnings soon. But also, too, Julie, just, Netflix's earnings really set the tone for, I think, tech earnings more broadly in a couple weeks. And you have to think about a company like Amazon. That stock has been underperforming for the better part of a year on a relative basis or compared to the major indices. There's a lot of concern on the street going into this quarter on how their margins will look for the fourth quarter holiday season as they invest in a lot in same-day delivery services and other capacity upgrades. You have to wonder if we're looking at a potential Amazon disappointment and another pressured reaction to Amazon shares after that quarter.
Yeah, that's a really interesting point. I mean, the other issue I think too is that all of these companies are internationally exposed. For Netflix in particular, it's been struggling in India. We talked about it raising prices earlier in the US and Canada. It actually cut prices in India, which is an acutely competitive market and a different kind of market. And Reed Hastings acknowledged some of the challenges that they've been facing there. So that's something to keep an eye on as well. And we've been talking a lot about Netflix and Peloton sort of in the same breath this morning, while at the same time acknowledging there are very different companies at different stages in their growth cycle. But the thing that they have in common is that both of them have been pandemic plays that benefited during the pandemic. Peloton may be up this morning, but it seems like its struggles are far from over.
No, there's cash flow concerns, there's cultural concerns, there's inventory concerns. Overall, there's just a lot of concerns, Julian. Yeah. I think you're seeing people react to that.
So just to pick up on Peloton again for a moment, yeah, you are seeing a lot of concerns there about the future growth. We talked this morning about the company coming out with a statement. One thing that we did not perhaps emphasize as much is that they're doing some layoffs as well, and they're delaying, according to the New York Post, the opening of a factory here in the U.S., a $400 million U.S. factory by a year, which will save it money, but obviously also, again, speaks to the idea of demand for its machines. So, all of that implying maybe the bounce is going to be short-lived in the Peloton shares. Although that's we're actually seeing a little bit of momentum in the gain in those shares, Saz.
Yeah, it's just going to be hard for the bulls to come up here and buy this one here, Julia. Now, none of this is to say is, Peloton is not making innovative stuff. The products really are, I think a lot of analysts, even the bears would agree that they make really good stuff. And a lot of companies would like to be in the same position as a Peloton with this many subscribers that feel very passionately about the brand. But at the end of the day, none of that even matters when you can't make your products profitably and you're overestimating demand. These are big issues, very big issues.
I don't know if the higher end trend was such a great product. There's one that maybe they didn't get quite right, and they haven't come out with another version of it yet, or at least not the same one-to-one comparable. All right, we got to get to Jared Blickery because we are seeing this selling, of course, not just in Netflix, but really extend for a lot of these hard-hit Nasdaq names and the index overall. Jared?
That's right, Julie. And for the month of January, I'm looking at the Nasdaq down almost 10%. Nasdaq now heading for its worst month since November 2008. That was before QE1 back in the day. That was post Lehman. So really something interesting going on here. Let's take a look at the Wi-Fi Interactive. We can kind of plot what's been going on this week, and really ugly price action. We had a little bit of a respite in here. Things seemed like they were getting back to normal, but just took that huge leg down, not only at the close yesterday, but also the day before. So the Nasdaq now down over 5% for this holiday shortened week. Let's check on the Dow. There's a little bit of a outperformer here today, but not by a lot. Still down about 61 points for the day, down 3.5 points for the week. And then let's take a check inside the market. And the sector action for today, we do see a little bit of green in real estate, staples, utility, and healthcare. But guess what? Those are the defensive sectors. Also tech, a little bit of a respite there. I think that's probably from what's going on in the bond market. And just getting back to the discussion of bonds and, excuse me, their effect on equities, sometimes it's just the amount of movement, and it almost doesn't depend on which direction the other can really upset the market. So here we have the 5-year, that's down 7 basis points, 10-year, that's down 8 basis points. And I want to look at a 2-month chart just to kind of gauge the relative action here. So we had this huge run up from mid-December into mid-January here, and we're backing off a bit here. Normally, this would give all the mega caps a little bit of an edge here, and let's see what's happening inside the Nasdaq. And you can see, indeed, we do have some green, but Amazon, which had a nasty slide into the close yesterday, that's down about 77 basis points today. Seeing Netflix, we've been talking about that, really negative price action. This is a stock that tends to trend sideways. If anything else, had that false break to the upside, and now really testing the 400 level. So before we leave here, let's take a look at the travel sector. Lots of red there as well, guys.
Yeah, lots of red and a lot of places to choose from this morning. Thanks so much, Jared. One of those places, though, that we're not seeing red has been in Schlumberger this morning, the giant oil field services company. Actually, I stand corrected. It is down. It was higher earlier after the company's numbers. Now it's little change. Oil prices are lower. And as Jared just showed you, the XLE, that's the energy ETF, is trading lower as well. But this is, as the company reports, its best results since before the pandemic. It's going to raise capital spending this year. Fourth quarter profit, 41 cents a share, and ahead of estimates, revenue at $6.2 billion. And the company, perhaps a sign of what is happening more broadly in the oil field services industry, as we have seen prices go higher, there is this capital spending cycle here that could help boost the industry. We heard similar commentary and numbers yesterday from Baker Hughes. So it does seem like we are seeing a bit of a trend here in oil field services, Saz.
Yeah, and our very own Jared Blickery noting the company is essentially minting money, free cash flow over $1 billion. Julie, maybe they should make a play for Peloton here. Makes a lot of sense. Kind of like that blue apron Peloton maneuver.
I'm trying to think of some way in which that would work, and I just
you could put the Peloton bikes on every oil rig. I mean, if you think about it, it really, to me, it makes a lot of sense. But what do I know?
All right.
What do I know?
I see it. All right, let's talk about PPG real quick, because the company is forecasting earnings for the first quarter that missed estimates, higher operating costs. I mean, we heard this from Sherwin-Williams as well. PPG makes paint also and other types of chemicals. So sort of a similar situation here. Fourth quarter numbers missing estimates as well. So just to sort of emphasize here, it's not just in tech that we are seeing some issues here. To be clear, we have been talking about a lot of other companies that are seeing rising costs that are proving challenging for them. And the paint industry is definitely one example of that. Let's also get a quick check on CSX, the railroad. That company coming out with profit and revenue beating estimates, but the operating ratio, the efficiency ratio and operating ratio, which folks watch closely at the airlines, did not beat estimates. And so it looks like that is why the shares are trading lower here this morning. All right, we got to leave it there. A lot going on here this morning. We are going to take a quick break. Before we take you there, let's take a look at some of the top trending tickers on the Yahoo Finance ticker page. As you might guess, top one's Netflix. We're going to talk about it more next with Lightshed Partners' Rich Greenfield. Netflix having the biggest single day tumble going back to October of 2014, following subscriber growth that is lackluster versus what the company itself had been predicting, not to mention the street. Let's get Rich Greenfield's take, shall we? He's partner media and tech analyst at Lightshed Partners. Rich, you watch Netflix probably closer than anybody out there in terms of analysis. What happened here? Do you think that this is also partially that the company did not prepare people well enough for this kind of a disappointment?
Well, I mean, I think what's sort of interesting, right, is you're seeing the stock down, over 20%. You're seeing most of Wall Street just throw in the towel and downgrade the stock and say, instead of this thing being worth 700 or whatnot, it's now only worth 400. And look, I think the reality is we're still very early in the streaming conversion from linear TV to streaming television. It's hard to believe that with 220 odd million subscribers that we're, that's the ceiling, or that 250 million is the ceiling. Broadband is in, you're talking about there's probably 600, 700, 800 million homes with high enough quality broadband to, support Netflix streaming or any streaming service. But let's step back. In the last quarter, they added 8.3 million subscribers, and they're telling you, even with a price increase in their largest market, they're going to add another 2.5 this quarter. So in Q4 and Q1 alone, they've added, essentially 11 million subscribers. This company is not, this is not over. I think, is it a straight line? No. I mean, I followed Netflix for, a long time now. There has never been a simple answer to why they miss. I remember you can go back in time and they were talking about the chips in credit cards they were struggling with. Like, they were sort of making up excuses for why they missed numbers or missed growth expectations in the past. I think they were pretty honest. They don't exactly know all of the pieces. I think what we do know is that Netflix takes more shots on goal than anyone else. You saw that with Squid Game. Nobody had Squid Game as the breakout hit that was going to fuel Q4 a year ago. But yet that's exactly what happened in Q4. Was Squid Game was a huge tailwind. So you don't know what's going to drive Netflix. They take a lot of shots on goal. And my guess is something's going to happen over the course of the next 11 months that's going to surprise people because of the amount of shots on goal that they're taking. No one's giving them credit for that today. Everyone's just throwing in the towel, trying to extrapolate out of one quarter of disappointing numbers relative to looking at the big picture and going, they have 33 million subs in all of Asia Pacific ex China. That number can be 300 million over time. There's still lots of growth to go. Unfortunately, and this is what the market has to deal with, it isn't always the pretty straight line that the market would like.
Rich, is one of the reads off of this quarter, though, that just given the market reaction and just the mood on the street after this, does Netflix have to take even more shots? Do they need to go out there and buy a gaming publisher? Do they need to even invest even more in original content on top of really the large sums they are investing in?
Well, certainly that's, I think the statement you just made is certainly why the rest of the group is suffering. That's why Disney's down. That's why Viacom's down. That's why Discovery's down. There is certainly a fear that, heck, if Netflix doesn't have enough content to continue to grow subscribers, imagine what everyone else has to do. They're spending far, far less than Netflix. So it just sort of speaks to how hard streaming is, not just in content, but in tech spending, et cetera. But I think the answer to Netflix is they are spending more. I mean, I think that's the thing that investors should be looking at and taking this as an opportunity to buy more versus to sell, is that Netflix is not telling you they're cutting spending. If Netflix was telling you, look, it doesn't make sense to spend more money. There's no more subs. We've reached that ceiling, that streaming wars ceiling of like 220 or 250 million, like there is no more subs to get. That would be a really negative sign that Netflix has gone X growth and it's over. Instead, what they're telling you is it's early. We don't fully understand why we're not growing faster right now. We're investing more in content all around the world, and we are confident that over the long term, there is still a massive, total addressable market, their TAM of hundreds and hundreds of millions of subscribers to capture. So I think they're actually very confident in the next several years. I think it's Wall Street that has no confidence in that and is just worried that this growth story is over.
To sort of pick up on one small thing, though, that Sazi was asking about, and that's gaming. The company did introduce mobile gaming during the quarter. Now, I don't know what the numbers are looking like, and I don't know if. So I guess what I'm asking is, even if the total addressable market is enormous, there's also on top of that another enormous market that's a different one for something like gaming. And is that
and look what's happened and look what's happened in the last week. I mean, I'm sure you've been talking actively about Microsoft and Activision and about Take-Two and Zynga, right?
Yes.
There is clearly tremendous interest in the power of mobile gaming, or just video gaming in general. My partner at Lightshed, Brandon Ross, has been very outspoken of sort of the biggest growth vector coming out of the pandemic is obviously what's happened in video gaming. And it's been a huge tailwind to Epic and Roblox and all of these companies in the gaming space, especially ones that participate on the mobile end. But I think for Netflix, the reality is they recognize the importance of gaming. They're not sitting around simply relying purely on entertainment. And I think they've correctly understood. They knew they had to move into original programming. They knew they had to go global. They knew they had to do global original programming. And now they're looking at, okay, we have a base of 220 million subscribers. How do we give them more to do that will allow us to tap into more time spent and ultimately be able to drive price even further? I mean, like, that's why they're able to drive price up 11% in the US, is that they have so much time spent on connected TVs. People can't live without Netflix. We can debate how fast they're going to grow, but people can't give it up. This is not a churn problem that Netflix is facing. And so I think gaming is a natural extension of that, is how do we capture more time per day? And go back to your question about other companies. Nobody else is entering gaming. You're not seeing any of these other streaming platforms push on gaming. And so I think this is a unique opportunity where Netflix is trying to get out ahead of everyone else yet again. They're so far ahead in original programming overseas. Now they're entering gaming. No one else is there. I think it's a pretty interesting opportunity to give people more to do on the platform and leverage their franchises, the content they're creating, and figure out how they make games that tie to that. I think it makes a tremendous amount of sense. It's very early, but they talked about last night how they are seeing good engagement across their user base with this content. And remember, Netflix on mobile was not a heavily used product. Everyone has Netflix on their phone, but it doesn't get used. Most Netflix viewing is on a big screen or a laptop. And so this is a way to meaningfully increase time spent on the most personal device in your life, the mobile phone, where video viewing happens, but long form viewing just doesn't happen as much. So I think it's a really interesting play by Netflix. But again, this is sort of, you're probably in the top of the first for their video game strategy.
Do they buy a publisher to speed things along?
Well, they bought a small publisher. I wouldn't be surprised to see them buy other small publishers. If you look at sort of the entertainment or the video content side of Netflix, they've never gone out and bought a big studio. They've basically went out and hired the best talent, which is something they're clearly doing on the gaming side. They're trying to hire great talent. And then on top of that, they are certainly looking for smaller tuck-ins, like they bought the Ronald Dahl estate. Like you look at what they've done in video content. I think they're going to do the same thing on the gaming side, meaning lots of smaller tuck-in unique acquisitions, and then go out and just try to hire and invest in the best talent they can possibly get.
Rich,
and when you're spending $18 billion on content, to put 5% of that spend into gaming, that's a big number for the gaming space. But in the terms of the totality of Netflix's content spend, it's actually a relatively small number. So it's possible to invest in gaming even in a pretty meaningful way as part of their overall spend.
Rich, I want to be a chat with you without something on AMC. Now, what Netflix said on their call, perhaps there's a COVID hangover, perhaps people are getting more mobile again. Does the quarter off in Netflix suggest AMC might be a good buy here ahead of the spring and summer?
I mean, I think AMC is in a very, very difficult position. I mean, I don't know if you've looked at box office numbers year to date, but I think, last year obviously ended with the huge success of Spider-Man, but box office was still, down almost 30% in Q4. But what's scary and what should be panicking every investor who owns AMC stock is box office is down over 50% from 2020, from 2019, 2018. the beginning of this year is just an absolute disaster. Like people are just, the movies that are coming out are not generating a lot of box office, and people clearly are not showing up to theaters. And you're even seeing studios like Disney take their next big Pixar movie and send it directly to Disney Plus. And so the trend of companies avoiding the theaters is continuing. And you've got the CEO of AMC selling every vested share he possibly has. And so I think it's a pretty clear sign that the movie theater business is not fixed. If anything, you're seeing an increasing trend where a few movies a year will be huge. Batman in March will be huge for Warner Brothers, but very few films are going to require a visit to the movie theater. And so you're probably looking at it in our top 20 for 22. We talked about our prediction of, we think box office this year is $8.5 to $9 billion compared to 11.3 billion in 2019. So that's a pretty dire forecast for box office and for AMC. So we would be continuing to sell AMC here.
Brian Sozzi, just couldn't resist asking you about that one.
Can't do it.
Rich Greenfield, partner and media and tech analyst at Lightshed Partners. Rich, it is always really great to get your perspective on all of these issues. Appreciate your time. Have a great weekend. All right, we're going to take a quick break. When we come back, something else that's selling off, Bitcoin and the rest of the crypto complex. We will dig into that next.
Bitcoin prices are taking a bath today as pressure continues in all parts of the market perceived to be momentum trades. Yahoo Finance cryptocurrency reporter David Hollerith is here. David, what happened here? I thought Bitcoin was headed to 100,000 this year.
Oof, yeah. So I think typically, Ryan, when we look at these scenarios, we say something like, oh, what did like the derivative speculators do? And, right now, I think it's pretty clear that the derivatives markets were not really responsible for this crash. It looks like we're sort of following fears around, what happens with interest rates rising and how aggressive that might be this year. So most investors are looking pretty anxiously at the next Federal Reserve meeting. People say that cryptocurrency, some investors say that cryptocurrency is an uncorrelated asset. I think it's proving just as much yesterday before the crash, the correlation to the Nasdaq 100 with cryptocurrencies has like never been higher. So we really can't say this is a derivatives-led move. This is more so following on other risk-on assets. And as we've talked about before, cryptocurrencies are higher up on the risk curve than other things. You can sort of think of it like a very high risk tech stock at this point. I mean, it's sort of what we've been talking about. But in general, you know, we've seen about 200,000 positions liquidated in the derivatives market. Now, most of the funding was led to the short side. So short sellers actually had a momentum advantage in this scenario. So we can't really say that the bullish speculators are responsible for this drop. It seems like more of a sell-off, just sort of staying with the risk-on story that's sort of happening with other markets.
David, you spend every day of your life talking to these crypto folks. Is there any sense that the selling is due for a pause in the near term?
It doesn't look like that, actually. The people I've spoken to, like as of this morning, have said essentially that they expect there will be more sell-offs. So Kraken, the cryptocurrency exchange, is they put out their 2022 report, sort of forecasting the bull and bear case. And of course, the bull case is above $100,000, but the bear case is at $26,000. So there's an expectation that during this sell-off, we could see things drop further, even at least below $35,000. So it's really hard to tell. The selling's definitely not over at this point.
Well, as I said, headed into break, oof, the selling continues here. Yahoo Finance cryptocurrency reporter David Hollerith, good to see you. All right, speaking of things selling off, here's your Yahoo Finance stat of the day. The 5.4% pullback for the S&P 500 from the early January peak is now deeper than the sharpest correction of 5.2% seen in all of 2021, points out Truist Co-Chief Investment Officer Keith Lerner. All right, coming up, we'll have more on the market. Stick around.
All right, quick check on stocks here, almost a half hour into the trading session. And we still have declines here for the major averages. The Nasdaq now down 1.25%. Obviously, Netflix is a part of that, but there's also just some continuing selling that we have been seeing over the past couple of months, call it now, ever since the Nasdaq reached a record high. Now, of course, it is in correction. The Dow and the S&P also trading lower, but by much less here this morning. Coming up in the next hour, we're going to talk much more about all of this. And we're also going to talk with Luminar CEO Austin Russell on the company's deal with Mercedes-Benz and what this means for the future of autonomous vehicles, plus the state of retail investing. Guess what? It's been about a year since the meme stock craze began. We're going to talk to the CEO of Webull about what that has meant for his platform and what he's seeing. We'll be right back.
Welcome back to Yahoo Finance Live on this Friday morning. I'm Brian Sazi alongside Julie Hyman, like always. Downward bias in the markets persists into today, in large part because that less than stellar earnings report out of Netflix last night. All three major indices are in the red. I should note the S&P 500 is nearing its third straight weekly decline. Now, here are a few other things we are watching for you right now. Tuned out, Netflix is the top trending ticker page on Yahoo Finance after the company's fourth quarter subscriber growth slowed and the first quarter outlook lacked inspiration. I have a story on the Yahoo Finance homepage now looking at why one analyst thinks Netflix shares are dead money, so I encourage you to give it a read. We'll also note the subpar quarter for Netflix is also putting pressure on shares of rivals Roku, Disney, and Viacom. Excuse me. And what a hot mess. A day after Peloton shares plunged 24% on production concerns, shares are rallying slightly after the CEO tried to shoot down reports of problems inside the company. Peloton also pre-announced its earnings results, which showed it missing subscriber estimates. Longtime Peloton bear Simeon Siegel of BMO Capital Markets will join us on this red-hot debacle. And driverless car deal-making. Luminar's founder and CEO Austin Russell stops by after landing a big deal with Mercedes-Benz. The tie-up saw Luminar shares surge 12% on Thursday. Now let's head over to Yahoo Finance and Inez Ferre for some Wi-Fi interactive action. Inez.
And Brian, the Nasdaq 100 heading for its worst week since March of 2020. Let's take a look at our Wi-Fi interactive board. You can see here that Amazon's down more than 3%, Tesla down more than 3%. And I'm going to put this on an equal weight chart so you can see some of the biggest decliners. Netflix, as you were just mentioning. But if I just put a 2-month chart, you can see the trend that we've been seeing over the last couple of months. The market's not liking the pandemic darlings, those stocks that really benefited during the lockdowns of the pandemic. DocuSign, Peloton, Netflix, Zoom, these are the biggest decliners over the last couple of months. If we look at the electric vehicle space over the last 2 months, you can also see some of the biggest decliners, which are some of those companies that have pre-revenue or low sales or no profit yet. Lucid down 31%, Rivian down 51%. And if we look at the speculative assets, these have been heavily under pressure. Today, we're watching AMC down 5% at $17 a share. These are prices that this stock has not seen since May of 2021. We're also looking at GameStop that's broken below the $100 level. That price has not been seen since February of last year. And Robinhood down more than 3% yesterday, closing at a new low over the last 6 months. In fact, this stock has lost 80% of its value since those highs back in August of last year. Again, the market not liking the stocks, the companies that did well during the pandemic. Brian, Julie?
Inez, you are on fire, so stick around for just a second because we are coming up on the 1-year anniversary of the start of the 2021 meme stock frenzy, which kicked off with short sellers being hammered by GameStop apes. So what's next for the retail investor community? Joining us now is Webull CEO Anthony Denier. Anthony, it feels like yesterday we just talked to you on January 29, 2021, when all this was hitting the fan. What is the state of the retail stock community right now?
Well, I think the retail investor right now is trying to come to grips with a new reality, right? So for the last decade, we've been in a quantitative easing state where, the Federal Reserve has been a backstop to the market. And now that's changed, right? Now 2022 is going to be the first time in a very long time that we're going to see the quantitative tightening and we're going to see interest rates rising. Right. So I think the retail investor is trying to get their head wrapped around what the new leaders are going to be. And it's certainly seeing a risk off event through January so far.
Well, and the other thing, Anthony, it's Julie here, is that some of these folks might have already seen losses, right? There was some recent Morgan Stanley analysis where they looked at the sort of profit loss for retail investors and found that that line is declining at best. And so perhaps these folks already have less money to put to work. Are you seeing any evidence of that on the platform?
Yeah, we are seeing customer AUM actually decrease over through Q4 and through the beginning of January. A lot of that has to do with taking losses in positions and then selling some of those losers. We also have to deal with taxable events, right? We're getting into now tax season. People is taking those tax losses to offset some of their earnings through 2021. So a lot of that combined, it's certainly the case. So we're seeing retail investors being resilient and sticking with some of their core names, but certainly taking some risk off the table on names that have taken big hits.
Anthony, Ines here. I'm curious your thoughts on the meme stock phenomenon, which is roughly a year old now, and you've seen the kind of decline in these speculative assets. Do you think that another meme phenomenon would happen again? And what are your thoughts on the retail investor and meme stocks?
I will never discount another meme stock event, right? Anything can happen now with communication being in the state that it's in, right? So readily available and everything being so instantaneous. I think looking back a year and thinking like, what have we learned? What have we gained from, we can call it GameStop, we can call it meme, is a couple easy lessons here. The power of the public or power of the retail investor has never been stronger. Right. And we've learned that through that short squeeze event. We've also learned that our market system and our market structures are inefficient. So hopefully looking forward, especially for the benefit of the retail investor. We can see the policymakers take real action to make the market more efficient for investors and faster to settle for investors. And we can also see that retail investor really utilizing that power and doing it in a way to educate themselves about the market, educate themselves about trends, and continue to learn and become smarter investors overall.
Well, let's stay on that, Anthony, because right now I'm looking at GameStop shares down about 6%, fell below $100 with this move here. Keep in mind, at this time last year, GameStop shares were around $500 a share. And I can't tell you the putrid tweets I get every time I mention GameStop on Twitter, and that is something negative. Fact is, a lot of people still own the stock. If you have written the stock down from 500 to 96, what's your play?
I mean, when you talk about, the angry tweets you get, and I can totally I could totally agree with you there. I'm not alone. There's a very vocal minority, I think, of investors that are involved in this GameStop phenomenon. If you see the prices now, that tells me that diamond hands or apes. I think it's a lot of talk. I think we're seeing our traders and our investors take money off the table in GameStop, right? And when it comes down to your own personal pocketbook, that's what's important, right? Managing your own P&L. Everyone's a patriot on July 4th, but it really comes down to you managing your portfolio correctly. And I personally, I'm not involved in GameStop. I don't recommend stocks, but if I saw these moves, I would be taking money off the table.
And just moving off of that point also, Anthony, we've seen such engagement from the retail community during the pandemic, and investing apps have seen an influx of people trading on those apps. Do you think that this will continue post-pandemic, and especially if we see a significant haircut in the markets?
Well, bullish markets always makes for more traders. That's just the business that we're in. When markets start to slow, when markets, start going down on a daily basis, we see corrections like we've seen. Trading definitely slows down, right? It is a cyclical and seasonal business in that sense. However, I do want to point out that this new trend, right? We call it new, and now it's several years old, but this new trend of retail investors managing their own portfolios, I do not think that goes away. I think it's only going to increase. The traditional kind of mindset of paying some other person a ridiculously high fee to manage your own portfolio, I think is kind of going away. I think the younger generation is very DIY in terms of their own investing in their own finances. I think they're extremely intelligent and savvy and know how to utilize the tools that are available that weren't available simply 4 or 5 years ago, right? So, the educational content that's out there, the influences that are out there that actually, I would say most of them actually really know what they're talking about. Like, these are leaders that are helping this younger generation become a better investor and self-sufficient, self-directed investor. That trend, what we're seeing here at Webull, is not going away. We see interaction on our community at all-time highs. We see people engaging with one another, talking about investing, even in down markets, right? So it takes the market to go lower to go higher. So, we always see these types of trends. It's all about, not seeing, missing the forest for the trees and understanding this is a long-term opportunity for a lot of young people.
And Anthony, finally, just quickly, you talk about that engagement on your platform. We were showing numbers a few moments ago about that huge surge in people opening accounts on Webull last January. Mm-hmm. How many of those folks are still around? What has been the sustainability of the trend as you have seen it?
Our retention rate is well over 90%, right? And that's very unique to Webull in terms of the way that we create our user experience. Is exactly that. We're not a utility for our customers. We are an experience. We're a place for them to connect. We're a place for them to learn. We're the second largest app-based broker-dealer in the US, and we're the only large broker-dealer in the US that has a built-in community, right? Where traders and investors can converse with one another and have peer-to-peer interactions. So we're seeing really great retention even after those spikes of users, and we continue to improve our product, which keeps our customers engaged.
Always good to get some time with you. Webull CEO Anthony Denier, appreciate you taking the time. And that's right, we'll check back with you later. All right, coming up, Intel is opening up its wallets big time to open a new chip-making facility. Julie is back with more on this next.
Intel plans to spend $20 billion on a new chip manufacturing complex near Columbus, Ohio. The company will initially have 2 chip factories employing 3,000 workers on the 1,000-acre site, targeting operations beginning by 2025. This move comes as Intel looks to broaden its chip-making business, particularly in the U.S., and it's made more than $100 billion in investment pledges for over the past year. PetSmart's in talks to go public through a SPAC merger with a blank check company backed by private equity firm KKR. That's according to Bloomberg. That deal would reportedly be valued at $14 billion, including debt. Those talks are still in the early stages and could still end without an agreement. PetSmart's been private since 2015 when it was bought by private equity firms led by VC partners for $8.7 billion. And in a tearful announcement, Adele postponed her Las Vegas residency due to COVID-19 concerns. The singer shared that she is, quote, absolutely destroyed by this, and half her team has COVID-19. She was set to kick off her residency today at Caesars Palace. She didn't share any new dates. Demand for the concerts, by the way, had been hot. Ticket prices in the secondary market reportedly rising to as high as $30,000 per seat. We're going to take a break. When we come back, Mercedes-Benz acquired a stake in Luminar and plans to use the Lidar maker's sensors for future autonomous vehicles. We'll talk to Luminar CEO Austin Rutzel next.
Luminar said on Thursday Mercedes-Benz will use its laser sensors in a next-generation auto platform to enable certain semi-autonomous driving features. The luxury automaker is also taking an unspecified minority stake in Luminar. Shares finished Thursday's session up 12%. With us now is Luminar's founder and CEO, Austin Russell. Austin, good to see you as always. I imagine it's a pretty big week for you. So for the tech newbies out there that are still trying to wrap their hands around autonomous, how will these sensors be used in Mercedes cars?
Yep. So the whole point of what we're doing with Mercedes and the objective is to be able to enable the integration of this kind of Lidar technology on the vehicles to see and understand the world around them accurately and precisely in 3D to give the cars a better understanding and be able to have even better and safer assisted and autonomous driving features is the objective. So that's what we've really been working deeply with them on to be able to enable that kind of capability. But there's a lot that goes into it. And, you know, the part of the significance of this, though, is that the intent is actually for consumer vehicles, as opposed to, say, you know, the robo-taxi test vehicles and other types of things that are out there as it stands today. So, you know, this is really a critical moment in the industry where you can start to see a transition from R&D actually going into series production. And, you know, with Mercedes here at the table, it's, you know, couldn't think of a better brand that stands for, you know, safety, luxury, and everything else that goes into it, kind of at the pinnacle of the automotive industry. So it's awesome to be kicking this off full steam ahead.
Yeah, Austin, it's Julie here. We've been following your journey, obviously, pretty closely along different steps of the way here. And so when are people going to be able to potentially have access to a Mercedes with this technology? And what kinds of things are you having to do to adapt it differently than some of your previously signed partnerships?
Yep. So a couple things on the front. One, they aren't disclosing this any kind of specific timelines or planned vehicles for it, and well, in large part because they actually haven't even announced the specific vehicles themselves, you know, or what it may be there. So when it comes down to it, the goal of this is to get this integrated in the next gen platform that they have. So that's ultimately something that can support different kinds of vehicle models and architectures and everything for the production platform. So that's what's going on at this point in time. But you know, you can expect it as part of the objective in the not too distant future when it comes down to that. In terms of the fundamental technology that's going into this, it's the same core Luminar Lidar technology and iris technology that we've had. Obviously, there's a lot of deep integration work, and you know, we're not stopping. We're continuing to improve the performance and capabilities of the device, and that absolutely applies to Mercedes as well. But part of the underlying principle here is that this is the same core technology that we're enabling across the board with our partners, you know, from Volvo to SAIC to, well, actually even Daimler Trucks, in addition to Mercedes, and of course the tech partners like Mobileye and NVIDIA as well along the way. So it's there's a lot of leverage.
Austin, you've signed a lot of deals. I think we've talked to you pretty much whenever you have announced a new deal. When do you start producing your products?
Yep. So everything is leading up to big start of production for series production at the end of this year. I mean, we've obviously been producing these products, and for sake of clarity, gone through a number of iterations of products, but these are largely for uses in development use cases at this stage. But Iris is really the first time where you're actually seeing this go out into series production and having these capabilities out on real roads in consumer vehicles. So this is a first really for us and for the industry in many ways. And as a result, that Iris technology is basically our start of production for that is targeted at the end of the year. So we're moving full steam ahead to that, and then can really start to see the ramp up over the subsequent years there to ultimately see this as a vision of mainstream adopted technology as standardized throughout the industry by the end of the decade. I would be surprised if most major automakers didn't have this adopted on board their consumer vehicles by that time, considering just the dramatic safety benefits, and not to mention the autonomous capabilities that you have to have. But those are key drivers for making this a reality.
Do you think investors they still misunderstand what you're doing, Austin? Are you more of a auto safety play than this notion that over the next 5 years, every car on the road won't require hands on the wheels?
Yeah, I would actually say, and one is, yes, I think there's no question that we're not fully or properly understood. And I'd say certainly by equity markets, at least. That's part of why we did a massive buyback, recently as well, to be able to raise capital to do that, just doubling down on ourselves. We think that there's a huge opportunity and frankly, hugely undervalued at this point, compared to where we are and everything that we're winning and the pure opportunity that we're delivering. I mean, if you do this right, that's the $1 trillion opportunity. And we've been on a massive win streak that we don't expect to ultimately stop anytime soon when it comes down to it. So yeah, it's there's a lot ahead, but I'd say in terms of what type of company we are, yeah, there's no question it's involving safety, it's involving this, but I'd say we're a new type, a new breed of automotive technology company that's really taking the industry by storm. And when it comes to autonomous capabilities, we are an autonomous company in many ways, but not in the same way of that people traditionally think about it, like a Waymo, Cruise, Argo, these robo-taxi companies. That are valued well into the tens of billions in these cases, but doing a totally different thing of trying to be able to replace the driver altogether, take it out of the seat and have a robotaxi pick you up and drop you off, in an urban area and environment. Our goal is leverage the existing multi-trillion-a-year production passenger vehicle industry, get this into the hands of consumers, get these next generation safety capabilities and autonomous capabilities out into the real world as quickly as possible, and have it happen really this decade, not next decade when it comes down to it. And that's just tremendous leverage and how you can build an incredibly valuable business.
And to your point, Austin, there's a lot of players in this, even if they're playing in sort of different aspects of it, right? What do you, and I know this is sort of a long-term question, but what do you see as your market share here? Like, do you see there being a dominant player and it's Luminar, or do you see some sort of high double-digit market share participants here by the time we get to the end of the decade?
Yeah, I think, I think the data goes to show, and the decisions in the industry go to show that, and from both a technical, business, and financial standpoint, that all signs point to Luminar when it comes down to that. But that said, the reality is that I think, well, of course, I think we'll have a dominant or the dominant market share position in more than everyone else combined, just as, from like, for example, a series production standpoint and getting designed into these vehicles and everything, that's already more than everyone else combined at this stage for this type of application capability. But when it comes down to it, I think the significance is less about like market share and like what the slice of the pie is, so to say, but rather how big you can actually make the pie in the first place. And it's a completely different game, because you take a look at it, and look at kind of some of the like the economics behind it. It only takes about, I think by our model, it was like 3 or 4% market penetration to be able to build in our case, like 5 billion revenue, 2.5 billion EBITDA business with a 60 billion forward-looking order book and massive growth there. So, you take a look at it and it's like, wow, okay, it really only takes a very small level of market penetration to be able to do that. So that's what it's all about. It's about market adoption, market penetration, more than a give or take from anyone. That said, we've certainly been leading the race and by a long shot when it comes to market penetration and adoption for series production. And that gives you just an incredibly sustaining advantage as you reach economies of scale and drive forward this product into the industry to make all of this happen. So a lot ahead, but this is the ultimate goal of how you 10x, 100x the business.
Austin, as a founder of the company, what was behind your decision to sign off on giving Mercedes a stake in Luminar?
Yep. So this is really part of the broader holistic deal, with Mercedes, as their which has an equity component, which shares are being provided, in context and consideration of certain services and data that's being provided to us as part of this. But when it comes down to it, I would say that in connection with that, there's also a data component where they're able to provide from series production vehicles subject to consumer consent and applicable law, that back from the cars, which ends up enabling us to continuously improve the product quality, safety, autonomous capabilities, and all that goes into it. But more than anything, it's aligning interests and getting great people involved as part of our business from both a technical standpoint, business standpoint, and financial standpoint. So great stuff all around, and continuing to move full speed ahead. I'd say the real thing though, and obviously the real opportunity here, that's the game changer is seeing this technology through onto the consumer vehicles, and that's something that's orders of magnitude more meaningful in terms of opportunity than, say any stake or any other aspect of this. So that's what we're fully focused on from an execution standpoint.
Always fun getting some time with you. Luminar founder and CEO, Austin Russell. We'll talk to you soon. All right, longtime Peloton bear Simeon Siegel of BMO Capital Markets will join us next on the fitness maker's latest hot mess. Stick around.
Peloton. We've been watching that stock. It's still up by 5% here this morning after falling 24% yesterday, still trading below the IPO price of $29 a share. And according to our next guest, could go a little lower from here. That's Simeon Siegel of BMO Capital Markets. Simeon, you have been a bear on this stock. We've talked to you many times about it, and you got more bearish today. You cut your price target to $24. You're the only underperform of this company on the street. What would change your mind, if anything? Like, what could Peloton possibly do to turn things around at this point?
Hey guys, great to see you. So what's weird, right? What's odd is if you think about it, we all normally talk about shrink to grow, right? When we're talking about Victoria's Secret and Under Armour, like all the conversations that the three of us normally have center around taking a company that's cutting costs and is doing a turnaround. I don't think anyone thought we would be having that conversation about Peloton. We're talking about a company that's supposed to be in uber growth mode that now probably are making the right decisions, right? Focusing on selling less and charging more, bringing in consultants to cut costs. But the problem is where the company is right now. I think we still need to recalibrate what it is we're actually talking about. And it's not to say that I won't come back and have our Victoria's Secret conversation where the brand's clearly not dead, but it's being undervalued. But I still think the numbers need to be meaningfully reset. And what I'm sure we'll get into, I don't think it's going to be as easy to cut costs as they think.
Simeon, why haven't any heads rolled at Peloton on the executive team?
Above my pay grade. I listen, I think that if you asked me the question of how much of this is self-inflicted versus not, I think we watched a supply-demand imbalance flip. I think at the beginning of the pandemic, there wasn't enough product to meet supply and now, or to meet demand, and now vice versa. And I think that's because there was a decision made internally to spend a lot, build up the inventory balance, and that obviously is proving the incorrect decision. So I think that's how I'll answer that. Beyond that, again, that's beyond my scope. And again, at the end of the day, we're still talking about people, so I want to be cognizant of that.
The stock has really fallen off a cliff. I mean, you've been all over it since day one. Are we at that point now where we might see some activist attention start to kick the tires on Peloton?
So you can. The thing to keep in mind, though, is there's a big insider ownership. So it's hard to just take a large position with insider voting rights. And then also, we're still around a $10 billion company. Like, let's be clear about something. Like, at the end of the day, the market cap here, I know we're all looking at the stock price versus where it IPO'd. We also have to keep in mind that there's a lot more shares than the IPO. So it's not as simple as that. It still is a very large valued company, and it's still being valued on EV to sales. Normally, we think about sales as being a big growth metric. I think when we think about what is the reason Peloton loses money, a huge part of that is because cost of acquisition is high. And Saz, you and I talk about all the competitors. I mean, Tonal, Hydro, there's just a whole host of brand new other people vying for mind share here that is not going to make that get any cheaper. So if we want to believe there is growth ahead and it's not just a reset with no growth, a lot of those costs are inherently variable. And unless they're going to stop spending on research and development and stop spending on sales and marketing, you have to find another place to do that.
Simeon, where are those customers going to come from? And related to that question, where did the customers go, right? I mean, I think even if the argument is they made supply missteps, right? Clearly there is also a demand problem too. Has Peloton hit the ceiling for the bikes themselves?
Yeah, Julie, I think it's a great question. I think that throughout this, a huge part of our bear thesis had been predicated on the notion that it was a great growing company, but we always thought it was a pull forward of demand, not an expansion of demand. And I think we're seeing that. To their absolute credit, they have over 2.5 million members, right? I think so. This idea of we have a big base that right now is far ahead of the competition, that's there. And they'll have to make sure that maintains, they'll protect that, make sure churn doesn't go up. But so I don't know that we've lost. I know that theoretically there's been a kind of Peloton is seeing a huge fall off. But we are absolutely seeing new entrants. We are seeing that connected fitness. I think connected fitness is in its infancy. I think that this is a great category with a lot of really compelling options that are emerging now. And so I think you're watching these new competitors take that mind share and start letting consumers know that this notion of working out at home is great. Technology allows it to be a special experience. Content allows it to be fun, but there's more than one option. And I think that's going to continue growing. That's not going to shrink.
And Simeon, CEO John Foley coming out with a note yesterday evening noting there was a leaker inside the company. Now the company is taking action against this leaker, but to hear a leaker inside of Peloton, this is not normal things you hear. You think that is indicative of a cultural issue inside the company?
Yeah, Brian, I think you're exactly right. I think the main thing to focus on is the company acknowledging that there's a leaker. I think we've seen a stream of news flow come across in the last week, so clearly that was happening, and you have to ask why. And you have to ask, we've seen different conversations around morale, but listen, not for nothing, a lot of Peloton is they compensate their employees through share-based comp in a pretty meaningful way. I mean, we can see what they spent on stock-based comp in the last 3 years, and it's a big number. Anyone who got a strike price, anyone who was paid over the last few years, likely got options priced much higher than where they are right now. So you're watching a whole slew of things happen, and you're also looking at what you thought was a much bigger bank account. And you're probably asking a lot of questions. And I think, to your point, we need to ask and we need to focus on the fact that if that's what it's looking like internally, what does that mean for the go forward, right? And I think the problem we keep hearing about, there's this conversation about layoffs that keep coming up, which is very unfortunate. But if someone's sitting there and they're hearing that, how incentivized are they to keep on working right now in the interim? So there's a halt on some version, right? They're saying they're not halting all production. So there's some form of a halt. And then you wonder what's happening internally from the people that are still working. So I think that there's a lot of those inside questions that need to be asked.
You were just saying, Simeon, connected fitness is in its infancy. If Peloton's not going to win, or certainly it's not going to be the only winner, even if it is going to do well, who's the winner right now? I mean, Peloton's the only one that's sort of the pure play that you can trade publicly, right? But where else should people be looking if they're looking for early ideas?
So listen, Peloton is a winner. Like I know I'm a bear. I know that that's kind of been the conversation. But I also think about them as being like, I want to give them all the credit that they own. I mean, the marketing department at Peloton is probably the best marketing department I've ever seen. And Peloton there's no reason to think that they are not. As long as liquidity doesn't become a concern, there's no reason to think they won't still be a winner. But I think it's exactly that point. I think there's going to be multiple winners. And so you are right. I mean, there are some SPACs that are available with connected fitness products. There's equipment manufacturers that are there, but a lot of the ones you're talking about are still up and coming. A lot of the ones you're just that will likely become the winners are still private. So I obviously can't opine on that, and that is what it is. But I think we are seeing it's not hard to find increasing and new connected fitness that are focusing more on technology than they're focusing on simply the content. And I think that's going to probably be the next phase. I think as we see companies that give you something that have a moat, that give you something that does something new, that will probably be better for engagement. That will probably be a long path. But again, I'm not trying to say to anyone that Peloton has not done a phenomenal job getting to 2.5 million members. I mean, they are currently the leader. They will continue to be a winner in this growth. Figuring out what that does to the stock price is another question. And I think that story went a lot further than the numbers.
So super quickly, Simeon, when you look at ways to invest in this, companies you do cover, is it going to be Mirror, for example? Is that one of the other possibilities or no?
So I hear the question. I think the winners here, I think, are still private. I think I think right now there's the connected fitness space still in a public sphere is not very large.
All right. Simeon, thank you so much. And obviously Simeon has been prescient on this call on Peloton. So it's great to get your perspective on all of this. Simeon Siegel, BMO Managing Director. Be well. Have a great weekend. Coming up next, we're going to talk about the big deal that happened earlier in the week, what it means for the gaming industry writ large. The CEO of Super League Gaming, Ann Hand, going to be with us next.
Microsoft's eye-opening deal for Activision Blizzard has sent a jolt throughout the gaming community. Let's talk more about what industry insiders are chatting about here with Super League Gaming CEO Ann Hand. And nice to see you again. It's been a bit. So have you and your team sat down yet and thought about what this Microsoft deal means to your business, and what would it mean?
Yeah, actually, that's a good question. We have talked about it. We were pretty pumped, to be honest. We've been a strategic partner of Microsoft since 2016. And just that in itself says so much, because Super League in 2016 was about this big. And I spent a lot of time in large cap as an executive, and I can tell a lot about corporate cultures pretty instinctively. And they always treat people across the other side of the table as equal partners, no matter how small or large. It's just a culture that's really built on win-win. So we looked at it and we thought of the rich opportunities ahead for us as a strategic partner, working with them on Minehut and across their cloud services and other parts of their business. And also all that rich IP that they have now inherited, that we think they can really do a lot with to really grow. If you look at it, I mean, number 3, obviously in the gaming space, but when you look at, they already have 25 million subscribers to Game Pass. Now you're putting games like Call of Duty and Overwatch into Game Pass. There's just a lot of exciting ways that they'll be able to leverage so much of the Microsoft ecosystem to not just really build that IP, but I really think to take a step change in the performance of Activision Blizzard as a holistic company with employee health and culture.
Reading between the lines, Ann, obviously Activision Blizzard has undergone some problems over the last couple of years culturally.
Yeah.
I think is what you're alluding to. So there have been problems more broadly in the gaming industry, of course, over the past decade in terms of culture. Do you think that it's moving in the right direction? And is this deal a sort of symbol of that?
Yes, I think it is symbolic. I think the timing is good for both companies. I do believe that these challenges that we talk about a lot in gaming, I think they're across all industries. I think you'll find it in the banking and finance sector, the energy sector. I just think that some industries are further along in their progress. And I just think that's where gaming has been, trying to catch up a bit. But I think we're kind of in a different world where I don't even think it's really a female-male conversation. I think if you think about what we've all gone through with COVID, just the dynamic, fast way that tech is changing so quickly on us, it's requiring a different type of leadership. You need to be highly adaptable, resilient. You need to believe in empowerment, frankly, because, use whatever jargon you want, Web 3.0, the metaverse. What it really is about is that we're moving into a virtual rich world of opportunity that's all built around user-generated content. And so if you don't live empowerment, believe it, if you don't operate a company that way, then frankly, you're kind of missing the boat, because that's where the money is. And so I think to really understand where that consumer, that end user is going, it just takes a different type of company culture to optimize it.
And really, since we last spoke, you're starting to see now a roll-up of large companies getting more gaming assets. You had the Microsoft deal, you had Take-Two making a play for Zynga. Is the reality that over the next decade, because of the metaverse, the explosion, NFTs, whatever it is, really a handful of companies are going to control the gaming industry?
Well, I mean, I'm not nervous from an antitrust point of view. I don't think that, I think Microsoft does start to have a lot of the real meaningful building blocks, probably more than most, when it comes to the idea of the big metaverse, like a truly interconnected open system for play, for work, for community, for commerce. Look, we're a long way off from that, but they certainly have a lot of the big pieces there. And I think that makes them very attractive. But yeah, I think the roll up is real. We had 3 acquisitions last year because that's the access that the public markets give us to create more heft, to break from micro into mid cap. And yes, I do think you're going to continue to see M&A be a big piece of the strategy here. And
just quickly, we've been talking around the issue of the metaverse a little bit. And I'm curious for your business, sort of what we're still in the infancy, although gaming is further along than most other industries with the metaverse. What are you most excited about in terms of the opportunity for gaming and that area?
Yeah, I mean, what we started out early on doing is first, aggregating a community mostly of young gamers, competitive gamers. We talked about esports a lot. We built an ad engine around it that's pretty sophisticated. We now have gotten into data and analytics, and we continue to go further downstream in the offerings. And so much is built around the metaverse for us. We reach 60 million players in the metaverse a month. That's quite a different company than not only when we went public in 2019, but that's a vastly different company than we were in January of just last year. And all of our platform is built around the notion of empowering those creators with tools and economies to help them build out that world, to build out their own gameplay, rich experiences, to live stream their gaming centric content. And so for us, it's really at the center. In fact, frankly, I feel like I have to kind of remind investors on our earnings call, we've been talking about the metaverse for 4 years, because that's how long we've been in it. And so we're not kind of jumping on the bandwagon here, but for us, it's really central. That and creator economies are central to the platform that we've been building.
It's always nice to get some time with you. Super League Gaming CEO Ann Hand, have a great weekend. All right, companies may be dealing with a growing number of worker absenteeism due to the Omicron variant. We're back with a look at a few charts that will open your eyes.
The Census Department this week released some data that gives us a hint as to the effect of the Omicron variant on the labor force. We've also been getting some hints from some executives, Brian Sozzi, and the picture is not great.
Not great indeed. So I'm locking in today, Julian, a couple good charts out of Goldman Sachs. The first one being this rise in worker absenteeism. As you can see on the screen right there, Goldman noting the share of the adult population not working due to COVID-related reasons almost tripled from December to January. And on that chart, obviously, you can see that big spike there. That really coincides, I think, with the spread and increase in infections due in large part to the Omicron variant. And then secondarily, this is impacting a lot of different industries, the education industry, the manufacturing industry, and of course, the trucking industry as well. I would even argue the railroads. We heard some of this commentary last night out of CSX on its earnings call. So you can see the industries right there being impacted by this worker absenteeism. And we asked P&G's CEO, John Moeller, about this earlier in the week, if he's seeing worker absenteeism in his plants, which in large part may be contributing to a lot of these grocery stores seeing empty shelves.
Of course, in the middle of large COVID outbreaks in different parts of the world, there are quarantine needs. My children aren't at school and need to be cared for. I have a family member who needs to be tended to. I have difficulty securing transportation. All of those affect daily availability of people to do their jobs, but they're working through it in a very, very impressive and committed way.
Now, on a positive note here, Julie, I was still able to buy some new Dawn Power Wash from P&G. That was on the shelves, but you go down many other aisles, and there's a lot of products out of stock right now. Of course, pet food is one of them, in large part because we're seeing worker absenteeism in these pet food plants due to the ongoing pandemic.
Well, and besides just supply chain issues, I think we can also extrapolate to what all of this is going to mean for the next jobs report, and therefore what the Fed is going to be watching and whether it's going to slow its roll a little bit, maybe because of some of these numbers. But I guess we'll have to wait and see how all of that goes in terms of it being data dependent. Brian Sozzi, I hope you have a fantastic weekend. Great work this week. It has been a busy one. We will be right back here at 9 a.m. Monday morning. Akiko Fujita and Brad Smith going to take you through the next 2 hours of trading. Stay here.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. Happy Friday to all of you. Certainly not a happy Friday in the markets here. We've seen the Nasdaq falling deeper into correction territory, dragged down by disappointing results from Netflix. The index now on track for its worst week since October of 2020. We're seeing the Dow reverse course here in the last few minutes or so, up about 55 points on the S&P 500, under just slightly about 8 points. An uphill ride for Peloton. Shares bouncing back after losing $2.5 billion in market cap on reports it's halting production of its fitness products. Why the company now says it's considering all options as demand pulls back. And a push to ban congressional stock trading gains momentum, with polls showing growing public support. We're talking to Arizona Senator Mark Kelly about his legislation and why he thinks the ban should extend beyond lawmakers. We are kicking things off this hour, though, with those steep losses we are seeing in Netflix. Take a look at the stock chart right now, hitting a new 52-week low. And Brad, this is really all about slowing subscriber growth. The company missed its estimates for the fourth quarter with 8.3 million subscribers added. It's now saying it expects to add even smaller numbers of subscribers this quarter. When you compare it to last year, we're talking about 2.5 million. In the current quarter, just over half of that 4 million from a year ago. Co-founder and co-CEO Reed Hastings saying yesterday a lot of this stems from the noise created by the pandemic.
There's a number of potential explanations in COVID, but then we worry about hanging too much on that. There's more competition than there's ever been, but we've had Hulu and Amazon for 14 years, so it doesn't feel like any qualitative change there. And overall, confidence in streaming becomes all of entertainment. Linear dissipates over the next 10 to 20 years. Very high confidence in that thesis because everyone's coming into streaming.
So, Brad, you heard Reed Hastings say that COVID just introduced a lot of noise. Right now, it's about kind of pressing the pause button. But all of this around the subscriber growth kind of clouded the fact that Netflix did beat on the top and bottom lines.
Yeah, and when we look at the stock price reaction here on the day, the biggest decline at the open that we had seen since October of 2014. Now, what's significant here is that he mentioned Disney by name. And with that Disney acknowledgement, any magic carpet ride for Disney, we should note on the streaming front, is a demogorgon to Netflix. The fact that one of these things is not like the other because you've got on the Disney side what Netflix is looking to incorporate more of. That's unscripted, more superhero, and sports. Disney has all of those. And for Netflix, trying to continue to gain some ground, especially even when they're issuing some of these kind of bleak forecasts for where that growth will start to stall out in comparison to year over year in subscriber counts, what they've seen, that is something that investors are continuing to trade off of this moment for, and continuing to see the stock move lower, I believe by about 23%. I just saw there on the screen right now, Akiko.
Yeah, magic carpet ride. Brad, I like what you did there. We did see Disney and Roku fall yesterday on the back of these earnings results as well. And of course, we've been talking about this in the context of what recently happened with Netflix, increasing monthly subscriptions, the basic plan now at $9.99, the premium plan at $19.99, a $2 increase. That raised questions among investors who said, look, are they in need of additional funds here? I thought it was interesting. You talk about Disney having, sort of the live events through ESPN. And we heard from Reed Hastings yesterday saying gaining 2/3 of the US pay TV audience was easier than getting the remaining third. And there's just a lot of competition to go after that last remaining segment.
Absolutely. Continuing to watch shares of Netflix here, but I mean, at the end of the day, it's coming down to where, for those 2.5 million subscribers, where in the world they'll continue to come from as well. We've continued to look across the international landscape. And about 2017, 2018, that was an inflection point for them being able to grow up that international subscription. And it's a question of what part of the world where they've hit some of those roadblocks in the past or seen that stall out in terms of the growth, where they'll be able to have the content appeal and appease some of the new subscriptions that they're hoping to see as well. And there you're seeing that international layout for Netflix and the subscriber growth by region there on your screen.
Yeah, let's break down these results further with our first guest for the hour. We've got Michael Pachter, Wedbush Securities Managing Director, Equity Research. Michael, this stock, specifically Netflix, has been a darling during the pandemic, and there's been a lot of concern. Yes, they had a lot of momentum over the last 2 years. Was there a lot of pull forward? What do you make of the stock reaction?
I think it's appropriate. And, as much as I respect Reed Hastings' intellect, he's just not a stupid man. He was incredibly disingenuous in that clip you just showed because he ignored the three things that are driving the share price down. One is that Netflix is a lot bigger than they were, in the last 12 years, and they're approaching market saturation, particularly in high GDP countries. Second is the competition from Hulu and Amazon Prime was maybe 50 million subscribers, 5 years ago. It's over 200 million now between HBO Max and Peacock and Hulu and Paramount Plus and Disney Plus. So subscribers are peeling off. And then the third thing, which really matters, is each of these services is keeping its own content exclusive to its own platform. So Netflix used to have Disney content, not just a couple of years ago. No more. No Disney, no Fox, no NBC Universal, no Paramount, Viacom, CBS. So the idea that Netflix can keep growing without the content it historically has had access to in a market that is fragmented and chasing the same wallets, and with Netflix already penetrated in all above median income households in the West, it was inevitable they were going to stop growing. I've been wrong for 10 years. I'm going to take my victory lap now. I'm right finally after 10 years of downgrade.
Michael, would love to know what kind of spend profile you think that this enters Netflix into. As you mentioned on the content side, this means that if there is that risk of content rolling off so that some of those other platforms can continue to take some of that back and the equity that comes along with those titles, where that means Netflix is going to have to continue to lean in to try and create the next Stranger Things, or just continue to create some of the popular series, Ozark, Bridgerton, and what you may have there.
Well, clearly, everybody's competing for the same content. Netflix has done a great job with owned originals, Ozark not being one of them, coming out today, by the way. That's owned by Media Rights Capital. Bridgerton is owned, but they're paying Shonda Rhimes something like $300 million to produce that. So it's highly likely that is an unprofitable series. They have to keep finding the Squid Games, and they're doing a great job. They really are. I think their original content's great. I think their licensed content's great. The problem is they're probably 75% licensed still, and each licensed property has to be renewed every year. So Ozark, season 4 coming out tonight, I guess it's already out. They have to pay for seasons 1, 2, and 3 again. And HBO doesn't have that problem. All their shows are original, and Disney same. So I think Netflix's cost disadvantage in competing for a shrinking pool of independent content is bad. I don't think they're really any better than Disney or Warner Brothers at making original content. And in fact, HBO content is significantly better, at least on Metacritic terms. So, I think it's just a tough road. I think these guys are battling behemoths who are better at producing content than they are.
Michael, as you noted, you've got an underperform rating on the stock. When you think about the moves today, we're getting closer to that 12-month price target you have of $342 a share. What would it take for you to change that rating? What do you want to see?
Oh, I mean, my target's sincere. So if the stock gets to, and I think our rules here are within 10%. So it literally could drop another $10 or so, and I have the right to upgrade. I actually want to see probably one more quarter, but if the stock melts down and goes to 250, of course I would upgrade. I don't know how permanent this is. There are a lot of people, cult members who have drunk the Kool-Aid, and they decide they just love Netflix at any price. So my guess is it'll probably rebound as soon as the market turns green, and probably go back to 450. And I have no interest in raising my price target until I see what their growth profile and their cash profile is.
And considering that cash and the spend that's necessarily, as we were mentioning a moment ago, on that licensing and even on the production side, where does this set up for one of the other major categories for Netflix too, that at least we've thought they would do better about getting into, and that's on the gaming front, yet we still don't have a ton to go off of there. What are you going to be watching for most closely as we continue to see what types of breadcrumbs they give us on gaming and their ambitions therein?
I really am watching for how many years it takes before they give up and write the whole thing off. Disney tried to do gaming 3 different times in the last 20 years and shut it down 3 times. The only media company that's been successful in gaming is Warner Brothers. And of course, they got purchased by AT&T, and that unit is rumored to be for sale. It's hard. Gaming is really hard. And Netflix isn't going about it right. The guy they hired is an accomplished video game guy, but he last produced a game 20 years ago. And, I haven't seen him cobbling together a team that's going to turn out quality content. So I think they're chasing this the wrong way. I think they should have been involved in buying Zynga. I think they should have been involved in buying Activision, and they just don't seem to have any interest. They don't want to make a big statement. They want to grow slowly. I'm confident they will grow really, really slowly. So the question is just, when do they realize that they can't get there and they have to give up?
You just mentioned 2 names that Microsoft has now gone after. Can't let you go without asking about the big deal this week of Microsoft acquiring Activision Blizzard. As somebody who's been following the gaming space, how big of a shift does this represent?
Look at that Activision share price, $81. That's the risk arbs telling you that they have low confidence that this deal will be approved by regulators at 95. So you're getting a 15% discount on a deal that's likely to close within a year. That's a pretty good return. And Microsoft was out with a tweet yesterday saying they're going to support the PlayStation platform and that Call of Duty will be on the PlayStation. That's preemptive. That's to tell regulators we're not trying to put Sony out of business. Think of Microsoft buying Activision the same way you would think of Disney buying, Fox. They want more content for the streaming service, and they can keep it off Netflix by doing so. So Microsoft wants more content for Game Pass, and by buying Activision Blizzard, they keep it off of the upcoming Sony streaming platform. That's smart. It's legal, and regulators aren't going to block that as long as they continue to support the platforms that Activision supported in the past. So I think this is a great combination. I'm disappointed to see it happen because it takes one of my favorite stocks out of my coverage universe. But it's actually the right thing for Microsoft to do. And Activision gets all of its sexual harassment issues behind it pretty quickly.
Michael, always good to get your take here. Michael Pachter, Wedbush Securities Managing Director of Equity Research. Let's turn our attention back to the broader markets. As we said, the Nasdaq certainly in focus given the week that it's had, dipping into correction territory and being dragged down even further, now on track for its worst week since October of 2020. Let's bring in Art Hogan, National Chief Market Strategist. And Art, I realize there are a number of threads that are happening right now, but over the course of the last day, we've seen 2 high growth stocks take a steep fall. We're talking about Peloton as well as Netflix. These are separate issues, but it feels like there's a bit of a re-rating that's happening broadly on some of those high growth names.
Oh, yeah, for sure. And I think that you can actually couple them together and say, here's a couple of pandemic darlings that likely pulled forward a good deal of future sales and got multiple compression when they had to announce what the future looks like. And I think that that's likely true in all of the sort of high multiple price to sales or price to revenue type companies right now. And that rethinking of valuations really just follows in the wake of rising interest rates, right? So we averaged 1.5% on the yield on the U.S. 10-year for all of last year. And this year we likely average somewhere between 1.75% and 2%. So that net present value calculation is obviously putting pressure on multiples across the technology complex, but much more so in the price to sales and price to revenues. At some point in time, we'll look at this and say we probably are overdone, right? And we've taken too much multiple compression out. And what likely will be the signal that that's the case is when we start to get into earnings season in earnest next week with a much heavier schedule of reporters and see where the winners and losers really sit. And I think that, unfortunately, kicking things off with financials that are likely to be beneficiaries of higher interest rates next quarter, That wasn't true last quarter. So we saw some disappointment in the financials, and then bringing up Peloton and Netflix. Clearly, some household names that have disappointed in the near term. But I think as we get into earnings season, we'll start to look at the damage that we've done, especially under the hood of the Nasdaq Composite, with the average stock down about 40%, and the index being down only about 10 or 11% from its all-time high of late. So I think earnings season, perhaps turns the table a bit, and we look at just how stretched that sell the growth and buy the economically sensitive cyclical value names has gotten on both sides of the equation.
And Art, there's some overlap in what the banks were saying as well in this early moment of the earnings season, in anticipating more rate hikes than even we were talking about at the tail end of 2021. And so if they're saying that, that's going to continue to impact some of those technology stocks that we had seen continue to move lower as well with that potential headwind. And so this question of whether this kind of reevaluation of some of those tech stocks with the scrutiny surrounding some of their high valuations, whether it is kind of oversold or whether this is just the beginning of further selling activity.
Yeah, Brad, the point that you bring up is interesting because, the Fed sort of pivoted at the week after Thanksgiving and dropped the term transitory and started talking about picking up the pace of tapering. And then lo and behold, at their next meeting, they delivered 3 dots in their dot plot in their summary of economic projections, looking for rate increases, perhaps 3 times. And everyone seems to have jumped on this bandwagon and running around with their hair on fire saying, oh, it's going to be 50 basis points in March. They need to shock and awe. We'll likely see 4, 5, maybe 6 rate increases. I think that gets pretty far in front of what a very transparent Fed has done throughout this cycle. And by transparent, I mean just talking about exactly what they want to do versus kind of surprising the market and getting even more aggressive. And they're likely to start raising rates right at the point in time where we're going to see a peak and a rollover in a lot of the inflationary pressures. If you look at the regional Fed surveys that have come out over the last 2 months, we've seen the prices paid component roll over consistently. So I think that come March, the first time they raise rates, which we think will be 25 basis points, they're going to be doing that in the teeth of sequential improvement in inflationary pressures. Therefore, I think they, probably raise 3 times. They do it once a quarter, get the taper behind them in the early spring. And that likely is the case. And if that's the case, and we're going to average, let's say we're going to average 2% on the yield on the US 10-year, and we're 1.5% last year, and you try to do that net present value calculation with a different multiple, if you're not using 3 or 4 and you're using something closer to 2 or 2.5, we've likely priced in a lot of damage, at least on that basis, right? And I think that, if rates are going up for the right reason, it generally is not a detriment to equity markets. The first year of a rate hike cycle typically sees an S&P 500 perform at about half the rate it performed the year before. So that still sort of signals to us that we may have high single-digit, low double-digit returns on the S&P this year.
So Art, give me 3 sectors here you're watching really closely as we get into the heart of the earnings season. A lot of people are going to be watching this saying, look, I've got my money crowded in a lot of these high growth names. Where do I move it?
Well, I certainly think technology and growth is going to be a sector you want to be in 2022, but I think you want to be in it in companies that measure themselves in price to earnings. And I think earnings will play that out. So when you think about some of the household names that have been around for a while, the stalwarts that have large moats and start delivering earnings and giving us guidance, that likely is going to help a whole lot in terms of that thesis there. On the flip side of that, you want to continue to be exposed to economically sensitive cyclicals. So we continue to believe financials, industrials, and energy are going to be the other side of that barbell for you. And I would continue to be focusing on that.
Art Hogan, National Chief Market Strategist, joining us here today. Great to speak with you, Art, and have a great weekend as well. And everyone, on the other side of this short break, coming up, the wheels are spinning for Peloton. The stock falls to a nearly 22-month low, the latest, as the CEO says. The exercise equipment maker is taking significant corrective actions following a bombshell halt of production from a report that came out. All of that and much more next. Peloton shares, they are up on the day after declining 24% Thursday following a report of production halts. There you're taking a look at shares today here, trying to bounce back after yesterday taking an L. The company later issued preliminary earnings results, $1.14 billion in revenue. That's versus the previously provided guidance of $1.1 billion to $1.2 billion, that range. The CEO issued a statement which included moving to a more variable cost structure and identifying reductions in our operating expenses as we build a more focused Peloton moving forward. Plus, Akiko, also new reporting that Peloton has pushed back opening a new factory. There's a ton to dive into on here, especially given the connected fitness space that saw so much favor over the course of the early months of the pandemic, as in-home fitness was really one of those early options and only options as more people were doing everything from home. But now you've got this continued kind of crossroads that Peloton finds itself at, as even when I was looking back at some of the workouts that they've seen for their connected fitness subscriptions, and the number of people that have those devices, those workouts, they started to decline actually right as many of those gyms, whether they be Lifetime, whether it be Planet Fitness, or all of the boutique experiences as well, when they started to reopen. And so it is this larger question of continued coexistence in the face of even more competition that is still yet to come. And I would ask the question, on the bearish comparison here, is this the next Fitbit of the fitness space, where you have some of the other compact and converted connected fitness solutions that are going to emerge? I just did a workout last week for Nordic Track's iSelect Fitness dumbbells connected to Alexa. So there's going to be even more competition that comes forward in an accelerating fashion.
I mean, it's probably too early to say, I would argue, that it is the next Fitbit. There's no question that there was this expectation of demand pulling back as more and more people begin to go back to the gyms. And what we've learned over this last 6 months or so is that a lot of people are opting for more of a hybrid approach, doing some classes at home, going to the gym on some parts. But yesterday's report wasn't just about pulling back on production. It was about halting production temporarily. And that's why we saw the kind of steep fall in the stock. Now, since then, we've gotten a little more color from the company. And I would point to this. It's not just about the production halt. The company now says, in the past, we've said that layoffs will be the absolute last lever we would ever hope to pull. However, we now need to evaluate our organization structure and size of our team with the utmost care and compassion. We're still in the process of considering all options as part of our efforts to make our business more flexible. I mean, this line about considering all options, that's certainly not a sign of confidence if you're invested in this company. But I would argue it's also not surprising when you consider the trajectory of this stock specifically. I mean, I know these are separate stories. We're talking about the business structure and then how quickly the stock has run up on the expectation that this type of demand can be maintained, and it simply can't. I mean, we're talking about a shutdown where everybody had to work at home. Peloton was in that prime position to do that. They're not there anymore, and they also have some competition.
Right. And it is that question of the repositioning of the products itself. And I think they've done well in thinking through the amount of floor space or just kind of airspace a product takes up in somebody's home or apartment, whatever the case may be. And the Peloton Guide was one of the competitive offerings that they put out there to go up against Mirror, which we know Sazi is just so gung-ho about, right? But at the end of the day, I think it's coming back to where they can continue in this strategy, as the CEO was put out there, to have the gross margin improvements, moving towards a more variable cost structure. The CEO, John Foley, has said as well, and then identifying reductions in operating expenses. And that reduction in operating expenses can come in the form of a few different things. It could come in the form of trying to research, develop, and best kind of reimagine what that actual positioning within the home, yet still connected into a Peloton workout, looks like in the future too. And so for those operating expenses, that could also impact what we see in the production, which was what we get back to here once again, and what the demand looks like at that point in time.
And I feel like we've started to hear a little more chatter again over the last 24 hours about a Peloton being a potential acquisition target. We're sort of getting ahead of ourselves, but Apple, one name that we've heard floated around. Do they really need a device to connect everything to? I mean, it's going to be interesting to watch because there is a bit of a shakedown happening. And Peloton certainly at least coming out and saying that we're reevaluating everything. And, you know, if you look at where the stock has slid over the last 24 hours or so, sounds like there might be even more downside, but we'll, of course, be watching that one closely. Coming up, a push to ban individual stock trading in Congress gaining steam, why Arizona Senator Mark Kelly says the timing is right to move ahead with his legislation. That conversation is coming up on the other side. A push to ban individual stock trading in Congress is gaining momentum. A recent poll by Data for Progress finds 67% of Americans would support such a proposal. I spoke with Arizona Senator Mark Kelly, who is co-sponsoring legislation to ban trading for all lawmakers and their spouses, talking to him specifically about why he thinks these changes need to happen now. Take a listen.
We see a lot of information that the general public does not have access to. And it's not right for individuals to be elected to Congress and then be able to trade on that information that the American people don't have. That's why as soon as I was elected, before I was sworn in, I took steps to put my assets in a qualified blind trust to make sure not only can I not make trades, I don't even know what's in there. The same thing is true for Senator Ossoff. Hey, I think anytime we can be, first of all, more transparent with the American people as to the steps we're taking, and getting the corporate money out of our political system and making sure that members of Congress can't trade on this information, it makes Congress work better for all of us. I'm actually the only person. I'm the only person in the United States Congress out of 535 people that does not take corporate PAC money, has a qualified blind trust, and has a public schedule. So my constituents know what I'm doing here every day when I'm in Washington, D.C.
What do you say to those who say this still doesn't go far enough? There should be criminal penalties, for example. I mean, the disclosure rule exists. We've learned from recent reports that lawmakers don't necessarily follow that too. Is there a compromise between all of the competing bills that is a way to get other lawmakers on board?
Well, if our legislation becomes law, members of Congress are not going to have opportunities to trade on the information because they're not going to have control over any stock portfolio that they have. So, the penalties in our case, for folks that don't do this or wind up through another mechanism of being able to trade on the information, there are fines associated with this. But if every member of Congress put their securities into a qualified blind trust, we would not have this problem. And then Congress could really get down to focusing on what's in the best interest of the American people and not what is it in the best interest of members of Congress personally. That's where the problems arise.
Reducing the U.S. reliance on Chinese supply, certainly a big focus of this administration. You recently introduced a bipartisan bill that essentially bans imports of rare earths, the use of rare earths among defense contractors. That's certainly in line with what we've heard from the president, but how do you do that when the alternative doesn't currently exist in the U.S. on the scale that it needs to?
Well, I think this is a first step, and it's got a timeline in there by 2026, right? So defense contractors, folks that are building the most sophisticated weapon systems, fighter airplanes, ships, missile systems, won't be able to use Chinese rare earth minerals in the technology that they build and sometimes sell overseas. So we've got to stop relying on Chinese rare earths in our defense industry. It's a national security risk to us. If China was decide to cut us off on those rare earth minerals, right now, this would have a serious impact on our national defense. So this requires that DOD and the Department of Interior, work together to build a stockpile of rare earth minerals, and we can do this. And we have some time to do it, and then require that defense contractors just use rare earth minerals that they can obtain from U.S. suppliers.
Why specifically focus on rare earths? I mean, there are so many supplies, so many materials that come from China. Why has this been a specific focus for you?
Well, this is one right now where, the supply is in China. And we do not have a significant enough supply here in the United States today. And this legislation will fix that. We'll look for other sources, and we can build this strategic reserve of rare earth minerals over time if we focus on it and if we choose to do it. And this sets the parameters to put the United States in a position that we have to choose to do this. When we build this stockpile, defense contractors will have access to it, and we will build the supply chain of rare earths that we need, because we don't want to continue to be in the situation where our adversary, could cut us off from things that we need for our national defense.
Certainly, we've seen a lot of U.S. businesses who are operating in China in the cost crosshairs recently, especially with this new law that was passed, the Uyghur Forced Labor Prevention Act. You had companies like Intel who had to go out and apologize in China, saying, after they put out a statement saying they're no longer going to be sourcing materials from the region because of the law. I wonder how you're looking at that dynamic, because we're taking this on specific issues, yet some would argue if these U.S. businesses continue to do business in China on the scale that they have been doing, that is only fueling the economy there by way, and also fueling or supporting the government. I mean, how do you think U.S. businesses should be navigating this tricky geopolitical environment?
Well, I think we should be, paying attention to our own, personal norms as the nation. And, the Chinese currently, as you outlined, they use a significant amount of forced labor. The Uyghurs being one example of that. And I would encourage U.S. companies to take a look at that and look for alternate sources. Manufacturing, we make some of the best stuff in the world, right? When you're looking at sophisticated manufacturing, there's no country that's better at it than the United States. We're also very innovative. And we have opportunities here to build manufacturing in the United States, good paying jobs for the American people. And at the same time, we can live up to our own personal expectations of supporting human rights around the planet. And what the Chinese do with forced labor, it's just not right.
And of course, Brad, this issue of reducing U.S. reliance on China, not just a focus of Senator Kelly, but also the Biden administration as a whole. It's interesting when you think about this legislation that he has introduced to ban rare earths or the use of rare earths for defense contractors. It's a bipartisan bill that was introduced with Tom Cotton from Arkansas. So there is broad support for something like that. And to that point, we're hearing from President Biden today talking about building out more semiconductors in the U.S. We had that $20 billion investment announcement from Intel. So that's an interesting one to really watch here because it feels like there's a lot of momentum going in that direction. And it's not just about one component, one mineral, but a reassessment of the overall supply chain.
Yeah, and it really kind of begs the question, especially in Arizona, where you had TSMC really looking at and charting their path towards building out a new plant there, and what that fabrication process could look like for the Valley of the Sun transitioning into the Valley of Silicon, if they were to have it their way, perhaps, and the job creation that could come along with that. Also, the number of other tech companies that have charted their own path towards either testing driverless cars. We know Waymo has been one of the poster children for that effort in Arizona. And so within this state, it's going to be key to watch where some of those tech companies and them moving in also continues to put pressure on some of the locals that have been there for a while, and what that means for campaigning going into 2022 and midterms and even beyond, considering the cost of living and monitoring how that may increase as well as you see an influx of population and residential prices start to move higher as well.
Yeah, no question. Arizona is going to be a big beneficiary of this push to bring manufacturing back home. You mentioned some examples. Intel, another big one, 2 plants being built out there too. So Senator Kelly, of course, pushing for that too, and because he sees the benefits back home. But an interesting one to watch. And of course, we're going to bring you a little more on that Intel investment later in the show today. Coming up, deadly devastation in Ghana. The latest developments after a truck carrying explosives crashes into a motorcycle, flattening an entire town. That story is up next in our Worldview after this break. In our worldview today, at least 17 people have been killed and dozens injured in a mining explosion in Ghana. The deadly incident played out in the country's western region when a truck carrying explosives to a gold mine collided with a motorcycle. The truck exploded about 15 minutes later as residents gathered at the scene of the crash. The impact from the blast flattened roughly 500 buildings and left a massive crater in the ground, leaving nearly 400 people without their homes. Authorities are investigating the cause of the explosion to determine whether companies involved followed proper regulations. Secretary of State Antony Blinken and Russian Foreign Minister Sergei Lavrov met in Geneva today to lower the temperature in a growing standoff over Ukraine. The two sides reported no breakthroughs in their 90-minute meeting, with Blinken standing firm and rejecting Russia's demands to reduce NATO's presence in the region. Lavrov called the talks constructive and useful, saying the U.S. did agree to provide written responses to Russia's demands next week. Moscow has amassed roughly 100,000 troops along its border with Ukraine, leading to fears of an invasion. The Kremlin has denied those plans. And President Biden is meeting with Japanese Prime Minister Fumio Kishida today in the first virtual bilateral talks since Kishida took office. The two leaders touched on economic and regional security issues, with special focus on recent provocations from North Korea and ongoing security concerns stemming from China. The meeting comes as Japan beefs up its own defenses near Taiwan following China's growing military aggression there. The two sides also expected to touch on ongoing efforts to curb COVID-19 and Russia's encroachment on Ukraine. Well, coming up, Hack Attack. We are breaking down how bad actors were able to launder $15 million worth of Ethereum from a major crypto exchange using a service called Tornado Cash, and the steps you can take to protect yourself. That's coming up after this short break.
Welcome back to Yahoo Finance Live, everyone. Crypto hack attack. bad actors were able to launder $15 million worth of Ethereum from a major crypto exchange using a service called Tornado Cash. And our next guest is here to explain how Tornado Cash works and the steps investors can take to protect themselves as part of our Crypto Corner segment presented by Tastyworks. And with us today, we've got Victor Fang, who is the Enchain.ai co-founder and CEO. We've also got Yahoo Finance's own David Hollerith joining us now. Let's dive right in the interest of time here. Victor, I want to go to you first here. Help us break down the significance of this Crypto.com hack that took place and the significance that it places once again around security within the space too.
Absolutely. Thanks for having me here. So yeah, Crypto.com got hacked, right? And then $15 million being sent to Tornado Cash and other mixers, right, a few days ago. And I mean, we've been following these incidents, and I think it's probably related to the two-factor authentication hack. It's not on the blockchain. I want to highlight it's not on the blockchain or smart contract, anything like that. But it's actually on the internet cybersecurity of the countermeasure that company probably have done poorly. And this is actually all related to this emerging sector in cybersecurity called the Web3 security. And Web3 security is all around protecting cryptos, smart contracts, your NFTs, and all blockchain digital assets.
Yeah. So, Victor, can you sort of explain what a mixing service is, just to give our audience a little more context?
Absolutely. So, so far there's three different kinds of major mixing services, right? So, I mean, the layer one, for example, Monero Zcash, and another one is those UTXO-based mixings like Wasabi, CoinJoin wallets, and all that. And this one we're seeing here is actually the Tornado Cash, which we think is actually the latest cool technology being deployed in this space. So it's all enabled by smart contract, and is also using one of the elegant cryptography algorithm called zero knowledge proof, which actually is a very hard to crack. So this is actually the nature of the Tornado Cash, how it was implemented, and now it's operating it's being implemented in open source in Solidity, which is the most popular smart contract language, and it can literally be deploying all other Solidity-based blockchains.
Yeah, and Victor, you've been monitoring Tornado Cash for the past year. Can you just sort of tell us a little bit more about the popularity of the service and how it's used more generally? I know it's not all criminal activity.
Absolutely, you're right. So I would want to highlight that privacy is not criminal activities, right? For example, you're using, like, some of us use the Chrome incognito mode, right? That's not a criminal activity. But what we're being seeing, right, over at least this Tornado Cash, it was being followed for about like 1 year now, right? So yeah, I mean, the hacker turns out to be exploiting this technology a lot, right? Like what you're seeing a few days ago, Crypto.com, right? And the data, right? We're being following this the activity, right, on the blockchain for a while. And last year alone, Tornado Cash has been they make about over $10 billion of crypto being transacted there, right? And it's actually a 600% year-over-year growth. So it's gaining a lot of popularity. And I think that number I just shared with you, $10 billion, is only on the Ethereum blockchain. And like I said before, all Solidity-based blockchains can actually literally just take the code and deploy and then start that infrastructure there. So that number will go up this year, no surprise.
Victor, with that said, certainly a lot of investors wondering about the security here. What do you tell investors what they can do, the steps they can take to protect themselves in light of the latest hack?
Yeah, great questions, right? So I think Web3 security is a emerging trend in this $200 billion cybersecurity sector, right? And so most of the clients, right, come to Enchain.ai, right, looking for help when they got hacked, and we are turning to a incident response and blockchain forensics, right, service like that. And actually, we are actually very glad to see a lot of them actually now realize that, whoa, it's actually we should invest in the preventative countermeasure for their crypto assets, right? So yeah, to most of us, right? So individual investors and all that, preventative is actually way more important than post incident, right? So when you're seeing all these hacks in the news, it's already too late, and there's only very few things we could do if it's already hacked. But preventative, for example, the first one I would recommend is invest in a hardware wallet. Okay, don't store serious assets in browser or like a software kind of wallet. The second one, beware of phishing attack. It's actually possible to spoof the email. You can fake it. Oh, it's sending from crypto.com, right? And I guess this is probably what happened, right? Social engineering and all that, and those may actually bypass your 2FA. So it's a human error, basically, and that happens all the time in the cybersecurity domain. This is not a surprise. The third one is if you're investing in NFT or any smart contract assets, right? So you make sure it's being audited by top tier experts like us, right? So because that's actually one of the key components of Web3 security. You want to make sure that it's actually secure on the smart contract side. And lastly, when you got hacked and all that, is actually not the end of work. We are here to help.
All good takeaways there, Victor. It's good to have you on today. Victor Fang, On-Chain AI co-founder and CEO, and our very own David Hollerith joining in on the conversation. Coming up, Silicon Heartland, Intel doubling down on chip production in the U.S. with a $20 billion investment in the Midwest, but don't expect the chip shortage to ease up soon. We're going to explain in our latest tech support next.
During this pandemic, your pocketbook felt the consequences: inflation, higher prices. Whenever a factory shuts down in one part of the world, the production and shipments of goods to shops and homes and business all over the world gets disrupted. COVID-19 has compounded that problem many times over, especially with these computer chips. As a result, everything from cars to dishwashers, are delayed getting to showrooms and customers, just as demand for them is up because the economy is growing. And because supply is low, we find ourselves in a position that we're really behind the curve. Prices are going up.
President Biden at the White House discussing the chip shortage and the challenges earlier today. This coming as we got a big announcement from Intel, and we're seeing shares popping up more than 1% after the company announced it's investing at least $20 billion into a chip making facility in Ohio. But how big of an impact will this have on the broader chip shortage? Yahoo Finance's Dan Halley joining us now as part of our tech support segment presented by Verizon. We've seen a doubling down here from Intel CEO Pat Gelsinger. We're talking about 2 factories in Ohio, 2 already reported in Arizona. How big of a dent can they make?
Well, yeah, this is a $20 billion on 2 different factories. As you said, there's 2 other factories in Arizona. It's not just Intel that's making factories in the U.S., by the way. We have Samsung and Global Foundries Samsung and Texas Instruments making factories in Texas. We have Global Foundries making a plant in upstate New York. We have Micron expected to build a plant in Texas. So a lot of companies are going to be building these factories. So that means we should be awash in microprocessors, right? We should be able to find them on our floors, kind of like Legos that we step on in the middle of the night. We're just going to be awash in them. But the reality is that's not what's going to happen. In fact, if you look at Intel's own press release, the factory that we're talking about here won't be operational until 2025. So this chip shortage, meaning everything from cars to video games to computers, graphics cards, is not going to be over overnight. And that means that we're still going to have problems getting some of these products. And as President Biden had pointed out, that's partially driving some of the inflation that we're seeing, especially around cars and electronics. And I just kind of want to give you an understanding as to why this doesn't mean that we're going to see an end to the chip shortage overnight. And really, it's because, one, as I said, this factory will not be built until 2025, where we'll start to see chips come off the assembly line. The other factories as well that I mentioned will not be ready anytime this year, or some of them won't even be ready by 2025 because they're not even ready to be built. The other thing is that when you build these kinds of factories, they have to be in a place that's basically away from any kind of seismic activity. They need to be incredibly safe and secure because if there's any kind of shaking or rumbling with the building, when the chips themselves are actually being built, it can screw up an entire wafer of chips. And then speaking of those chips themselves, it can take up to 6 months to build a processor. That's 6 months for one wafer. So really, these chips take a long time to build. And I know we kind of take them for granted. We get in our car, we get Siri going, or our Google Play, or we power up our computers or our game consoles, or we turn on Christmas lights last month. Hopefully, you still don't have Christmas lights up in the middle of January. But really, this is something that's going to continue to be an issue. So my suggestion is, if you're looking for products that require these kinds of chips, the ones that are in short supply, maybe see if you can hold off a little bit longer on making purchases, especially if it's high-end things like graphics cards or game consoles or vehicles, because the prices are still going to be inflated. If they're not inflated, then they're still going to be hard to buy. And yes, it's good news that we're seeing these factories being built. Obviously, it's an issue that has needed to be addressed, but it doesn't mean the chip shortage is going to end overnight.
Yeah, and President Biden pretty clear in sort of calling for patience, saying this is not a 2-year plan. We're talking about a 10-year, 20-year plan to reduce reliance on non-U.S. manufacturers. Thanks so much for that, Dan. Coming up, COVID headaches lingering for Netflix. An analyst is going to be joining us in our next hour to discuss the streaming giant's latest earnings results amid slowing subscriber growth as we see shares sliding down 20%. We'll be right back. Welcome to Yahoo Finance Live and happy Friday to all of you. I'm Akiko Fujita along with Brad Smith. We're seeing the Nasdaq falling deeper into correction territory, although it has come back off of the lows of the session. It's down about 108 points right now, on track for its worst week since October of 2020. The Dow also trading lower, down about 95, and the S&P 500 also in the red. And just like that, the pandemic stock rally is over. A re-rating underway for the companies whose businesses benefited the most over the past 2 years. Netflix shares tumbling after it warns subscriber growth will slow. And Peloton is cycling higher for now. That's after a 24% drop yesterday that sent its shares below its IPO price for the first time since April 2020. Why one analyst has not changed his mind about the future of the company. But we do begin this hour yet again with the slide we are seeing from Netflix. Brad, we highlighted this in the last hour, down more than 20% right now, hitting a new 52-week low, all on the back of those concerns about slowing subscriber growth. I want to bring in our first guest for the hour here. We've got Andrew Merrick, Raymond James Internet and Digital Media Analyst. Andrew, in the last hour, we spoke to an analyst who said that he is, he's been questioning the concerns, raised concerns about Netflix, but you have maintained a market perform rating. You think the sell-off we're seeing today is a bit overdone?
Hi, thank you for having me today. I would say that the reaction that we're seeing in Netflix's shares is appropriate given what we think is kind of a reset in expectations for the pace of subscriber growth post the pandemic. I think bullish arguments would have had you believe that maybe we get back to that mid to high 20s million per year trajectory that we saw in 2018, 2019, prior to the upheaval of the pandemic. Since then, I think the 1Q guidance of 2.5 million subscribers kind of takes that off the table for 2022. And so I think the question will remain, what does normalized demand for Netflix look like as we get past the pandemic? And I think it's actually relatively well below those mid to high 20 million figures. We're at, I think, 19 million for 2022.
And particularly, as you mentioned your targets and what you're looking for, your note has about 19 million, as you were mentioning, 19.6 million even going into 2023. And so with that in mind and kind of factoring in what Netflix has already said and forecasted at this point, on what type of spending do you anticipate that would take place, knowing that this is still a company that's heavily reliant on the titles being popular in many different regions of the world as well?
Absolutely, especially from a subscriber acquisition point of view, which is what Netflix kind of pointed out as one of the weaker areas of their subscriber dynamic. Churn and retention were actually relatively strong, but the subscriber acquisition is the question. And that does really boil down to, can they keep providing that high level blockbuster, headline driving content in order to entice subscribers to join the subscription service? They were about $17 billion in cash content spend in 2021. We have that increasing to about $18 billion in 22 and increasing at a growth rate slightly lower than revenue beyond. We think they're going to continue to spend on content because it is that engine, that driver for subscriber growth and interest.
How much of the slowdown that we're seeing right now is about competition? Reed Hastings did address that, but he seemed to say it's more about the COVID noise than the competition that's leading to the slowdown that we're seeing.
So this was the first time that we can recall that even on a marginal basis that the company cited competing streaming services as an avenue of competition. In the past, it's mostly been focused on things like video games, other forms of digital media. But I think that as we've started to see the direct-to-consumer services start to really scale up, whether that's Disney Plus, Peacock, Paramount Plus, these are companies with very large libraries of content and who are also starting to really turn the content investment flywheel in ways that we haven't really seen, especially prior to the pandemic. So I think as these services, these competing services scale, it's going to create a very competitive market for your streaming video dollar, and it kind of erodes the value proposition of cord cutting. Whereas in the past, you could cord cut, subscribe to one service, and come out well below a cable subscription. Now you're typically having to subscribe to multiple services, and that cost advantage is no longer as great.
So absent the major superhero titles that some of their competition has, absent the regional sports networks or sports overall or unscripted, which they're looking and addressing even more so in this most recent earnings call and report, where does that pricing power, as we're looking at the competition and that competitive landscape and the pricing power, that has Netflix sitting above the rest of the competition in the fold right now that we're displaying. And so does that pricing power begin to wither if you don't have the superhero or the sports or some of the unscripted content?
Yeah, I think the stock reaction today and maybe some of the weaker subscriber guidance is overshadowing a little bit the strength of Netflix's content. Netflix still drives, zeitgeist style content. We were talking about Squid Game. It's the only thing we could talk about in the months of September and October. And then you bolster it with other franchises like You, The Witcher, Bridgerton, which will be launching a season 2 in late 1Q. They may not be sports, they may not be superhero movies or series, but they are headline driving, conversation driving types of content that people want to be included in those conversations and will subscribe to Netflix to be a part of. That being said, they're not really the only game in town anymore.
Andrew Merrick, Raymond James, internet and digital media analyst. Appreciate you stopping by today. Well, the drag on Netflix shares also dragging down the broader index. If we're watching the Nasdaq right now, coming off of the session lows, but down nearly 1% right now. All three major indices in the red. What's been a bit of a choppy session here on this Friday. Let's bring in George Mateo, Chief Investment Officer of Key Private Bank. George, you've kind of warned about the volatility, as have many other analysts. But you say specifically that the economy and the Fed are operating at different speeds. What do you see?
Yeah, thanks for having me. I think it's an important point to note that I think, as you pointed out, the economy and the Fed are really going at different paces right now, different speeds overall. You've got the Fed, I think, is kind of catching up, but we've really seen COVID just turbocharge the economic cycle post the recession. albeit the recession was kind of brief and it was short, but it was deep and it was very quick. And now we've recovered and we're coming out of that recession, if you will. The Fed now is just responding to that. The Fed actually went into the recession being very aggressive with respect to monetary policy, cutting interest rates to zero, and essentially flooding the economy with all kinds of stimulus. Now the Fed is starting to pivot again, and they've announced this. And in fact, when we talked last, we were talking about the fact that the transitory language would have to be terminated, and it was. But now the Fed has to think about raising interest rates, withdrawing some of that liquidity, and with that, you've got a transition hands that's spelling a lot of volatility for investors to contend with.
And so you think also that the Fed is going to feel compelled to move faster than expected. We've heard this signaled early in the earnings season from some of the banks that have reported thus far, many of them coming out with their own expectations for how quickly that tightening process will have. What most notably would you be looking out for, though?
Yeah, I think it's fair to say that there's probably a few people that still think that inflation is somewhat transitory. And I guess in our view, it's going to be a bit more persistent. I mean, nothing lasts forever. And I think we will get through this at some point. But from our view, I think inflation is going to stay a bit hotter for three reasons. Labor prices are going to continue to be pressuring economies, and that's going to be with us for quite some time. Secondly, the housing market is just roaring, and that's also going to be an inflation headwind. And then energy prices are somewhat of a wild card, but we think they're going to be moving higher as well. So you've got those three things of labor, housing, and energy that really spells inflation might be a bit stickier and a bit more persistent than people think. With that in mind, again, we think the Fed is going to have to be withdrawing stimulus from the economy as it is, talking about tapering, talking about rising interest rates. And really next week will be a very key week in terms of what the Fed might do. Since we wrote some of these notes, we've talked about that the Fed actually has responded to this. They've started to signal that they're going to be more aggressive. Just how aggressive they will be, though, will really hold the key for what the economy does going forward and how the markets perform thereafter.
Yeah, we've had several weeks to really speculate all over the place. We'll finally get, hopefully, some clarity come next week. You mentioned all of those levers or the concerns around inflation. What's the hedge? What are you looking in terms of your portfolio looking at?
Yeah, well, I guess overall, we have a theme this year that it's going to be hot, crowded, and flat. So by that, I mean inflation is going to run hot for a while. Markets are somewhat crowded overall. You've got some indices that really are dominated by a number of small companies. And also even the large indices are dominated by a very few number of companies. So right now, the S&P 500, for example, is made up of about 5 companies that control 25% of the market cap. And we have days like today when you have volatility rising, that crowdedness in the market spells a lot more volatility. Overall, though, I still think at Kiko that we can see kind of a flattish year this year as earnings growth could be quite strong. We're probably going to have a bit of a disappointment this quarter in the sense that Omicron is going to take some of the wind out of the sails. But overall, as some of those trends and those headwinds start to fade, we still think the backdrop for profits is pretty good. And with that in mind, flat markets overall is kind of our theme for this year and for the rest of 2022.
Yeah, Omicron variant, and then additionally some of the supply chain concerns that we had seen already showing up in some of the data as well. And so even as we look further out into the future, how far out do you believe investors are looking right now and trying to price into the best of their ability some of the anticipated major movements that we're going to see either from the Fed or even from the White House as they continue to go into a heavy political year with the midterm elections?
Yeah, that's a good question. And gosh, there's so many wildcards out there right now, right? With all respect to this game theoriness, with respect to what the economy might do, what the Fed might do, how the administration might cajole the Fed to actually take action. And I think one thing we have to look at is really the slope of the yield curve. I think that's going to be really key to watch in terms of how quickly the Fed actually starts withdrawing some of the stimulus and how the market responds to that. Right now, the curve is still positively sloped by about 80 basis points. That's not great, but that's not bad either. And if we start to see that curve start to invert, and really the difference between short-term interest rates and long-term interest rates starts to converge, then that would signal that something might be more concerning. So I think in this environment, again, we've got hot inflation, crowded markets, flat returns, I think is the outcome. And in that environment, you want to be very selective. You need to be somewhat nimble. I think you also need to be somewhat flexible with your mindset going forward. And I think if you can maintain that framework and be somewhat more malleable and more flexible than you might be in the past, I still think you can navigate this market fairly well. But selectivity is going to be very key going forward, in our view.
All right, George, last time you were on, you said that the Fed should eliminate the stance of transitory. They did just that. We'll have to check back in the future to see what else they may have been listening into as well. George Mateo, who is the Key Private Bank Chief Investment Officer, joining us today. George, we appreciate the time. And coming up, everyone, if I dip, you dip, we dip, has been the tune for global cryptocurrencies, recently with an overall 10% decline in market value over the past 24 hours, a continuation of the early year declines we've seen. So what's the 2022 outlook amid regulatory considerations and metaverse development revving up? Stick around and find out. The global crypto market, that has been in decline, down 10% over the past 24 hours. You're taking a look at Bitcoin, BTC, USD on the day, down by about 10% over the past 2 days, 7.5%. Bitcoin and Ether have seen high volatility throughout January, despite continued pushes by social media companies towards NFT assets and metaverse transactions partnerships this week. For more on the outlook from here, we're joined by Steve Kurz, who is the Galaxy Digital Head of Digital Asset Management, joining us now. We've also got Yahoo Finance's own David Hollerith joining us once again. And so, Steve, let's dive right in on the action that we've seen over the course of this past week. What do you believe is really at play here, and what does this set up kind of going into what is a heavy development environment for applications on the blockchain, but more specifically, kind of the annexation of the cryptocurrencies we've been tracking?
Yeah, thanks so much for having me. Look, it's pretty normal for crypto to have volatility like this, particularly to the downside. I think what's different, obviously, and as a student of markets, you have to respect what's going on with the Fed and in the interest rate market with inflation numbers. And so I think everyone in the crypto market is looking to, Jerome Powell, and I think some of the softness that we've seen in crypto probably continues. There's a real lack of a sort of ballast or anchor point to something like a Bitcoin price when you see these kinds of moves happening in the macro markets. So I don't think it's anything idiosyncratic to crypto, but we're getting caught up in this big move. And I think that's going to take a little bit of time to sort itself out in terms of the underlying flows and the technicals.
Yeah, and Steve, I mean, there's so many factors that do contribute. It seems, as you pointed out, it seems like most of what's going on here is macro. But I was just curious, are there any underrated factors maybe that might be playing into the crypto sector sell-off?
Well, what's interesting is there's this crypto's a hyper liquid market, and there's this gap between the wall of institutional interest that we see every day. That's episodic, it's lumpy, it takes time, and then the here and now battle and interplay between crypto and other risk asset market environments. And so structurally, I think we're quite constructive on how this plays out, but it's not like there's a marginal buyer for every dollar that sells off when you have such a big top-down move. I don't see anything under the hood in terms of different aspects of crypto that's necessarily worrying. That said, I do think there are idiosyncratic stories within crypto that are some are better than others, and some continue to do quite well through this volatility, as you alluded to at the beginning of the segment.
Steve, it's Akiko here. Anytime we see a sell-off in crypto, we try to think about the correlations, and often they don't always stick. But I wonder where the institutional money has been moving. I mean, we've seen that over the last year, maybe more. But as we see volatility kick in on the equity side, are we seeing money move out of crypto?
We're not seeing institutional money move out. I think there's obviously the obvious liquidations that happen during periods of time like that. The average institution, whether it's a hedge fund or an allocator, is actually very focused on still how to get off of zero and how to get to 50 basis points of their portfolio in crypto. So the real question is, does this sell-off impact that timeline as opposed to has it actually been selling? We have a number of institutional clients. We manage certain ETFs and other products. We haven't seen anything out of the ordinary in terms of negative flows when you think about Bitcoin or ETH. But obviously there are questions about, are we in a bull market or a bear market broadly? And I think that'll trickle through to timing, but not necessarily to the ultimate decisions that get made.
And Steve, we can't really forget about the $33 billion into venture capital funding that's been raised over 2021. So I'm sort of curious, in an environment, if we're going to be realistic, might not be like 2021. What do you think is going to happen to that capital raise? How would it be deployed? How are you expecting to see that in the sector?
Well, it's a great point, and our research team did a great job pulling a report together on this. And what was interesting is the dispersion. It wasn't just growth equity or Series A. It was really from seed all the way through. So there was a healthy, in the stack of venture investing, it was healthy and across not only crypto verticals, but also across stage. And so I think a lot of what's being built from the early stage venture side is incredibly interesting and tied to this Web3 metaverse narrative. And then you look at the later stage stuff, there are 43 or 41 unicorns that came out of that bucket last year. And those companies have to really prove themselves and their revenue lines. And it's a different equation for those companies. But that's one of the reasons we're so bullish. If you look at NFT activity on OpenSea, if you think about all of the big centralized tech companies moving into the meta game, when you think about the things we're investing in and the funds we're launching, yes, it's a more tactical environment. Yes, maybe macro's negative, but I think the 3 to 5 year stories are really strong, and that brings talent and more capital into the space. And so we are structurally bullish, but we're trying to look through a little bit of this market noise along the way.
Yeah, if we're talking specifically price moves, Steve, I was going to ask you on whether, in fact, you have maybe shifted your price target looking to year end, given the volatility. It sounds like you're even more bullish. Mike Novogratz, we know, has said everything from what, 500,000 to 250,000. What are you looking at?
Well, look, there's a couple of psychological levels that have broken down. 2 trillion of overall market cap in the space, 40,000 for Bitcoin, 3,000 for ETH. You have to pay attention to that. You have to respect that. I think crypto's higher at the end of the year than where we are today. I don't know that necessarily happens in the next 1 month or 2 months. I think there is some work to be done in terms of that. And I think importantly, when you look at the NFT market, which is in the tens of billions relative to the $2 trillion of crypto, you're going to have really idiosyncratic growth stories. It's why we're focused on those early stage aspects. It's why we're focused on active management, quite frankly. This is a trader's market for crypto, but also for macro and other assets. And we think that's probably a good thing for crypto overall, that you have such a broad palette to now play with from the perspective of a market practitioner.
The interesting thing right now that we're also seeing, Steve, within the space is the amount of hiring and the executives that are being added on to so many of these ambitions. And you've got another transition of your own that you've seen within the company. And so walk us through why this made sense right now and the executive kind of how we may see even more of that evolution from tech executives, from finance industry executives getting into this space.
It's a great point. I haven't seen anything like this ever in my career, but the last time I saw it was really from the sell side to the buy side following the global financial crisis. It's very clear that that trend is happening now towards crypto, both the buy and the sell side within the financial services industry, and then obviously from centralized tech to decentralized tech. We're delighted to have hired Bill Burt, who was the COO of the Portfolio Solutions Group, the $55 billion fund of funds at Blackstone, to work with the team here at Galaxy. The reason for that was obvious. We're trying to build a world-class institutional asset management business with multiple legs of the stool, and having someone with that kind of expertise, scaling a business, multiple business lines, doing it in a regulatory compliant fashion. You need to have adults in the room who have done this before. I think that's a microcosm for everything that's happening at Galaxy, but also across the entire crypto space. We're growing up to meet that next phase, which includes regulatory and education at scale and doing things obviously the right way in an institutional grade fashion.
Yeah, so many changes happening almost on a weekly basis. It feels, Steve, we've got to have you back on the show again soon. Really appreciate the time today. Steve Kurtz, Galaxy Digital, Head of Digital Asset Management. And our thanks to David as well for joining in on the conversation. Coming up, the wheels are spinning for Peloton after the stock falls to a near 22-month low. The latest, as the CEO says, the exercise equipment maker is taking significant corrective actions. Following that report, it's halting production. That's next. Well, shares of Peloton are facing an uphill ride here. Shares bouncing back today, but not before losing $2.5 billion in its market cap. Those steep declines came after reports the company is halting production of its fitness products. Let's bring in Andrew Boone. He is JMP Securities, the Citizens Company Managing Director, Research Analyst. Andrew, it's been a bit of a rough ride, not to use the pun here, on Peloton over the last day. Those reports first came out. The company said, well, It's not all production. What do you make of, number one, of the stock move, but about where the company is positioned right now?
Yeah, we continue to view Peloton as a best-in-class connected fitness product, right? We love the bike. We think it's head and shoulders above the rest of the industry in terms of the experience, the digital library, brand awareness, just the overall consumer offering. Yet at the same time, it's pretty clear to us that the bigger picture macro pull forward of demand means that we're going to have a pretty tough 2022 in terms of consumer demand, right? Just fewer people are building in-home gyms. And so what was, triple digit growth over the last number of years is now going to slow as we look to 2022, given these macro headwinds.
And so with that, we got a little bit more detail on the subscribers, ending connected fitness subscriptions of approximately 2.77 million versus the previously provided guidance of 2.8 to 2.85 million, even in some of those advanced numbers that we got ahead of the earnings report. And so even going out from here, we look across the connected devices that they have right now and the active monthly workouts that they're seeing. And that was already in decline and really kind of correlating to when some of those in-premise or on-premise or IRL fitness experiences reopen. So what do you expect to see on the workouts front? Because that too is one of the major selling points if people are buying into a couple $1,000 connected fitness device.
Yeah, I think the recent trend in overall workouts was really due to seasonality. And so as we've gotten into 4Q, there's now snow on the ground in some places. It's just colder outside. You usually see an uptick in terms of 4Q as well as 1Q for workouts, just given the weather patterns. So I would expect that to normalize in the upcoming quarters. In terms of connected fitness demand overall and the product, Peloton has multiple drivers for growth, right? There's international market expansion. There's new products that could be launched. There's long been rumored of Rower out there. We've done the work in terms of looking at website traffic growth and tonal as well as hydro, both categories which Peloton doesn't really address today well, are growing year over year. And so you're seeing actually demand overall for connected fitness devices. It just may be in areas that Peloton has yet to address. Right, they've launched the Peloton Guide, which is more like a mirror product, but they yet to have a resistance or actually a connected weights product that could lead to incremental demand from consumers.
Andrew, who do you think provides the biggest competition right now to Peloton? I mean, that's one argument here is that, sure, they have really been a leader in the space, but there's a lot of other players here now.
Yeah, no, it's a fair argument, right? Tonal's rates $600 million, Hydro's rates $200 million. There's a lot of capital that's come into the space overall. And look, if I go on Instagram, I'm scrolling through, I see my Peloton ads, and now I also see, I think Fight Camp ads, I see Hydro ads. There's just more competition across the space, and as I think Brad mentioned, there's more competition for in real life fitness as well, right? You can go back to your boutique fitness provider. You can go back to a SoulCycle class, Orange Theory. And so Peloton, look, it's a best in class consumer experience, yet at the same time, there are now more options. And so there are fewer people that are building in-home gyms. So if you go back and you look at the trends, kind of go back to 2019, right? Prior to the pandemic, what we're looking at for 2022 on our estimates, we're up 3x from those levels, right? The problem is that even us being up 3x from pre-pandemic levels, it still implies year-over-year declines, just given the massive pull forward that we had in 2021.
Even as the company had pushed back against some of the production halt stories and reports that had come out, we do have the statement, of course, that the company still did put out addressing the efforts to kind of put off some of these and identify some of these reductions in operating expenses, building a more focused Peloton moving forward, variable cost structure, all of these things that they're approaching and kind of trying to navigate through right now. How would you read through what they said to anticipate where they're going to make some significant changes?
Yeah, so I think there are two big components in terms of operational kind of optimizations going forward. One is on the production side. And so looking backwards, Peloton bought a Taiwanese factory. So they now own their own production internationally. They also bought Precor, right, which has a factory in North Carolina. They've committed to building a factory in Ohio that's set to open in 2023. So if you look at the production numbers that kind of were stated, I think a couple quarters ago, Peloton has about 2 million units of capacity. And so again, going back to our estimates for 22, we're talking about 1.3 million units with more capacity coming online the following year. And so, okay, so what does that mean, right? Is the way to optimize profitability for a factory is to optimize your utilization of those fixed costs. And so look, Peloton invested across their entire last mile delivery chain. They invested across production. And so now they're having to find ways to rationalize those investments as demand has slowed. On the operating expense side, Peloton has invested in marketing. That probably is now going to get pulled back, as well as just experiencing double-digit growth basically for the entire history of the company, which is 10 years. And so these guys have built a cost structure that expected further growth. I think one of the press reports said that they expected growth in the industry overall to be flat for 2022. That's likely how they planned headcount. And so now as we're starting to see growth slow, right? And so, Brad, to your earlier point, these guys missed their connected fitness number for 4Q. That's what they reported last night. It's a miss. And so it appears that growth is slowing through 4Q, and our checks suggest that it's slowing again in January. So to that end, the investments they made across their personnel was probably a little too high if you go back just even a quarter. And so now that has to be right-sized on a go-forward basis, just given a slower growth profile.
All right, we'll be watching closely to see what type of restructuring or cuts that may even mean for Peloton in the near future. Andrew Boone, JMP Securities, a Citizens Company Managing Director, Research Analyst. Thanks for joining us here on the day, and have a great weekend as well. You guys, coming up, a new grind for Starbucks here. The latest scrutiny for the coffee chain giant after the company walks back its plans to drop a vaccine mandate for employees. That is next. Shares of Starbucks holding on to some gains on the day here. This even after hashtag boycott Starbucks was trending on Twitter. That after the company changed its coronavirus vaccine policy and aligns with the Supreme Court's ruling. For more on this, I want to bring in Yahoo Finance's own Danny Romero. Danny, what can you tell us?
Yeah, Starbucks is facing major criticism after the company announced that it would no longer require its U.S. workers to get vaccinated or submit that weekly testing. But this is all after 2 weeks ago, the company announced that they would require their workers to get vaccinated and submit that weekly testing. However, that was before the Supreme Court ruled against the Biden administration's effort to compel companies to adopt that type of mandate. Starbucks chief operating officer specifically cited the ruling in a statement to workers about their change in policy. But the hashtag, like you said, boycott Starbucks has been trending on Twitter, with consumers saying that they will no longer go to a company that does not require its workers to get vaccinated. I reached out to SB Workers United, the group fueling the unionization efforts at Starbucks, for comment, and they sent us this statement that reads in part: Starbucks reversed their vaccine mandate without discussing the issue or negotiating about it with the unionized partners at Elmwood and at Genesee stores, which are 2 stores in Buffalo, New York. Another comment from a barista is, we truly appreciate the care and concern our community shares with us regarding Starbucks' decision to axe the vaccine rule. It's up to customers on whether they choose to boycott. But if you're looking for some tangible ways to help your baristas get vaccinated, donate that K95 masks, complain to corporate, and cheer on folks fighting for a voice in the company. And again, that was from a barista in Boston. We reached out to Starbucks for a comment in regards to the criticism, and they referred me back to the letter that they had sent to their workers, which says, we strongly encourage all U.S. partners to get vaccinated and encourage disclosing their vaccination status. Also in that letter, it states that 90% of workers have fully disclosed their vaccination status and that the vast majority are fully vaccinated. Again, the company employs about 228,000 workers. Akiko, Brad?
Yeah, Danny, the reaction on both sides speaks to just how polarizing this issue has become, but certainly a story to follow. Thanks so much for that. Coming up, stocks are on track to end the week lower. We're going to be taking a look at the latest market action as we see all 3 major indices in the red. We'll be right back after this break. Welcome back to Yahoo Finance Live. The Nasdaq off of the session lows, but continuing to drag lower right now, down about 1.3%, dragged down by those disappointing subscriber numbers out of Netflix. For a look at the rest of the market action today, let's bring in Yahoo Finance's Inez Ferre. Inez.
And Akiko, the Nasdaq 100 heading for its worst week since March of 2020. Let's take a look at the components on our Wi-Fi interactive board. You can see that Amazon is down more than 3%. We're also watching Tesla down more than 3%. I'm going to put this as an equal weight chart so you can see, as you were mentioning, Netflix down 21%. But I want to mention over the last 2 months, some of the pandemic darlings, as we call them, really getting hit over the last couple of months. Peloton, Netflix, Zoom, DocuSign, all of these names which did well during the pandemic under pressure. If we look at the electric vehicle space over the last 2 months, also same kind of scenario where we're seeing pre-revenue or low sales or no profit companies that are involved in the EV space really getting hit. Also looking at the meme stocks, we're watching AMC, GameStop over the last couple of months that have been getting hit. Today, we're watching the action on these meme stocks as GameStop is off the lows of the session. It had been below the $100 level. It hadn't seen those levels since February of last year. And also AMC hadn't seen its levels since May of last year of 2021. And finally, I also want to mention Robinhood, which has been on a steady decline. In fact, Robinhood year to date down 26%, but over the last 6 months, this stock is down about 80% from its all-time highs back in August of last year. Again, the companies that did well, in this case, Robinhood, you had a lot of retail users going on the app that were trading on Robinhood. Those that did well during the pandemic are starting to see major haircuts. Akiko, Brad.
Inez, thank you so much for those updates here, tracking all of the major activity here on the markets, everyone. And coming up on the other side of this short break, we get to our Twitter poll. We asked you what you think about Netflix's price hikes, especially as we've been breaking down the streaming giant all day, given some of their price activity. We've got the results from that poll on the other side of this short break. Welcome back to Yahoo Finance Live, everyone. In our decision of the week and our poll for our users and viewers to get involved with, Akiko, we asked everyone how they feel about Netflix raising prices. And we've got the results for everyone, especially as we've been breaking down Netflix throughout the day. Here are the results for you folks. Okay, so it's pretty even actually, but the leader and the winner in this, 28% of people saying it was already too pricey, 25% saying not my account anyway. So that perhaps whittles out anybody that wasn't paying. And 24% saying that they're canceling their subscription. This was the last straw for them, Akiko.
I'm curious, to your point, Brad, how many people actually pay? I mean, that's the one thing that Netflix has asked every single quarter. Are you going to crack down on password sharing? They haven't until now. And so, you know, for those who are saying it was already pricey, I'm going to assume that you're already paying. But I'd be curious how many people are actually going to pay or maybe share even more because of the price increase. And let's try to break down what the increase is, because we were showing a chart earlier in the hour about where Netflix now stands in comparison to their competitors. The basic plan for Netflix is at now $9.99. The premium is at $19.99. And that puts Netflix at the higher end of the spectrum, or the highest end of the spectrum compared to some of their competitors. So on a day where we're talking about slowing subscriber growth, I'd be curious to see whether that in fact starts to hit some of their numbers in this current quarter, as well as moving forward, because as you see on the screen, there are so many streaming sites right now. And, you know, viewers are starting to sort of pick and choose which ones they want to pay for.
Yeah, it's spot on. And you look at three of those that are on the screen right now in Disney and Hulu, and the fact that they've got their own bundle package that you could throw an ESPN Plus for. And then on the other side of that, you have Apple TV Plus, which gets thrown into that broader Apple bundle where you can get some of the other services that they provide, whether that's fitness, whether that's some of the kind of cloud storage. They're basically just trying to make it an all-in-one ecosystem for themselves. But all of that considered in the comparisons and trying to make their ecosystem stickier, what else does Netflix have? Gaming? Not really. So when we see some of those investments continue to pay off for Netflix on the gaming front, or continuing to try and make the content that much more carrying out much more fanfare, even in an environment right now where we still have that lag of blockbuster titles that are driving people back to the movie theaters. This is still that era that Netflix could capitalize on. But it's all a question of which regions that comes down to, what the price points are in those regions as well, because we do know that they have that type of elasticity, or at least a selective process of making sure that it is appealing in different markets at those price points. But I think for Netflix right now, it still comes down to this game of where the content spend is moving forward from here on, in either original or a licensed front, even as so much of that content vacuum that's taking place really emerging from 2017 into 2019 has been present, how much that's potentially impacted that continued subscriber growth for them.
And we did hear from Netflix's COO discussing this very issue. Let's take a listen to what he had to say.
If you look at Disney Plus as an example, but other streaming services out there as well, and their ability to grow, even as we've been growing as well, I think it's really strong endorsement for the core idea that consumers around the world are willing to pay for great entertainment, and it encourages us to continue that investment and to try and deliver more entertainment value and earn more of that share.
Chief Operating Officer and Chief Product Officer Greg Peters there weighing in on that. A lot of questions. Netflix is going to continue to face pricing, just one of them, but at least for today, they are continuing to take a steep hit in this session. If you look at where stocks were down more than 20%. Let's take a look at the broader indices here as we count down to our weekend. We've got all three major indices continuing to be in the red. The Nasdaq down almost 1.5%, and that is the one we're watching as we continue to see it drag down even further into correction territory. Much more to come here on Yahoo Finance Live. Have a good weekend to all of you. Keep it right here.
More market volatility, Netflix helping drag the Nasdaq deeper into correction, but are we oversold? And what data is the Fed considering ahead of its policy meeting next week? We'll ask an analyst. 3 new studies from the CDC show boosters are beneficial, not just helping prevent infections, but also helping keep people out of the hospital, especially those over 50. But is Omicron hampering booster efforts? Plus, Airbnb CEO isn't just talking the talk, he's also walking the walk. Brian Chesky plans to work remotely, moving from city to city, staying where else but at Airbnb properties. Yahoo Finance catches up with him to chat that and more, even the Olympics, in a wide-ranging interview just ahead. You will not want to miss it. Welcome, everyone. I am Karina Mitchell, along with my co-anchor, Alexis Christoforous, and it is Friday. Alexis, what a week it has been. Not the best start to tech earnings this week. And also, as our EP reminded us this morning, Nick, also not the best time to check your 401k.
Yeah, you might want to hold off on doing that for a little bit. Definitely a punishing week for investors, Karina. Stocks looking to close out a volatile week with some big losses. In fact, the S&P 500 on track to close out its worst week in 15 months, down now 35 points. The Dow Jones Industrial Average has been all over the map today. It was up about 100 points. Now it's down 156. And the Nasdaq moving deeper into correction territory, off about 13% from its recent record peak. Investors continuing to rotate further away from growth and tech stocks, which we know have outperformed since early on during the pandemic, and the darlings of the so-called stay-at-home trade getting clobbered. Netflix down sharply today after its first quarter subscriber growth outlook fell far short of expectations. But Peloton, different story, recovering some losses after hitting a 2-year low yesterday on news that it's halting production of its fitness products amid a slowdown in demand, though Peloton CEO walking those claims back a little bit today, and the stock is up nearly 14%. Want to get a quick check of the bond market. Treasury yields easing a bit today. Another volatile week here in the bond market, and we have the 10-year yield at 1.76%. Remember, it was at about 1.9% earlier this week, and we've got the 30-year yield down to 2.07%. Of course, investors in both the bond and equity markets waiting for next week's Fed meeting here. We hope to learn more about the timing of an interest rate hike. For more on the market action now, let's check in with Inez Ferre, see what she has her eye on this Friday. Hi, Inez.
Hi, Alexis. The Nasdaq 100 is heading for its worst week since March of 2020. And if we look at the components on the Nasdaq 100, we're watching Amazon that's down more than 3%. Tesla is also lower right now. I do want to show you an equal weight chart so you can see today's action. Netflix down more than 20%. DocuSign is lower. But let's take a look at a 2-month chart, because a lot of this shredding of these pandemic darlings, as we call them, or these companies that have done well during the pandemic, has happened over the last couple of months. And you can see the biggest decliners down here, DocuSign, Peloton. Even though Peloton today is up over the last couple of months, it's been severely under pressure. Netflix, Zoom, also part of that group. Looking at the electric vehicle space, still sticking to that to this 2-month chart, we are seeing that the companies that are involved in the EV space with no profit or pre-revenue or low revenue, these are the ones that have been declining the most. Remember that a lot of money flowed into these EV companies in the last half of last year. Also looking at the speculative stocks like AMC, like GME, GameStop. This is still a 2-month chart. I'm going to take it back to an intraday chart right now. We're looking at GameStop that's down more than 1% off its lows of the session, but it did hit below the $100 level, a level it hasn't seen since February of last year. AMC also lower today, down 3% at prices it hasn't seen since the spring of last year. And finally, I want to mention Robinhood, which is not necessarily a meme stock, but some would say is sort of a proxy when it comes to the retail investor. Robinhood seeing new lows yesterday, closing at a new low. In fact, Robinhood is down around 80% from its all-time high back in August of last year. Again, this is a company which saw a lot of inflow of retail traders during the thick of the pandemic, a lot of retail traders going on the platform to trade, but it has been under pressure over the last couple of months as investors really question these lofty valuations for some of these companies, especially amid high inflation and possible rate hikes in the future. Alexis, Karina?
Okay, Inez, there is a lot going on. Thanks so much for breaking that down for us. We are going to stay on the markets and bring in our guest, Niladri Mukherjee, head of CIO Portfolio Strategy for Merrill and Bank of America Private Bank. Neil, thanks so much for stopping by with us today. I want to just get your sense of what you're seeing in the markets, all the volatility. Today, it looks like equities are shaking up the bond market, which is a reversal of what we've seen the last 3 weeks. So is that a temporary pause in what we're seeing happening in bonds and equities? And then do you think we've seen the worst of the sell-off?
Well, I think what you're seeing is across the board, and this has been playing out for the last few months, which is companies with less profitability, companies with questionable business models, companies with a high PE, high valuation, etc., more speculative companies, more concept-oriented stocks. They have been weakening since really February of last year, and now that weakening has accelerated. Meanwhile, the market is rotating into value-oriented investments, and even some defensives are doing better. So I think the market is now pricing in what is going to be a pretty an environment which is going to be pretty difficult from a liquidity standpoint. So the Fed is obviously going to start hiking interest rates starting in March, most probably. So you won't have that tailwind going forward. And I think some of this volatility is to be expected. We had a great year in the stock markets last year, and we had, over the last 3 years, something like 100% return in the S&P 500, and 5% like returns actually happen 3 times a year. So this volatility, in my mind, is welcome. It is to be expected, and I do think it creates an opportunity for long-term investors to pick up some high-quality names on the cheap going forward.
And Neil, speaking of being to be expected, what about these stay-at-home trades, right? Zoom, Netflix, Peloton saw incredible growth both in the stock market, but also their bottom lines early on in the pandemic. And investors seem to have soured on these stocks. Do you think the sell-off we've seen in that trade has been a little bit overblown? Because at the end of the day, we all knew that torrid pace of demand would have to end sometime.
You're absolutely right. And some of these names, if you think about it, came out of nowhere and became household names within a few months of having the pandemic beginning, and everybody using it across the board globally. So it wasn't a surprise. Perhaps it was to some people, but as the pandemic raged on throughout 2020 and into 2021, these stocks just kept doing well and kept going up, and their earnings estimates went up. Their case for profitability became even more stronger. But funny things happen when liquidity conditions change in the stock market. That's when fundamentals start to reappear, and I think that's what investors are doing now that the Fed liquidity bonanza is behind us, and looks like they will hike interest rates and potentially shrink the size of their balance sheet. I think these names could continue to struggle. And if you think about where we are in terms of the pandemic, with vaccinations, with Omicron raging through the entire population in very quick fashion, I think some of these names are also discounting the fact that we could be getting slowly but surely to the other side of the pandemic. In fact, many research reports are pointing to that, and experts are saying that, especially as vaccination rates are improving. So I think investors are going back to the names that they had ignored for a long time. Once we get to the other side of the pandemic, I think it's less likely that people will be sitting at home and watching Netflix. I think more likely they're going to be getting on a plane and going for their beach vacation or wherever they go for a vacation. So you see that rotation, you see that flows play out in the stock market as well.
And then what do you see as far as the international story? Do you see opportunities in, let's say, Japan, in China, as opposed to the US now?
Yeah, it's interesting. International has gotten off to a slightly better start compared to the US. Keep in mind that the US has handily beaten international over the last 7 to 10 years. And every time international starts to gain some traction, it looks like the markets pivot back to the US as the outperformer. I do think that international developed markets, like you mentioned, Europe, Japan, they have the potential to keep up with the US. Valuations are reasonable there. When we go to the other side of the pandemic, countries like France, Italy, Spain will benefit from a recovery in tourism. If you look at the European Central Bank, at the Bank of Japan, they are less hawkish than the Fed is. So that's a relative win in terms of the stock market for those regions. But if you look at emerging markets, they've started the year off a little bit better, but they have a lot of fundamental challenges. If the dollar stays strong, I think that hurts emerging markets. If China continues to slow down, even though they've started to induce some monetary policy back into the economy, but they're expected to slow down quite dramatically this year, I think that takes away from emerging market fundamentals. And if they continue to be on this path of regulatory oversight of technology, real estate, education, et cetera, I think that is another negative for emerging markets as well. So I would say on a risk-adjusted basis, it's still a good time to be favoring the US because the outcomes around our base case with respect to inflation, pandemic, and Fed liquidity are very wide. So from a risk perspective, I think US is still the best market to invest in. And I think international developed could potentially keep up with the US, but I still find fundamentals in emerging markets extremely challenging.
And Neil, finally, in the 30 seconds we have left, we know that volatility is going to be the name of the game, at least in the short term, especially for tech. Do you think it's anywhere near finding its floor yet?
I think we're almost there. I think keep in mind tech is majorly outperformed US indexes over the last 10 years. So the market is trying to find a floor here. I think we're getting to that point. I do think there's more downside with some of the high PE and speculative names, but I think in the next couple of weeks, it will be time for investors to come in and step in to those high quality, old technology, free cash flow, secular names, which are levered to things like the digitization of the global economy. So I think we're getting close on that front.
Definitely, there is a lot of value in free cash flow at this moment. All right, we will have to leave it there. Niladri Mukherjee, head of CI Portfolio Strategy for Merrill Lynch and Bank of America Private Bank. Thanks so much for stopping by today. And we want to step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. You can get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. Just check it out today at yahoofinance.com/plus. And we've got much more coming up. Boosters are beneficial. That's what the CDC says in its latest results. We'll break it down for you ahead.
Welcome back. The CDC today says new studies show Pfizer and Moderna booster shots offer strong protection against Omicron and are highly effective at preventing hospitalizations. Still, more than 53% of eligible Americans haven't gotten those booster shots yet. With more on why this booster effort seems to be sputtering is Yahoo Finance reporter and editor Adriana Belmonte. Adriana, why do you think it is that people are just not running out to get those boosters?
So there's three main reasons for it when you dig down into the data. It seems like one of the primary reasons is the fact that the narrative keeps changing. Right now there's this idea that Omicron is mild, that it's the symptoms aren't as severe as previous variants, especially Delta. So people think that they don't need the booster right now; they can hold off. But what they don't realize is that these variants are just as severe for unvaccinated people, meaning that if those unvaccinated people catch the virus from somebody who isn't boosted, they're hit just as severe as any other variant. Another issue is that public guidance is constantly changing. There's data saying that you need a booster against Omicron. There's one saying that you should wait until there's one specifically tailored to Omicron. It's always changing. People are confused, and rightfully so. And then the other reason is that vaccines have become so politicized. Right now, it makes it seem like that if you get vaccinated, you support one party, one political candidate, and you have to stay unvaccinated if you want to be true to another party. So this polarization, especially amplified by social media, is just really exacerbating this issue.
Yeah, thanks for mapping that all out, because there's a lot at stake here for folks. And I think you're right. There's just, in general, a whole lot of confusion. I want to bring in Dr. Ben Weston now. He's Milwaukee County's Chief Health Policy Advisor and Associate Professor of Emergency Medicine at the Medical College of Wisconsin. Dr. Weston, thanks so much for being with us. And I want to start with what you're seeing there on the ground, because in a state, or rather a city like Wisconsin, where just under 59% are fully vaccinated, are boosters the priority for you right now?
Yeah, thank you for having me back. Well, vaccines and boosters are the priority, as well as all the other mitigation measures. Look, if you get vaccinated or boosted today, it's not going to help you tomorrow, but wearing a high quality mask is, and distancing is, and ventilation is. But this is really about the long run. COVID isn't going anywhere anytime soon. And so getting vaccinated, getting boosted remains critical. And this new data out of the CDC shows that more than ever, particularly over 50 years old. Those boosted in that age group are 44 times less likely to be hospitalized than unvaccinated. And the booster itself, just that booster addition, accounts for 17 times a decrease in hospitalization. And we see similar data in younger age groups too. So without a doubt, the booster is critical.
Doctor, I'm wondering, what is your biggest concern at this point in the pandemic? Is there anything that keeps you up at night? Is it, for example, the next variant that comes down the line? Is it a sense of complacency? We've seen in the UK, England is starting to relax their vaccine policies and mandates. No need to wear a mask indoors, for example. What keeps you up at night?
Well, you named all of them. I think one of the big things that is worrying right now is what's next. And we don't know what's next. But what we do know is that if we can't have vaccine equity, local vaccine equity, of course, but global vaccine equity, we're going to keep seeing variants. And this variant happened to be more mild. That doesn't mean that's what the trend is going to be moving forward. Alpha wasn't more mild than the variant before it. Delta wasn't more mild than the variant before it. And so there's no reason to think the next one will be either. And so we need to increase vaccinations on a global scale, especially to our low-income countries.
Doctor, I'm not sure you saw this story, but it made headlines in lots of newspapers. There's a folk singer from the Czech Republic who was not vaccinated, and she died earlier this week after deliberately catching COVID. She thought that it might be a better defense to catch it and have the antibodies than to actually get vaccinated. We saw news today coming out of the CDC that they're saying these boosters are effective in keeping people out of the hospital. But we also know that people who have recovered from COVID seem to have better protection, at least when it comes to the Delta variant in the short term. So make the case for people hearing that and thinking, is it just better to have natural antibodies? Should I not get vaccinated?
Yeah, it's a great question. So natural immunity has been challenging, and it's been challenging to understand exactly how good it is. Now, what we know and what seems to be the case is that natural immunity is not as durable as vaccine-induced immunity. Now, the other thing that we know, and probably is the most important, is natural immunity. And this folk singer, I saw the headline on that, is a good example of this. Natural immunity is not anywhere near as safe as vaccine-induced immunity. There's a lot of risk in getting COVID, even if you're young and healthy. Young and healthy people can get sick too, and they sure as heck can get long-term symptoms from COVID, not to mention spreading it to others in the community. We're all around vulnerable people every day, whether we know it or not. And so vaccine-induced immunity ends up being the safest and most effective way to get your immunity. And the vaccine and the booster are critical to that. No doubt natural immunity plays a role, but the vaccine and the booster are critical.
So, Doctor, you did say young people can get sick from the virus, and many are being hospitalized as well. So where do you stand on remote learning? It's been a hot topic button. Many people say kids need to be in school. Some say, maybe it's better to have waited while this Omicron surge did its thing, get it out of the way, and then start sending people back to in-person learning. Where do you stand on that?
Well, listen, I think you'd be hard-pressed to find a parent out there who doesn't want their kid to be in school, but they want their kid to be in school safely. And I think there are ways to do that, but I think it involves layers of protection. Layers of protection means vaccinating everybody possible. Most school-age kids now can get vaccinated. So getting kids vaccinated, getting teachers vaccinated. It also means masks. And really, we're talking about higher quality masks. Omicron is so transmissible that is a cloth mask better than nothing? Of course it is. But it's not nearly as good as a paper disposable mask. And that's not nearly as good as a KN95 or N95 mask. And you can find those easily now, relatively easily, for kids that are comfortable and easy to wear. So it means vaccines, it means masks, it means distancing, and it means ventilation. And if we can put all those together, I think we can have our kids in school safely, and that's the best place for them to be if they can do it safely.
All right, Dr. Ben Weston, thanks so much for being with us today. On the other side of the break, we speak with Airbnb's CEO about his promise to work remotely and live in an Airbnb property every 2 weeks. We're back after this.
Welcome back. Well, where in the world, or at least the country, is Airbnb CEO Brian Chesky? Well, he joins us right now, speaking with Yahoo Finance's Akiko Fujita, to discuss his plans to help the country staying at Airbnbs and to discuss the state of travel recovery on this side of the pandemic. Akiko?
All right, thanks for that, Karina. I want to bring in Brian right away. And Brian, we've talked a lot about this idea of decentralized living taking off during the pandemic, and you're kind of joining the ranks here to kick off the year. Joining us from Atlanta today, and where else in Airbnb, but talk me through what prompted this.
Well, I think what prompted this is that I think that we're living through probably the biggest change to travel since the advent of commercial flying, because the entire identity of travel is evolving. Because people, many people don't have to go back to an office 5 days a week, they're less tethered to living in one place. And so what this means is that for millions of people, not everyone, but a large chunk of people, they now have the opportunity to travel anywhere, and in some cases even live anywhere. And so we're seeing, families going away for the summer. We're seeing people taking long weekends, but we're also seeing some people just living in Airbnbs. And I figured if millions of people are joining this trend, I should too, and use the product myself and try to really figure out how I can help us continue to design a better experience. And also, it's pretty fun. I mean, I've always kind of wanted to do this, be able to go somewhere for a few weeks here, a few weeks there, and suddenly, if I don't have to myself be back in the office, I think I can show people with a laptop and Wi-Fi in someone's house, you can run a huge company, you can do a lot of things from Airbnbs.
Yeah, Brian, I want to get to the specifics on the platform, but first, talk me through your setup here. I mean, you're running a big company remotely. Every 2 weeks, you're shifting up your location. What's the setup and what's the plan? Where do you go from Atlanta?
The setup is I have a bag. Inside that bag's a laptop. I turn on the laptop. I join the Wi-Fi. I can run the company. That's all it takes. I mean, it's literally, there's nothing else that's involved. The only other setup I have is to do an interview like this. Other than doing interviews like this, all it needs is a laptop and Wi-Fi, and you can work from anywhere in Airbnb, and you can even run a company like Airbnb. I'm kind of taking it one city at a time. A week ago, I didn't even know I was living on Airbnb. I was in Atlanta visiting a friend, and I thought, I don't have to necessarily go back to San Francisco. Why don't I just book an Airbnb here? And I've always wanted to check out Atlanta, so here I am. And I'm gonna hop around to some different cities and communities and really just have this kind of fun little adventure.
You mentioned that part of this is trying to improve the design of the system. And you've talked a lot about the evolution of your customers during the pandemic. They're staying longer. They're staying in different markets. 1 out of every 5 gross nights booked in Q3 were for stays of 28 days or longer. What do you think has fundamentally shifted about the way customers are using your platform over the course of the pandemic?
Well, before the pandemic, primarily, Airbnb was a way for people to stay in a city. And, about half our business was cross-border. People were crossing borders or staying in urban areas. And the reason why we were primarily travel was because most people had to be back to an office. We still have all of the travel business. And I actually think when borders start to reopen, there's going to be so much pent-up demand for travel that I actually am incredibly bullish in travel. I think it's one of the things people miss most is the ability to travel. But now there's an entirely new category, which is really, you could call it living. It could be a week, a couple weeks, months, or even an entire season. And what we've seen that's changed is a newfound flexibility. People are traveling everywhere, all the time. They're staying longer, and they're not just traveling, they're living. You can travel anywhere, you can live anywhere to the extent that you have flexibility. And, millions of people now have newfound flexibility. We want to design for that world.
How does that change the opportunities you see for the company? I watched an interview you did earlier. You seemed to tease out new products that could be coming out on the market a little later this year. And it sounds like there's a bit of a shift in focus here. Yes, you still have travel, but you're also more focused on long-term lifestyle. I mean, is that the right way to look at the platform, this shift that's happening from just short-term stays?
It's not a shift, it's an expansion. So we are still doing travel. It's a huge opportunity for us, but there's now this entire new category of living on top of traveling. So I wouldn't call it a shift, I'd call it just an expansion. And it's really exciting. And to be super clear, I think this summer, presuming that obviously the pandemic, the situation improves and borders start to reopen, I actually think there's going to be an explosion of travel and a lot more flexibility for people to live. So I think it's an and, not an or.
So with that expansion, though, what are some other products you're looking at, opportunities that you see to be able to offer on the platform as customers continue to use these Airbnb stays in a more different way?
Well, I mean, nearly half of our business in Q3 by nights booked was for stays of a week or longer. I mean, that's still travel, but it's a different kind of travel where at that point, you really are immersing the community. You need to have great Wi-Fi. You need to have a lot of amenities. And so I think the stakes get a little higher. We have to raise our game on, customer service, the protections we're adding travelers. Because more people are flexible where they travel and live, our search tools need to continue to evolve to showcase all that Airbnb has to offer. We're seeing more and more people booking unique properties because the homes are becoming the destinations. People want to book tree houses and really interesting homes. And of course, the bread and butter of Airbnb is still there, and it's going to come back, which is people crossing borders, staying in urban areas all over the world. So it's just a really exciting time. All the opportunities that we used to have exist, but there's this whole new world open to us. And we're just focusing every day on making the experience as amazing as possible. And I would say there's going to be some pretty big offerings coming in the coming months.
You mentioned the different experiences that are on the platform. A treehouse is one you mentioned, but also you've kind of gone after some of these sites that a lot of our viewers are familiar with, the Home Alone house, the Carrie Bradshaw house from Sex and the City. What kind of bids have you gotten on that? And what does that tell you about how people are thinking about the experience of traveling?
Well, I mean, yeah, we have the Home Alone house. Could you imagine you can actually stay in that house and it's really a cool experience? And I think we had like hundreds of thousands of people apply to stay at that house, if I'm not mistaken. I haven't checked the latest stats, but what it tells me is it's tapping into something that people want to have an experience. They don't want to just stay in their home and just, they want to get out of the house. They want to have an experience. A lot of people feel isolated and they want to spend meaningful time with other people. And so that's what this tells me. I think there's a lot of pent up demand for travel. I think people want to explore and live in different places. And they also want to have meaningful time with friends and family, and travel is a great way to do that. So I think that people want to dream. They want to get out in the world. And I think we can allow them to do that.
All right, Brian, stick around for a little longer. Coming up, we're going to be talking a little bit more about how you're thinking about the workplace as we talk about the shift that's happening. Much more with Airbnb CEO Brian Chesky coming up on the other side of the break. We'll be right back. Welcome back to Yahoo Finance Live. We are back with Airbnb CEO Brian Chesky joining us from his Airbnb in Atlanta. And Brian, before the break, we were talking about how you've seen the way in which people use Airbnb spaces change because they have a little more flexibility. They're able to work remotely. How's that shifted your thinking about how you think about your workplace?
I mean, I think it's pretty remarkable. If you had told me 2 years ago that I could run Airbnb from someone else's house, all I need is my laptop and their Wi-Fi, it would have been pretty far-fetched, but that's the world we're in. And I don't think we're not going back to the office 5 days a week. And I don't know very many companies that will. We're still designing our future workplace, but I can confirm that it's going to have a lot of flexibility in it. I think that's where the world's going. The Airbnb is benefiting from that, and we should walk the walk. And so that's absolutely where we're looking at. And I think it's really exciting.
Yeah, I mean, on that front, you've implemented a permanent flexible policy that allows employees to work remotely. Has that kind of expanded your pool of employees? I mean, we've heard a lot of tech companies, especially who opted for that early on, say, they're now able to tap into talent, not just in the Valley, but outside of the state of California. How has that expanded the pool for you?
I mean, it massively opens the pool. Now, the one thing I want to be clear about is that we're still sorting out the details of the long-term policy, and people want to know, obviously, where will I live in 1, 2, 3 years? But that being said, I think this is a really, really important trend for the world, because I think it provides economic opportunity, because not everyone could move to San Francisco, and so where our headquarters is. And so I think this is just you kind of democratized a lot of opportunities around the country for a lot of jobs. So I think it's a very exciting opportunity for us.
Something we've heard from so many companies is about this growing competition for talent, which is, of course, something that we've seen in the Bay Area for some time. Have you started to notice that as well in terms of, as a company having to offer additional incentives, employers having a little more say and a little more leverage in choosing which jobs? What have you seen firsthand?
Well, I think a year ago, I think last year, I think I went on record saying something that I think at the time might have, I don't know if it was controversial, but I said employers aren't going to dictate the workplace policies, employees will. And so any CEO that thought they were going to haul all their employees back to the office 5 days a week, I said, that's their prerogative. But ultimately, we're in the business of getting the very best talent. And so you got to be competitive in the market. And I think after compensation, workplace flexibility would be the most important benefit. And so I think employees, not employers, by and large, are going to dictate it. Or said differently, the market is going to dictate how we all work and how we all live. And I think clearly the people are speaking, and what they're saying is that they want flexibility, and the vast majority of people don't want to go to the office 5 days a week. But they're also, I think, saying that, we don't want to all consent to recreating the movie WALL-E, where we're staring at screens and we never have human connection in the real world. And so that's what I think the key to design is. I think the future is flexibility. We want to provide opportunity all over the country and all over the world. Obviously, remote work is extremely efficient, but people need human connection. And if we don't provide human connection as employers, if our product isn't bringing people in the real world, then I think we're going to be living in a fairly lonely period. So there's a balance, and I think you have to get it right. But I think the days of people going back to the office 5 days a week are over. I even think the model that people were talking about, remote, a hybrid of 3 days a week, is also, I think that was a little overly ambitious. And I think that what everyone's realizing is more flexibility is where the world's going.
Let's talk about that global footprint that you have. As you were alluding to before the break, you said you think there's going to be a big tailwind once borders open up in a big way. Yeah. Outside of North America, what do you see as the biggest international opportunity?
It's hard to say what the biggest one. I mean, we're just to give you a point of reference, we're in 220 countries and regions. I think we're in nearly every country in the world, but North Korea, Iran, South Sudan, Crimea, and a few others. So we're very international. I mean, Europe is going to be a boom, but Latin America has been growing, obviously Asia Pacific, Africa. So it's hard to, I think the thing about travel is it's universal. It's not a regional thing. It's not a trend. Every person has, I think, inherent into them a desire to see the world, to travel, to go to communities. This is not a regional trend. This is a global thing. And so I think the opportunity is going to be spread all over the world. And the thing I've learned, having been in 100,000 cities and communities all over the world, is I am shocked not how different we are, but how similar we all are. Most people are 99% the same. And we like to talk about the 1% that makes us all different. But, having over 1 billion guest arrivals on our platform in communities all over the world, I can say that, the world's more similar than it is different. And so frankly, the opportunities are pretty similar in geographies all over the world.
You mentioned Asia as an opportunity. Obviously, China in focus with the Beijing Olympics coming up in the next few weeks. Airbnb is a sponsor here, and your company, along with other sponsors like Intel and Coca-Cola, have received a lot of criticism for not necessarily speaking out on especially human rights issues that are happening in China. I realize this isn't a sponsorship that's just for the Beijing Olympics. It's multi-year. Talk me through the risk-benefit calculation the company sees in sponsoring the Olympics, especially one that is more controversial like Beijing.
Yeah, I think it's very important that that I'm explicit about what our sponsorship is. We have a 9-year sponsorship with the Olympics. We're not sponsoring specific games. Our sponsorship was designed around athletes. And the reason we decided to do a sponsorship of the Olympics was when I heard a stat that said that the average Olympic athlete was living at or below median income, and many of them live at the poverty level. I think a lot of people don't realize that a lot of athletes are not sponsored. We tend to focus on the ones that have big sponsorships. A lot of athletes have to pay their way. And we found out that a lot of athletes were staying in Airbnbs to defer their cost. They were training out of Airbnbs, or they're even hosting. And so we thought this is a great way to really, kind of help these athletes with economic empowerment. And the idea of the Olympics was countries coming together. That's really like Airbnb. On New Year's Eve, we had 4.5 million people staying in Airbnb from, I think, 200 countries all over the world. So we're here to support athletes over 9 years throughout games all over the world. And we're not just supporting the games, we're supporting the Paralympics and the athletes in between the games. So this is really, really about supporting athletes.
Brian Chesky, good to talk to you today. Really appreciate you taking the time with us. Airbnb CEO Brian Chesky joining us. Alexis and Karina, I'll toss it back to you.
Thanks a lot, Akiko, Brian Chesky. Great conversation there, guys. Thanks so much. Straight ahead, Senator Mark Kelly of Arizona. He's going to weigh in on whether lawmakers should be allowed to trade stocks. Don't go away.
Welcome back. Senator Mark Kelly from Arizona recently sat down with Yahoo Finance to discuss the challenges Americans are facing tied to rising costs, supply chain issues, and how to prevent corporate price gouging. Take a listen.
I mean, these rising costs are really hurting Arizona families and families across the country. But it's not just here in the United States. I mean, we've seen European countries, experience similar issues when supply chains get disrupted, like they have over the last couple of years. I mean, that contributes to shortages. And as we know, that's going to result in rising prices.
You've pressed the administration specifically to take steps to lower the cost of food. And you've spoken specifically about what you've described as corporate price gouging that's happening. Is that what you think is happening here?
For some issues, yeah, absolutely. Just this week, the Secretary of Agriculture, Secretary Vilsack, came out to Arizona a couple of days ago. I was with him, meeting with some ranchers in Glendale, Arizona, but the ranchers came from all over the state. Ranchers are getting the same amount for their beef that they did, before the pandemic, but the prices have gone up. So what is causing that? They're not getting more for their product, though consumers are now paying, in Arizona anyway, about $5 a pound for ground beef. So something is happening in where the product goes from the ranch to the market. So I have the administration looking into this. I mean, is it the processors? What is causing prices to go up? And food is becoming, it's really challenging for many Arizona families to buy groceries right now, and it has to be dealt with.
What are you hearing from those constituents, the ranchers that you just alluded to? How much have they seen costs go up, and what's the reality for their businesses?
Yeah, I mean, the price of corn and alfalfa, the price of diesel fuel, so their expenses have gone up, but their revenue is flat. They should be, benefiting, from some of the price increases. I mean, we don't want the prices to go up. We want Arizona families and families across the country to be able to afford groceries. This has been really challenging. But there's something specific to this, and I think this is going on in other industries where you have big corporations that are taking certain steps to increase their profits on the backs of the American people.
So let's talk about the steps that you have proposed to try and bring things down. You talked about bringing down the cost of food, but also addressing the snags that we're seeing in the supply chain, specifically in the labor shortage in the trucking industry. You've called for the need to expand the pool of prospective drivers, but how do you actually do that? I mean, this is something that we saw even before the pandemic. And some would argue there's a bit of a generational shift that's happening. Not enough people wanting to get into this industry anymore.
Yeah, it's true. It's, these are good paying jobs, but they also require that you leave your family for, in some cases, good periods of time. It's challenging work. And right now, I mean, we've got a shortage of employees across the country. The workforce, we had over, I think about 1.5 million additional Americans retire than expected during the pandemic. That's a lot of people that just disappeared out of our workforce. There are certainly some things you can do. You can provide training opportunities that are more readily available to young people. You can reduce the age for folks to get jobs where they're driving on interstate highways from state to state. Right now, that age is 21. We are looking into reducing that to 18. You got to make sure you have the right people. You got to make sure you train them well, and they're going to, do the job in a responsible way. But there are steps we can take to alleviate that supply chain issue. We also have supply chain issues that are showing up at our ports of entry, whether they're the ports of, the land ports of entry like we have in Arizona on the Arizona-Mexico border, or the ports of entry along the coast, like, California with, shipping, backed up, called on the administration to take some steps there. They're building or opening some temporary locations for ships to come in and unload their cargo. On the land port of entry issue, in the bipartisan infrastructure bill, which I was one of the one of the folks that negotiated and worked across the aisle to get this done. We've got significant funding to upgrade those ports of entry. That'll help us bring more products, not only from Mexico, but to Mexico in a much more efficient way. So that's going to alleviate, in the long term, alleviate some supply chain issues that we've been facing.
Okay, that was a conversation with Senator Mark Kelly of Arizona. We're going to take a quick break, but much more ahead, including another check of the market on this Risk Off Friday. Stay with us.
Welcome back to Yahoo Finance Live, everyone. Well, it looks like we're going to end the week on Wall Street the way we started it, and that's with another sell-off in a volatile session. Again, stocks lower across the board. We're off our worst levels of the day, but that's not saying much. The Dow is down 162, the S&P down 39, and again, technology is leading the way south for stocks. The Nasdaq falling deeper into correction territory, now off more than 13% from its recent record high. A loss there today of 186 points, led lower by Netflix after those disappointing subscriber growth numbers. Let's dig a little deeper into the Dow and take a look at some of the winners and losers there. We have got in the green, we've got shares of Nike, Intel, McDonald's, and Procter & Gamble all higher. But we are seeing that offset by Walt Disney, Boeing, Visa, and Cisco. All of those stocks are lower and dragging the Dow Jones Industrial Average lower. And speaking of lower, the crash, and we're calling it a crash here in the cryptocurrency markets, Bitcoin down another 10% today at around $38,000. We've got much more Yahoo Finance Live to come after this short break.
Fitness trends across the country are facing course corrections as Americans begin to turn away from at-home and virtual exercise, seeking out physical locations. Companies like Peloton are feeling the burn, but it's welcome news for gym owners. An industry expert weighs in. The sneaker industry is having a great run. The global market was valued at about $78 million in 2021 and is estimated to top $100 million by 2025, according to Statista. We ask an expert about the pace of growth in the face of supply woes and the new trends. Plus, existing home sales dropped more than 4.5% in December amid record low inventory. There are many reasons why, including many millennials having to choose between a down payment on a home and paying off student debt. We'll get into it. Welcome back, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christoforous, on this Risk Off Friday. And we want to get into what's driving the markets. Let's bring in our Yahoo Finance's Jared Flickery. Jared, want to start with Netflix. No relief for them after those disappointing subscriber numbers, and no real explanation why either.
No, it's a little bit of a black box situation here. And let's take a look at the Wi-Fi Interactive, because it's not just Netflix. A number of other names in this space are just down in sympathy. Fubo TV off over 8%, Roku off more than 6%, Viacom also down 6%. And so is Disney. So a lot of concerns about the entertainment space, because as we know, during the initial lockdown period, these were stocks that were high flyers. And here's a 2-year chart of Netflix. And you can see after some initial enthusiasm in 2020, basically went sideways for about a year. And then it broke to the upside tantalizingly. And then it consolidated, broke right back down into its old support. And now has violated. So this is a current price. Pretty drastic price action here. This is going to be a broken stock for some time. And I just want to get some analyst commentary here. And I do have Benchmark saying they're upgrading it to a hold from sell. They're removing their $470 price target, but sees $450 as fair value for the stock. The scale of the sell-off, they're saying, seems overlooked. Well, Benchmark is the only one upgrading the company right now. Credit Suisse on the miss on the current, the miss on the current quarter subscribers. They're saying they're downgrading it to neutral from outperformed, lowering the price target to $450 from $750. And they're saying there is still large opportunity in global streaming. Netflix should retain its leadership position, but growth expectations are being reset lower. And here's Macquarie as well. They're downgrading it to neutral from underperform, moving the price target down to $395 from $615. Quite a big slash right there, saying the subscriber outlook is disappointing and contributes to, quote, a more uncertain outlook. So not the best news for Netflix. I guess investors, maybe the subscribers, though, will get some new shows. I think we got some new news from the CEO, Reed Hastings, and also co-founder, that they are going to be picking up a lot of their programming schedule in March. But until then, the waters look very murky. And I think that's kind of spooking investors here. 20% for this stock to the downside is an extreme move. And I think investors just kind of spooked here.
Yeah, extreme's the word. Another extreme movement today was in Peloton. Yesterday, the stock hit, I think, a 2-year low. Today, it's bouncing back a bit. You know, Peloton CEO trying to walk back the idea that they're going to halt, at least temporarily, their bikes and treadmills as people's workout behavior starts to change.
Yeah, and this is a company that probably got overdone in the beginning of the pandemic as well. And let's just take a look at what this stock has done. This is a max chart going back to its IPO in late 2019. And here's that huge run up when there was a lot of enthusiasm about the stock. But guess what? We have this head and shoulders top. And the neckline wasn't precisely broken at this, I guess, when you would expect it to. It looked like there was going to be a breakdown here, went back up one more time, and then we got the breakdown, and it's been down ever since. I do have some analyst commentary on Peloton as well. Let me just get to it. And this is going to be Benchmark. They're upgrading it. So this is a rare upgrade to hold from sell, removing the $470 price target. But they're saying, excuse me, this is the notes from the previous ticker, so I'm not going to talk about Netflix anymore. I want to talk about Stifel. They're saying the stock has overcorrected relative to underlying business conditions. They're upgrading it to a buy from hold price target to $40 from $56, but that is the only upgrade that I saw for Peloton. Truist is saying Peloton's pre-announced results are mixed. They did pre-announce their revenue figures last night, a slight disappointment, but Truist is saying there was no management commentary on demand trends so far in the third quarter of 22 or the outlook for the second half of this year, which are key. They're recommending that investors remain on the sidelines until there is better visibility into Peloton's evolving strategy in light of lower than anticipated demand. And they're maintaining the hold, but a price target of $68. And just looking at the stock again, I want to drill this down to a 2-month chart. Here's that big sell-off that we saw yesterday on the news that they were going to halt production, a number of their fitness lines. But this is a chart that is kind of a falling knife. So I think these words from Truist here ring true. Don't want to catch that falling knife just yet.
And Jared, investors not finding any relief in crypto either today. Bitcoin taking a bath well below the 40,000 threshold, down about 30,000 from its November peak.
Yeah, it's getting ugly in crypto land right here. And I'm going to go to a longer term view of Bitcoin. This is a 1-year chart. Now, when we got these new highs up here, this was October, November of last year, got to about $64,000, $65,000. That was an incredible momentum breakout, but then it stalled. And the fact that we didn't get to 75, 100,000 based on all the momentum leading up to that point, I think was a red flag. And now we are breaking 40,000 support. This is a level that's been in play for over a year now. And what's below? Well, we got to start looking back at 28 to 30,000. That was these old lows in here that we finally got the launch price of. But I'm going to say something a little bit even more bearish here. We could see 13,000. We could see these levels from somewhere in here. Don't quote me, but about 13,000 is the real long-term support levels. So hope it doesn't go that low, but if it does, hey, buying opportunity, right?
All right, buying opportunity. You said it. All right, Jared Lickery, thank you so much. We'll see you back here in a bit with the oil close, but we will keep it on markets right now. Bring in Michelle Schneider from MarketGauge.com, partner and director of trading, research, and education. Michelle, thanks for stopping by today. Just want to get your reaction to some breaking news that we just got. A federal judge just blocked Biden's vaccine mandate for federal workers. Omicron has thrown such a wrench into returning back to normal, and I'm wondering, do you think this further hurts productivity?
Well, very possibly it can. Of course, it brings up other issues just in terms of what you can force people to do, and there's all kinds of opinions about that. But I think if we step back and look at the bigger picture of what that means, it's another stab at credibility, which has been in question on so many levels this year as we were coming into this year. The credibility of the administration, the credibility of the Federal Reserve, the credibility of the scientists when it comes to Omicron, the credibility of analysts. And so this is just another way that people now don't really know what to sink their teeth into. Is this a blow further to the labor market and the economy? Or is this just another aspect of where we're at right now, which is in such disparity in terms of, how we are as a country?
Michelle, I want to switch gears a moment and get your take on what's happening in the cryptocurrency markets. You just heard Jared say that even though Bitcoin's at about $38,000 right now, he says it's more fairly valued at $13,000. Do you think that it's just going to continue to fall out of favor with investors who were using it as a hedge? But you know what? The jig may be up if the Federal Reserve decides to hand us multiple interest rate hikes this year.
Okay, well, there's a few parts to that question. First, let me say, in terms of Jared's point, even though he said, don't quote me on the 13,000, he's probably right. I've been looking at the 2021 levels that came down at 28 to 38,000, and that really has to hold, or we could see much lower. Do I think longer term cryptocurrency as a place to be is good? Yeah. What's interesting, though, is people were expecting this decoupling where the market would go down, the stock market and the cryptocurrency market would go up. We haven't seen that. I also do believe, though, that the whole technology in terms of blockchain technology is still in diapers. I mean, we're going to really be seeing a lot more development as we go on in blockchain. And then finally, in terms of the Federal Reserve, I don't know how much interest rate hiking they're going to do because they're in a real pickle right here. And we've talked about this. This is typical stagflation type environment what we have going on, and crypto is not the answer. Interestingly enough, gold is starting to look like it's outperforming. So in stagflation, the Fed has to decide, do I stagnate the economy further at the risk of higher inflation? Or do I, become little, I wouldn't say more accommodative, but not so hawkish, and wait for this market, starting with your question about Omicron and the vaccine, to come back to some level of strength, because we're limping right here, and then become more hawkish. I would not want to be in the Federal Reserve.
How closely do you think they're watching this data? Because so much has changed from their last policy meeting. We've seen, markets in turmoil. We've seen housing numbers that were pretty bleak. We've seen job losses accelerating. How much do they watch? And then how much action can they actually take?
Well, that's the point. And the dot plot is what they're looking at. So we have another FOMC meeting coming up. It'll be interesting what they have to say. But Powell's kind of dropped these hints about how he's going to continue to focus on the labor market and some of these economic statistics. And they do have egg on their face in terms of inflation. But I actually really believe that they believe that inflation isn't going to be as bad as they think, and that somehow it'll fizzle out. And in fact, if you look at something like the Baltic Dry Index, it kind of peaked and fell off. Many people look at that as an indication that somehow inflation has peaked, but I don't see that. So they've really backed themselves into a corner. And again, as we go into that credibility conversation, the Fed may be at the top of that list.
And just want to get your thoughts quick on Netflix, one of our most actively traded stocks today, trending on the Yahoo Finance site, taking a real drubbing here after those disappointing subscriber growth numbers. What's the long-term game, though, here for Netflix? Are you still seeing upside potential for investors, and is now really a good entry point?
Well, I certainly wouldn't be entering right now after we've had this kind of bloodbath in the stock. I mean, you can look at the 200-week moving average, which when I looked at earlier, I'm not sure exactly because I haven't looked at it in a couple hours, but it was around this 400 level. And if we can get some kind of consolidation around there where we have an interesting risk point, then perhaps, I mean, Netflix is still Netflix. It still has a tremendous amount of content. I know they're raising their prices, but it also has a lot of competition. But it's also the story of what we're seeing of these stocks that just got so overvaluated that they have to come down. What to me is going to be really interesting is what happens with Apple earnings, because even though Nasdaq is challenging its 50-week and in correction territory, Apple is $20 away from its 50-week, which is at around 143. So rather than really focus more on the Netflix scenario, on what that means for the market, I'm going to be looking at Apple. And of course, just look at ARK. We've talked about this being the harbinger of things to come in tech, and certainly that continues to go south.
All right. And I know you like some elements in the commodities space as well. We will have to leave it there. Michelle Schneider, MarketGauge.com. Partner and Director of Trading, Research, and Education. Thanks so much for your insight today. We're going to take a quick break, but is Peloton's current downfall a sign of fitness buffs shifting gears, preferring to head into gyms to work out rather than relying on at-home fitness? Stay with us.
This stay-at-home workout seems to be losing a little bit of its luster. Just ask Peloton, which is now considering laying off workers and producing fewer bikes and treadmills. Here to talk about the shift to in-person workouts is Chuck Runyon, CEO of Self-Esteem Brands, which owns Anytime Fitness Gyms. Chuck, good to see you. And I know that Anytime was one of the first 24-hour gyms, hence the name. You've got about 5,000 gyms with about 4 million members. So I'm curious if there's anywhere in the world where your gyms are now back at pre-pandemic attendance.
Yes, we have numerous regions around the world that are back to not only pre-COVID, but above pre-COVID attendance. And our consumers are purchasing more in-home and in-club coaching services. So people are coming back to the gyms. You know, I've been in this industry a long time, and members want variety. They need guidance. And sometimes you really want that from a human coach inside your club, but we still provide some in-home coaching as well. So it's not an either or, it's a both.
And sir, I want to ask you, how do you think government policy is helping or hurting a return to in-person gym workouts? Because obviously gyms were the hardest hit.
Yeah, look, our industry was the first to close and the last to reopen, and this industry has suffered. And, you know, and we are working with lawmakers around the world to provide relief for this industry. And we have created a very safe environment. We play by all the rules. And so I think our industry's done a great job doing that. But I think, you know, there needs to be a discussion about the long-term vaccine of better health and fitness. We've seen how this virus has affected people with underlying health conditions. So when COVID's gone, we really need to have a meaningful discussion about global health and about what we can do to incentivize physical activity and better nutrition, because ultimately that is the best long-term vaccine.
Chuck, I know that you were in Washington, D.C. last month. You were appealing to lawmakers there to pass what's called the GYMS Act, which would provide the first, I guess, federal pandemic relief to club owners. Can you tell us where that legislation stands right now?
Yeah, we're still working closely with lawmakers around the country. Like 70% of the gym and studio industry is operated by small business owners. And as you know, this has been a very difficult climate. And they have provided direct relief for other industries. And again, as I mentioned, we were the first to close and last reopen. And so our industry also needs some relief. So we're working with lawmakers, making sure we can support small business owners who own gyms and studios and communities around the country, and provide those essential services that, again, people need, not just now, but long-term for mental and physical well-being.
And Chuck, then how are you positioning yourself as people start to come back to the gym? I know you've launched a new platform, Real AF. Tell us about that.
Yes, we are excited to support our members wherever they are. So at home, at work, in the gym, we can literally now have a coach in their pocket. So we want to provide them personalized guidance and a plan that really meets them where their lifestyle is at. So like we encourage, of course, to visit the club as often as they can. But if they can't, we're going to provide the support and the tools and the motivation so they can live a healthier life. We just recently purchased Stronger You, a digital nutrition company. So now we can give a more holistic support to our members. And that's what we obsess about. I mean, we lie awake sleeping or lie awake at night thinking about how can we get our members healthier? And this can help us do it now and meet them on their terms.
And Chuck, I have a two-parter for you. I'm curious if you've had to raise membership prices at all during this challenging time. And then also, because you are 24 hours, are you seeing more people interested in going in those overnight hours when the club would be less populated?
Yes, and Anytime Fitness had an advantage because we have smaller clubs and because we're open 24/7, we've been able to create an environment that is safer. So, you know, as we've come out of COVID, we've been more resilient than most other fitness brands in this sector. And yeah, your first question is, we have seen, it depends really on the area of the world that you're in. But for the most part, we have reasons that, you know, to be quite bullish on, you know, where the fitness sector is going.
All right, Chuck Runyon, CEO of Anytime Fitness, thanks so much for being with us today. And coming up, we're going to talk about one of the biggest hurdles standing in the way of millennials becoming homeowners. That's student debt. We're back right after this.
Welcome back. Well, rising home prices and housing inventory issues has made for a highly competitive housing market. But one main factor that millennials are shying away from home ownership is student debt. Here to break it down is Jessica Lautz, National Association of Realtors Vice President of Demographics and Behavioral Insights. Jessica, thanks so much for joining us today. So how much more are millennials spending now on housing and education as well compared to previous generations of the same age?
Yeah, so that's really the problem that we see when we look at budgets of those who are under the age of 25. So they're thinking about saving for a down payment for a home, but right now with rising rents and also looking at their down payment and just what they need to pull together with rising home prices, it's being very difficult for them to do it and pay for their student loan debt at the end of the month as well.
What about some of the pandemic relief we've been seeing regarding student loans? Has that helped open up or free up any liquidity for these millennials as they search for their first home?
Yes, for 38% of student loan debt holders, we know that the pandemic, it did get them closer to paying down their student loan debt. So that's been a very big help because not only did they take advantage of these pandemic relief programs, they were able to move to more affordable areas. They were able to move in with their parents and they cut spending on restaurants and entertainment like the rest of us did as well.
Do you see the housing market, seeing any meaningful growth this year? Because inventory is at an all-time low. Prices continue to be astronomical. So many are priced out of it.
Yeah, it is really difficult. And right now we are expecting that people will be interested in entering the housing market, but it's very difficult when they see these double-digit growth in prices, but then also the extremely limited inventory, the lowest amount of inventory that we actually have reported back to 1999 when we first started collecting that data. So it's very hard for a home buyer to find a home when there's none for sale right now.
We know that buying a home is still sort of the number one way to build wealth. But what are millennials to do if they're strapped with all of this debt? What are some ways that they can sort of see their way clear to maybe save a little bit more at the end of each month so that they'll have that down payment and eventually be able to afford the home?
Yeah, and I will say for the typical millennial that's out there, they're thinking this is an 8-year timeline for them to really be able to pay down their student loan debt and save for a home. So thinking about this long term, thinking about cutting spending where you can, saving where you can, maybe that's the tax return or a gift from loved ones that you can chalk into savings right now and really be able to save for that down payment. And maybe that's farther off, but putting that away today can be a big boom for the future.
And I'm speaking more broadly now. What impact do you think rising rates will have on home prices? Because it hasn't stopped people from buying homes, even though mortgage rates have been rising already.
Yeah, I think there's a race right now to lock in those rates and know exactly what your payment is going to be for the next 30 years. But I think when we look towards looking at 2022 and rates rising even more, it's going to cut out folks who are really stretching, who are saving and trying to enter homeownership, but that might count out some buyers who are stretching into homeownership right now.
In addition to these student loan, all of this debt surrounding student loans, you also have millennials dealing with sky-high rent prices. We actually talked about that on yesterday's show, how, so many people have been basically priced out of the home buying market. They've run to the rental markets, and that's had prices there spike up. So it's hard to really catch a break. What is the best course of action for a young person if they know they ultimately want to become a homeowner? How do they deal with living expenses in the here and now?
It is very hard to juggle both rising rents and think about saving for a down payment. What we have found for successful home buyers, the number one thing that delays them is student loan debt. Right after that is rising rents. For those who entered homeownership in the last year, we've seen an elevated share. They moved in with mom and dad in the last year. They were able to live with family because they could skip that rental payment and save for that down payment. That's not available to a lot of adults out there, but for some, that did become an opportunity.
So what advice do you have, let's say, for millennials who maybe have some flexibility as far as how they work, where they work, they can work remotely? Are there certain regional areas where they can look to find some sort of deal or some ability to get a foot in the door, so to speak?
Yeah, absolutely. And that's a good thing that has happened with the pandemic. And CEOs now are saying, I want to retain good talent. And to do so, you have to have either a hybrid workforce or a fully remote workforce. And so that's allowed a lot of employees to look at suburban areas, small towns. We actually know that right now for successful first-time homebuyers and millennials, there's more of them purchasing in small towns than actually in urban areas. So this has definitely been an opportunity for homebuyers today.
When you compare millennials to past generations and how they were able to attain first-time home ownership, how does it compare? I mean, was it any easier for Gen Xers and for baby boomers? I'm sure each generation thinks that theirs had to carry the highest burden.
Yeah, I think there's definitely a little bit of generational warfare happening right now when we talk about finances in the housing market. But as far as looking at this data historically, what we know is that for those who are under the age of 35, as census is reporting it, we're looking at a generation currently that has lower homeownership rates compared to looking back all the way to 1982 in the data. And so they are definitely encountering hurdles more so than past generations. And it really is because a disproportionate amount of student loan debt, but then also those rising rents as well.
All right, and important to remember that millennial home ownership is still on the rise. Okay, we will leave it there. Michelle Schneider, Market Gauge. Jessica Lautz, National Association of Realtors, Vice President of Demographics and Behavioral Insights. Thank you so much for stopping by. And we have much more after a quick break, a check of the energy sector and where crude settled.
Welcome back, everybody, to Yahoo Finance Live. Want to get a check of the oil markets now and check in with Jared Blickery. So, Jared, I see that crude easing a little bit today, but that hardly tells the story for the week because crude going to end higher overall.
That's right. And in a week where we're counting down the hours to the end of the day and the carnage to the Nasdaq, guess what? Crude oil going to post some decent gains, about 2% for the week. And you can see on our commodities heat map here, a lot of red on your screen. So let me get up crude oil down about 0.5% here. And let's just check out the intraday price action. The official settle, by the way, was $85.14. So you can see kind of a choppy to sideways action right here. But let's take a look at what's happened since the open on Sunday. And we can see they're up about 1.5%, excluding that opening print. Looks like we're down 0.4%. But overall, we are finishing the week up for crude. And let's take a look at the energy sector. Also seeing some red in this sector today. We have seen energy as a stalwart of the year so far. You take a look at what's happened year to date. We still got Exxon up 18%, ConocoPhillips up 15%, but not looking so good for the other sectors. Here's our sector action. You can see indeed energy is the only one that's still in the green for the year, up 13%, Alexis.
All right, thanks a lot, Jared. Want to stick with oil? Bring in Regina Mayer, KPMG's global head of energy. Regina, happy Friday to you. It's been a long week. I want to talk to you for a moment about the psyche of oil traders, because it seems if you look at the price action that they've been discounting COVID. You know, there was concern that Omicron would pull back the economic rebound and that perhaps we might see a drop off in oil demand. Do you think oil traders are thinking differently about that now?
No, I don't think so. I think the market's largely shrugged off the fears around Omicron. And so what remains with the oil markets is it's all about supply. So the expectation is that demand is going to continue to surge. It'll hit pre-pandemic levels in 2022, according to most of the estimates. And we're dealing with a supply constrained environment where OPEC Plus is demonstrating restraint, but also they're at the limits of their capacity. So we don't have a global safety valve. So that's where the traders are looking, and that's why oil remains buoyant. And there are those that are calling for triple digits before things settle back down.
And Regina, how high do you see crude going? And then when do you start to see constraints start to sort of ease up a little bit?
So the bulls are definitely calling for 100 plus the dollar oil before the end of the year. I'm not that bullish in terms of the overall price. We're at a point where marginal production is absolutely being spurred. And the key statistic that I've noticed is the Permian production in February is slated to exceed all-time production, so 5 million barrels per day. Canadian rig counts went up 50 rigs just in 1 week alone. So I think we're going to see renewed production from the US, Canada, and Brazil. And obviously, if OPEC Plus and Russia can produce more, they absolutely will produce more. So I think that's a governor on the triple digit prices. But at the same time, there's still upward pressure, right? Inflationary costs, so it's going to cost us more to get the oil. There's the cost of capital challenge that will be facing us. So there are more upward pressures than downward pressures. But I don't necessarily seeing it going to triple digits this year.
What about, though, if the geopolitical situation changes? I'm wondering how closely a possible conflict between Russia and Ukraine is playing into things right now. And if there really were some sort of an issue there and Russia were to actually take action against Ukraine, what could happen to oil? I mean, could we then see $100 crude?
Absolutely, Alexis. And you hit the nail on the head. I mean, that's where a lot of the upward pressure comes from, is there are quite a few geopolitical hotspots that we're all watching. And we're just one, blip away from a conflict that could actually drive the price up even further because we're in such a tight supply market right now. While the market, we lost a little bit of ground on WTI was because there was an unexpected increase in US crude inventories, but US crude inventories overall are still 8% below the 5-year average. And that indicates considerable restraint. And if you do see a conflict with Russia or a conflict in other parts of the world around oil producing nations, you absolutely will see the supply constraint lead to a spike due to the geopolitical situation.
President Biden is in a pretty tough situation, right? Because he can't just call up OPEC and say, can you open up the spigot some more? We saw when he released from the strategic reserves, that did very little to help sort of drop gas prices just before the holidays. What more can be done? Can anything be done?
Well, I think, and actually the industry's been working closely with the current administration and looking for policy incentives to enable more activity. So the administration's been focusing on increasing permitting, right? So while there was a moratorium on drilling and development on federal lands, that has been lifted. And I know that Secretary Granholm has been meeting with members of the industry to talk about other things that the administration can do to unlock more of the reserves that we have within the United States alone. But we're also, the Permian and Midland Odessa, we're seeing activity from the ground. There's quite a lot of people movement, prices are increasing, jobs are booming, and you're starting to see more of that activity in the US. So I think making it easy to do business in the US for the energy industry and improving some of the incentives around carbon capture so that we can continue to achieve our objectives around greening the hydrocarbon footprint. All of those things are proactive things the administration can do. And I do know that some of those conversations are underway, which is really encouraging.
Want to touch on gas prices, though, which affects just about all of us. Do you see gas prices moving much higher? We just saw a graphic a moment ago showing the national average at around $3.32. Some are saying we could see well over $4 a gallon by springtime and into summer as more people hit the roads. What's your thinking there?
Well, we've definitely seen some relief because the weather limits. This isn't necessarily summer driving season. And refinery utilization can definitely go up. This week, it was at only 88%, and the country has the capacity to go to 95 or 96%. So I think that, and also I will say, Alexis, gasoline stocks are building in the US, which is definitely a plus for the consumer. I think we can see some pain relief, but if the price of crude continues to go up, if it gets to $100 per barrel, that will definitely put more pressure at the pump. But during the winter season, I'm optimistic because stocks are building, refinery utilization runs are increasing, and we're not using as much of the stocks, because of the weather and the movement. So fingers crossed, things will settle down a little bit more for us as consumers and our pocketbooks.
Yeah, fingers and toes crossed on that one. Regina Mayer, KPMG's Global Head of Energy. Have a great weekend. Coming up next, a look inside the white-hot sneaker resale industry with the CEO of the GOAT Group.
Welcome back. Well, the sneaker industry was on shaky ground last year, dealing with release dates in constant flux to brands suffering from shutdowns in factories across Asia. But despite those slowdowns, the race is on as sneaker sales are expected to accelerate in the coming years. Here with more and to talk about that and trends in the industry is Eddie Liu, GOAT Group's co-founder and CEO, along with Yahoo Finance's Danny Romero. Thanks so much to you both for being here. Eddie, I want to start with you. So you have multiple locations, many across the globe, something like 13. What has the last year been like for you as far as sales and being able to navigate all of the supply chain issues that have come up? Because sneaker brands were hit hard.
Hey, great to be here. Thanks for having me. And the great thing about GOAT is that we don't just have one seller where we depend on supply. We have over 700,000 sellers around the world that have supply on hand. So you're always going to find what you want on GOAT. And it's not just this year's styles that are impacted by some of the supply chain issues. We have styles from this year plus past catalogs. And so, if you want a sneaker from 5 years ago, 10 years ago, we have that on GOAT. And so it's been a record-breaking year for GOAT.
And Eddie, it's Danny. So from the data that you collected, Nike was one of your top selling brands, but Nike was one of those brands that also suffered from supply chain disruptions. Do you think those brands will rethink or reconsider doing business somewhere else? Do you see that in the future?
In terms of supply chain, like I mentioned, given that we sell in so many different countries, we didn't see as much of a supply chain impact as some other companies. And given that international is such a big part of our growth, there were so many different and every country had its own top sneaker. And what we saw was it wasn't just Nike. Yes, Nike was a big hit in English-speaking countries like the US, in Canada, the UK, but in the Middle East, for example, Yeezys were the top sneaker of the year. And so in Saudi Arabia and the Emirates, Yeezys were really sought after. In Japan, our top selling sneaker was a New Balance. So I think you're starting to see trends where it's not just being Nike dominated, but of course, Nike is a very important part of the ecosystem.
And also another thing is we're seeing that the secondary market is now becoming the primary market. Can you talk to us a little bit about how that is, the evolution of that?
So of course, with sneakers and apparel in general, you have primary sales, but once those products sell out in store, there's just where does the consumer go to buy products? And now that there are companies like GOAT out there, we're seeing that GOAT's just becoming kind of the best place to buy sneakers and fashion on the internet because it's the first place you go to. You don't want to deal with kind of not being able to, or going to a store and not being able to find product, or going to a manufacturer's site and it being sold out. So we're seeing that our customers are just coming to us directly. And you mentioned the primary side as well. We're starting to work with some of the best brands in the industry who sell directly on GOAT right next to our network of 700,000 sellers. So for example, Balenciaga, Versace, Alexander McQueen all sell directly on GOAT. So the consumer gets the best of both worlds, both from the primary and the secondary markets.
Eddie, good to see you again. I'm wondering if you are looking at getting into the NFT market there at GOAT when it comes to sneakers. I know StockX is doing it already. Shaquille O'Neal is looking at the possibility. And how would that work since sneakers, you either want to wear them, they're very tangible, right? So how would a digital asset of sneakers work into the equation?
Hey, Alexis. Well, our digital lives are being increasingly important, and it's definitely something that we look at. We actually started this kind of cross-section between the digital and physical with our Black Friday campaign. We called it Spaces, where our consumers were dropped into virtually themed worlds where they could access our products in different settings. So we're already on the kind of digital physical train, and definitely stay tuned for more.
And Eddie, want to just touch on the fact that there has been such a huge rise in luxury brands getting into the sneaker market. You name the brand, top brand, Chanel, Balenciaga, as you mentioned, they all have a sneaker, and that's attracting like my daughters to wear sneakers more than they have before. So I'm wondering, are more and more women coming into the sneaker house as well, if you will?
Great question, and definitely. I mean, when we started 7 years ago in 2015, we were primarily a limited edition kind of Jordan and Yeezy marketplace where it was predominantly males. As we've incorporated luxury and fashion, and like you mentioned, a lot of the luxury houses have amazing sneakers and collaborations with some of the top sneaker companies such as Nike and Adidas. So we're seeing that the female demographic represents 40% of our consumer base now and growing.
I want to step away from sneakers for a moment and ask you about these so-called hype bags that seem to have become even bigger than sneakers for some folks, these cross-body bags that guys are wearing. I mean, they're pretty high-end. Gucci, Hermes has theirs. What's that market looking like for GOAT?
Definitely on the accessory side, it's one of our fastest growing markets. Apparel and accessories have grown so much year over year, and we're continuing to invest time and product into giving these options to our consumers. So we're excited. I mean, fashion spans all genders, it spans, we say that a lot of our products are unisex these days. So continue to be excited about the options for our female and male consumers.
Okay, Eddie Liu, GOAT's Group co-founder and CEO. Thanks so much for stopping by, along with Yahoo Finance's Danny Romero. We are going to take a break and switch gears. On the other side of it, Intel just announced a big move to help drive chip growth. Stay with us.
Welcome back. Intel today announcing it will invest about $20 billion into a new chip making plant in Ohio. It also hopes to announce a European manufacturing site in the coming months. Our tech editor, Dan Howley, here now with more details. And Dan, I have to think this has something to do with the global chip shortage.
That's right, Alexis. This plant, it's going to be 2 factories, actually, will cost $20 billion. And Pat Gelsinger, the CEO of Intel, says that eventually it could be the largest fabrication facility on Earth for microprocessors. Now, they're saying that they could have up to 8 different factories built at this area, $100 billion cost. And then that would obviously bring in more jobs into the Ohio area. And as you said, this has a lot to do with the chip shortage. The U.S. obviously keen on getting more and more capability, manufacturing capability into the states. And so we had President Biden this morning discussing this. Here's what he had to say about the issues that the chip shortage are bringing up, especially in the auto industry.
Because supply is low, we find ourselves in a position that we're really behind the curve. Prices are going up. In fact, 1/3 of the recent price increases that have been seen nationally are due to car prices.
And so, yes, the car prices, according to Pat Gelsinger, will in the future be made up 20% of microprocessors. That's right, 20% of a car's cost will come from the processors that are in them. So these factories, as well as ones that are being built in Arizona and Texas from other manufacturers, including Texas Instruments and Samsung, really are meant to help bolster the U.S.'s ability to build out its own infrastructure for microprocessors.
And Dan, when will then factories be likely to start shipping these processors?
So the first two factories that the Intel has won't be completed until about 2025. That's the early estimate. That's the whole thing about these factories and the chip shortage. The factories aren't going to fix the chip shortage in and of itself. It's more of a bulwark against future chip shortages. We still have to catch up with demand here and abroad. And so these facilities will still take years and years to construct. And then on top of that, processors themselves can take up to 6 months to build. This isn't stamping out, a stainless steel skillet or something along those lines. It takes a lot of work for processors to go down the assembly line. So 6 months, that's the maximum that you can expect for one chip to be done. So that's why we're still seeing these shortages. Now, some of the heads of some of the biggest chip makers in the world, NVIDIA, Intel, AMD, say that 2023 is the time where we should start to see the chip shortage come to an end. So we still have to get through another year, perhaps, of shortages of things ranging from features in vehicles. Obviously, automakers are cutting some of those out, as well as video game consoles and graphics cards.
All right, Dan Howley, thanks for that roundup. We appreciate it. Have a great weekend. Let's get you all another check of the markets because it seems as though the selling is gaining steam here as we head into the close to end what will be a punishing week for investors, another volatile one. Right now, the Dow Jones Industrial Average off nearly 300 points. That would be its worst level of the trading session. In the broader market, financials and tech leading the way down again is becoming a familiar story. The S&P looking at its worst week in about 15 months here, now down about 57 points. And the Nasdaq surrendering that 14,000 level. It is now down more than 250. And once again, on a percentage basis, the biggest loser off about 2%. A leading tech lower today, Netflix, after that disappointing subscriber growth outlook. That stock is getting pummeled today. However, we do have some Nasdaq losers here that we want to show you. Right, Netflix is the first one. We've also got DocuSign, NetEase on the downside as well. So not only are equities selling off, the sell-off in cryptocurrency continuing with Bitcoin now below $40,000. Last trade I saw at $38,000. It's off about 40% from its high just back in November. That's going to do it for us. For Karina Mitchell, I'm Alexis Christophorous. Thanks so much for joining us. Have a wonderful weekend. More Yahoo Finance Live right after this.
The sell-off continues as markets drop and the Nasdaq falls further into correction territory. Netflix sank more than 24% after warning about a slowdown in subscriber growth, and other stocks are taking a hit ahead of next week's Fed meeting. Hennian & Walsh CIO Kevin Mon helps us plot next moves to protect our portfolios. Then you wake up with a sniffle or even a slight cough. So what's your next move? Try to find a COVID test? Go to work? In the age of the pandemic, a simple yes or no to those questions, well, that answer has serious consequences. So we will ask an emergency room physician what we all need to consider. And then Bitcoin falls more than 11%, dropping below $40,000, dragging down Ethereum and other crypto assets, just as Americans consider adding those assets to their retirement accounts, things like IRAs. What we all need to think about before betting your golden years on digital assets. We have an hour left in the trading session. I'm Adam Shapiro.
And I'm Emily McCormick. It's a sea of red in stocks this afternoon. The three major indexes are trading near session lows at the start of this final hour of trading. Taking a look at the price action here, the S&P 500 down about 1.5%, with communication services, consumer discretionary rather, and material sectors leading the way lower. Although to the upside, we do have consumer staples and real estates narrowly in positive territory on that sector action. Then taking a look at the other major indices, the Dow Jones Industrial Average down now about 350 points or about 1%. It had briefly been in positive territory earlier during today's session. And the Nasdaq, again, the laggard in today's trading day, down more than 2%. But for more on the market action, let's head right over to Yahoo Finance's Jared Blickery for more. Jared?
That's right. And we're going to do a longer recap after the bell today, but I want to get to the Wi-Fi Interactive and show you what's happened with the NASDAQ over the 4 days. This is a holiday shortened trading week, remember, and it has been a long week. Look at that, down almost 7% over the time period. The Dow off a little bit better, but still down 4% for this 4 days. Now, let's get to the bond market because we're having a huge downswing in yields, and that's bucking the trend that we've seen recently. They've been surging higher. Not today. The 10-year is down 8 basis points. Let's get a look at the 5-year. That's down 7 basis points. And the 30-year, that is down 7 basis points as well. Now, looking inside the market, we want to get to the sector action. Only staples and real estate are in the green. You also have utilities outperforming, but that is a very defensive setup. And that's par for the course what we've seen this week. Here's the sector action over the last 4 days. The best off, utilities still down about 0.5%. To the downside, consumer discretionary, Amazon really dragging down that sector over the last couple of days. But then financials, the value trade flagging a little bit this week. Tech down 6%, even energy, which is the sole sector in the green this year, that is down 3% for the week. And let's just check out the yearly totals here. Energy up 12.6%, everything else mired in the red. We're going to go back to our day view here, and let's take a look at the travel sector. We're seeing the cruise lines get hit pretty hard. Carnival is down 3.5%, Norwegian down 4%, Southwest Airlines, Delta, United, all of those airline stocks are down more than 2%. And let's get a look at the semiconductor space, seeing some weakness there. We got WDC and Micron. Both of those are off about 3%. And then in software, one of those beaten down sectors over the last few months, we got Shopify down 13%, CrowdStrike down 5%. Just looking at the 4-day totals here, a lot of dark red on your screen. And we got to take a look at Bitcoin because Bitcoin has finally sunk below $40,000. We can see it's down 11% over the trailing 24-hour period. 38,000, not a big level, so probably have to probe a little bit farther below, maybe even that 28, 30,000 before we find some support, although we do have minor support at about 35,000 as well. So we're going to pick things up in about 40 minutes, and hopefully it's not another slide into the close for stocks as we have seen over the last 2 days, guys.
All right, Jared, we're going to keep an eye on what's happening with these markets. We know the last 20 to 15 minutes of the trading session is Pepto-Bismol time, so get ready. But Kevin Mon always has a smile when he comes on board. And it's good to have, because those of us who don't like this kind of volatility, I mean, you make your living on this, but this is frightening to average investors, especially when you consider, I realize we had 27% gain last year on the S&P 500, but looking at year to date, and we're not even a full month into the year, S&P 500 is off 7%. So before we dive into the headline I take from you, Kevin, is growing but slower. Want to calm everybody. Yes. Help us understand what we're witnessing right now. How much of it is fear? How much of it is I need to take some profit off the table? And how much of it is just driven by things beyond our control, like the expiration of options contracts?
Yes, it's been a tough start to the year, to say the least, Adam. But let's consider the following. The technology-laden Nasdaq index is having its worst month since November of 2008. The U.S. large cap S&P 500 index is having its worst week since October of 2020. But it's also had its best 3-year run since 1999 with a return of 72%. All of that led to excessive valuations with a PE of around 26 to end the year. Those excessive valuations ran into a more hawkish Fed as we left 2021 and turned to 2022. As a result, investors got concerned that a more aggressive Federal Reserve might slow down the economy and also pose some problems for those more highly leveraged technology companies. But putting that all into perspective, once again, we think these pullbacks are creating some very interesting investment opportunities in certain areas over the longer term.
Kevin, it's great to have you on again. I'm wondering, for investors, because there certainly are many of them who are heavily weighed in their portfolios in some of these high growth, highly valued technology companies, what would you suggest that they do right now? Should they be selling when we get little mini rallies throughout the rest of this year, or should they be holding through some of this volatility?
I think investors should generally be true to their risk tolerance. They shouldn't necessarily get more aggressive when the market is moving higher, as it has over the last 3 years, and they shouldn't get more bearish when markets are moving lower, as they have at the beginning of 2022. But I think this market now is much more of a stock-specific market than it is an index or asset class-driven market. Couple examples in point, Emily. Consider Amazon right now. Amazon is down over 13% year to date. Does anyone think Amazon is going out of business? Or do you believe with us here at Smart Trust that Amazon is likely to be the hub of the e-commerce ecosystem for a year to come? Apple is another example, down 8% year to date. Does anybody believe that Apple is going out of business? Or perhaps it was just trading at some excessive valuation and it's being taken out right now with some of the selling pressures that are going across those various technology indexes. So I think investors should stay true to their risk tolerance, understand what their longer term growth objectives are, and then focus more on the individual companies, their positions within their industries, and whether they tie into the themes that should drive this economy moving forward.
The other thing that is pretty practical advice that you have for your clients is you talk about asset classes that perform well. We know we got the interest rates going up, probably starting March at that meeting. But you point out, look, high yield bonds, precious metal miners. I don't know if Cleveland Cliffs, I love Cleveland, so I always go to CLF, hardly precious metals. But there are places that money's going to be made going forward. Can you talk more about that? Because a lot of people are looking for opportunity.
Absolutely. And whether the Fed moves 3 times this year, 4 times this year, or even more than 4 times, as Jamie Dimon recently suggested, it's clear we're in a rising rate environment. And historically, there are certain asset classes that tend to perform better in rising rate environments. Understanding that rising rate environments generally accompany expanding economies, or the Fed wouldn't be raising interest rates. One of those areas is high yield bonds. High yield tends to outperform investment grade during period of interest spread hikes. If we drill into certain sectors of equities, one area that we particularly like, Adam, are financials, notably the smaller cap regional banks, community banks, and mortgage and thrift institutions. We think their spread business, where they're making loans and now earning a higher rate of interest as rates rise, is going to do very well for them. And we also anticipate the M&A activity to pick up in that regional bank space as well. The same can be said for smaller cap biotech companies, as we think the pace of M&A activity of some of those innovative healthcare solution providers in the areas of gene editing, gene splicing, oncology are going to become more and more attractive to the larger cap pharmaceutical companies who have a lot of cash on their balance sheets to spend.
Kevin Munn, you're like a legal dose of Valium when people get jittery. It's good to have you here. Kevin is Hennian and Walsh Chief Investment Officer. All the best to you. When we come back, we're going to talk about COVID and the protection that having a vaccine and a booster actually offer if you should encounter someone with Omicron.
Welcome back. The CDC released new data today showing that booster COVID-19 vaccines from Pfizer and Moderna are 90% effective at preventing hospitalizations from the Omicron variant. Yahoo Finance's health reporter Anjali Kamlani joins us now for more. Anjali, break down these latest findings for us.
Well, Emily, what the CDC revealed actually just reinforces what we've seen across the world with data that has popped up, especially in Israel, for example, about the benefits of that booster dose. We saw that, of course, as you mentioned, the doses held up 90% in preventing hospitalizations and was particularly effective in ages 50 and older. This, of course, coming at a time where we see a rise continuing in hospitalizations, even though admissions have started to decrease in some parts of the country, we are still seeing ongoing hospitalizations as well as some ICU, which indicates severe illness. And that in particular does indicate that there are still a number of unvaccinated people or those who have not gotten their boosters being affected by this new variant. We know that this data did also provide support for the idea that the boosters protect better against Delta than they do against Omicron, which has proven to be able to elude just a little bit of the protection, which is why we're seeing so many breakthrough cases, even for individuals with boosters. But as has been reported before, those cases are largely mild, and that's where this whole milder disease comes from for Omicron. But it is largely for those who are vaccinated or boosted. Back to you.
Yahoo Finance's Anjali Kamlani, thank you so much. Let's bring in our next guest now for more on this topic. Dr. Owais Durrani is an emergency medicine physician based in Texas. Dr. Durrani, thank you so much for your time. You heard Anjali talking about these latest booster shot data coming out from the CDC. Are these findings that booster shots have been highly effective against hospitalizations related to Omicron consistent with what you've been seeing in terms of who as patients are coming in with COVID and whether they've been vaccinated or boosted or not?
Absolutely. I could probably count on one hand the number of patients I've admitted to the hospital that were boosted over the last 2 months or so. None of them needed to be intubated. They were all in the hospital for a few days and then discharged. The vast majority of patients that I'm admitting that need intubation or high levels of oxygen are all patients that are either unvaccinated or they got 2 shots and they're, months out, 7, 8 months out from those 2 shots. And so right now it is more clear than ever that 3 shots is what we need. The FDA and CDC have data that supports that. We have data from across the globe that supports that. And the definition of fully vaccinated needs to be changed to that. Right now, when patients come in and I ask them, are you fully vaccinated? They'll say yes, but they, as I mentioned, may have gotten that second shot 8 months ago. And so they're not really protected at the levels that we need them to be protected with. If the CDC and FDA change those guidances, it's going to help me convince those patients to get a booster and help them think of a booster as something that's going to be a sequence in that vaccination schedule rather than as something that's a bonus, which is what we've kind of made it out to be over the last few months.
Doctor, I want to ask you a question that I think lots of Americans over the age of 40 deal with every day at 6 a.m. It sounds like we're possessed by our grandparents with the coughing and hacking and the morning noises that gross everyone out. But you might think to yourself, I got a sniffle, I got the cough, am I ill? And then a decision has to be made at that moment. Do I proceed? Do I go to work today? Because a lot of people, there are hybrid office settings. In the old world, you'd go. But today, that doesn't necessarily mean you have COVID. So is there a number of questions we should ask ourselves before we make that final decision?
Yeah, that kind of sounds like me some mornings too, even though I'm not over 40. The short answer is you need to stay at home until you have a negative COVID test. With how much COVID transmission there is and Omicron transmission there is in our communities, it's safe to assume that it's COVID until proven otherwise. Now, unfortunately, all of us don't have readily available testing. And so that's going to require some legwork in terms of, calling your primary care doctor's office, seeing if there's community testing sites around you, seeing if a friend has an extra test that you could borrow, whatever the case may be. But right now, I tell all my patients and anyone who asks me this question, it's safe to say that you have COVID until proven otherwise. Maybe in a month or 2 months when that transmission level drops to under 10%, the answer to that will be different. But right now, assume you have it.
Dr. Durrani, the CDC also reported that there are steep declines being seen right now in COVID cases in New York and in the Northeast at large. What are you seeing right now in Texas and in the South? And do you feel that cases are getting to the point of plateauing, or are you past that peak?
Yeah, so we're seeing some initial data here in Texas where we have a decrease in the number of cases. Now, there have been some delays in reporting case numbers, so we'll need to follow those trends. But when I go into the emergency department, it still feels like we're in the thick of it. And that's because anything hospital related is going to be lagging from case numbers. So I'm still seeing patients that are, admitted to the ICU, still boarding in the emergency department. We're still having issues transferring patients into our hospitals from rural areas that need the specialist care available in places like Houston. We are, still seeing waiting room times that are 8, 12, 15 hours. And so right now, I still urge everyone to be cautious. You don't want to get COVID. You don't want to, break an ankle because that's going to be a 15-hour ER visit. You want to stay away from hospitals as much as possible and be as cautious as possible because right now is not the time to be sick.
The vast majority of those beds, are you telling us, are those who are not vaccinated with COVID?
So yeah, the COVID patients that are waiting for beds, yes, a majority of them are either unvaccinated with COVID, they're either severely immunocompromised with things like cancer, or transplant patients that unfortunately are not going to get that robust immune response, or their kids.
You mentioned those 8, 12, 15-hour waits for ER visits. What has the staffing situation been like where you're practicing at and at hospitals in your region?
Yeah, we've really been strained for staffing. We have a skeleton nursing staff. Many doctors are out sick, and so we're all having to pick up extra shifts to fill in those areas. You can come to the ER for, say, an upset stomach. That's no big deal. But then, I'm examining patients in the waiting room. I'm ordering tests, and they're getting their blood work drawn in the waiting room. They are sitting in the waiting room for hours. And even if they don't have COVID, they may be sitting next to someone who does, and they may be positive a few days after that visit. And so the staffing shortages and the surge in patients that we're seeing are coming at the worst time possible and leading to these situations.
Doctor, looking ahead, because we realize how much work people like you and the other medics and staffs at hospitals are doing, a year, 2 years from now, is it going to be hard to get hospital staffs back up to where they need to be? Are people going to be so burned out that they might not even want to consider a future in medical care?
I hope not. I went into medicine, and so many nurses, respiratory technicians, others went into medicine because it's a fulfilling field. This pandemic is a once in a generation kind of thing. There were already flaws when it came to healthcare workers not getting care for mental health and things like burnout. And it's been magnified by this pandemic. And so I hope that once we're out of this crisis mode, hospital systems and medical schools and all levels of the healthcare system will address a lot of these issues and put into place mechanisms that allow us to, get a break when needed, allow us to get mental health for those that need it, allow us to, have in place paid sick leave for those who don't. And I think putting those things into place, if we do those, will bring people back into the healthcare workforce because it is such a fulfilling field when done right.
There have been some early reports emerging that Omicron may mark a turning point in the pandemic, and that once we get past this point, we may see this become something more endemic rather than as a pandemic. What's your view on that as someone working in this field and who has been working in this field over the course of the entirety of this pandemic?
Yeah, if there's one thing that I've learned throughout this pandemic is to not make bold predictions, and I've been humbled time after time. And so I hope that's the case, but I'm really cautious about that. Now, when you look at, just simple biology, viruses mutate, that's normal, and they mutate down the path of least resistance. Omicron is so transmissible that it becoming potentially more transmissible wouldn't really benefit it because it is the dominant variant. So when you look at it from kind of that simple biology evolutionary 101 point of view, that makes sense. That being said, we've had so many curveballs throughout this pandemic. I don't want to hang my head on that and just assume that's going to happen. I really hope that once we get through this kind of crisis phase of Omicron, we don't simply go back to, this is over and things are going to be fine. We really need to focus on ensuring we get the globe vaccinated, that we decrease transmission, and so that we don't get another variant that may be more transmissible or more severe or both.
All right, we'll leave it there. Dr. Awais Durrani is emergency medicine physician in Texas, and we thank you so much for your time this afternoon. Coming up, Bitcoin prices sank to the lowest level since August today as the risk-off tone in markets extends to cryptocurrencies. We'll get the latest with Yahoo Finance's Jen Schonberger on the other side of this break.
All right, so as we pay attention to what's happening in the crypto corner, a lot of us remember the comedian George Carlin, who had 7 words you could not say on TV. And if you're a crypto investor, you're probably uttering some of those words right now, watching what's going on. Thank you very much, Federal Reserve. With a paper that doesn't necessarily have a definite course as of yet. What does all of this mean? Jennifer Schonberger covers crypto for us. And can we blame the Fed, Jen, for what we're witnessing in the drop in cryptos today?
Hey there, Adam. Yeah, it's a consortium of issues today. The Fed may be contributing to that, but when it's risk off and stocks sell off, so do cryptocurrencies. Bitcoin and other cryptocurrencies are now more highly correlated with stocks since the onset of the pandemic, and even more so since this past fall. Take a look at a chart of Bitcoin today, falling below that 38,000 level, now off more than 11% as crypto is in the red across the board to close this week. That is, the Dow is off more than 1%, and the Nasdaq off more than 2%. In general, crypto's been under pressure as the Federal Reserve looks to raise interest rates, and the sell-off in big tech stocks is prompting investors to liquidate positions in their crypto holdings to limit those overall losses. Jeff Sika, founder of Circle Squared Alternative Investments, tells me, quote, hedge funds and institutions that have paired cryptocurrency with tech stocks and have highest percentage of leverage ever are being forced to raise cash quickly to reduce leverage and cover future margin calls as the market sells off. This tight correlation between crypto and tech has created this undoing. He says he's tempted to buy, but not quite yet. Also driving today's action, Russia's central bank Thursday proposed banning cryptocurrencies just after regulators in the UK, Spain, and Singapore this week toughened rules on crypto. This all coming just a day after the Federal Reserve took its first step towards potentially pursuing a central bank digital currency. For that to move forward, the Fed must design a CBDC in a way that meets approval of Congress and the White House. Congress generally appears open to authorizing a CBDC, though the Fed will need to sort through details to satiate both parties. A White House representative did not immediately respond to Yahoo Finance's request for comment. Senate Banking Committee Chairman Sherrod Brown called the Fed's report a good first step towards the digital dollar, while Republican Senator Pat Toomey, ranking member on that Senate Banking Committee, says he's encouraged by the report, but concerned about how the Fed will protect Americans' privacy. And Adam, with many traders in the crypto sphere hiding out in stable coins now as they sell off, a CBDC could be a competitor for those private stable coins, especially during times of market volatility and sort of a go-to safe haven. According to an analyst at Chainalysis, if we were to adopt a CBDC, it would have virtually zero credit and liquidity risk and would be widely accepted by the financial system. So certainly could be a game changer here and could be contributing to some of the sell-off that we're seeing across the crypto space today. Adam?
Jen, you've just given us the first question for a little bit later on. We have a guest coming on who's going to talk about the fact that cryptos are now part of IRAs, and perhaps people who are investing for their retirements want a little bit of a guarantee like the one you just outlined if we do get a central bank digital coin. Jen Schonberger, thank you very much. When we come back, we got to check what's going on with the oil right after the break.
Welcome back. Let's get a quick check of the market action because we are seeing the three major stock indexes accelerating to the downside this afternoon. This is something that we've seen over the past couple of trading days where the last 30 minutes of trading have been exceptionally ugly. And taking a look here, we do have the Nasdaq Composite down more than 2%. A big slide in shares of Netflix, currently down 23%, is contributing heavily to that decline after the company missed on subscriber numbers for the fourth quarter and on its subscriber growth outlook for the first quarter in earnings results released yesterday. And taking a look at the other major stock indexes, the Dow Jones Industrial Average now down more than 400 points, or about 1.2%. And Disney is the component that is leading the way lower. That stock down about 7% and falling in sympathy with what we've seen from Netflix because of course, Disney's Disney Plus business unit. The S&P 500 is also down about 1.7%. But let's shift now for our 2 and 2 stocks I'm watching and 2 stocks that Adam is watching during today's session. And let's take a look at shares of Under Armour, because this is one stock that is bucking the downward trend of the broader market, and that's after an upgrade from Citigroup. Now, the Wall Street firm raised its recommendation on shares of Under Armour to buy from neutral, and according to a Bloomberg report citing the note from this firm, Citigroup analysts wrote, quote, Under Armour is emerging from the pandemic in a much stronger position in North America with inventory clean, distribution rationalized, the brand identity more clearly defined, and with its product assortment in good shape. Now, Citigroup also sees Under Armour relatively low in terms of penetration in China and sees that as a long-term growth opportunity on a geographic basis. Now, Under Armour, recall, last reported much stronger than expected third quarter results back in November, with revenue up 8% over last year to reach about $1.6 billion, and revenue from Under Armour's biggest North American geographical segment also rose 8%, with international sales up 18%. Now, the stock has underperformed against the S&P 500 over the past year, rising just 2% over that time period, though Citigroup also highlighted that Under Armour has an attractive valuation compared to peers like Nike and Lululemon. Now let's switch gears to talk about Ally Financial, because this company reported earnings results earlier this morning. Those were better than expected, though the stock, as we can see, is down this afternoon. And net revenue was up 11% over last year to $2.2 billion, or ahead of Wall Street's estimates for $2.07 billion. And adjusted earnings per share of $2.02 were up about 26% compared to last year. Now, the one metric that Wall Street may not be liking quite as much is on Ally's higher provision for credit losses. That came in part because of the company's acquisition of Fair Square Financial, and also Ally did have higher non-interest expenses. Now, finally, do want to highlight that Ally got a boost from strong auto demand last year, and it noted that consumer auto originations were up 20% to $10.9 billion, also topping expectations. Now, nevertheless, should note that that stock is down about 4%, so really tracking the broader downward trend in the broader markets, not getting a boost here on these earnings results. Adam?
Emily, want to follow up after we got the earnings from Netflix? What's going on there? I mean, Emily in Paris might say sacre bleu if you're a fan of Ozark, which comes back tonight. Yes, I'm a fan. They use a different word. Again, one of those words that you can't say on TV. Shares were down at 1.25%. Not much better right now. They reported earnings yesterday. Disappointed investors, not on the earnings, but on future subscriber growth. That, by the way, has had the effect of pulling down other streaming services. For instance, Disney, those shares were falling about 6% earlier today. Roku was off by about 7%. Fubo TV off by about 9% right now. So here's what's going on. JP Morgan and Piper Sandler both have overweight ratings on Netflix despite that subscriber growth story. Take a look at Ford. I mean, who doesn't love cars, right? Okay, I get it. The Gen Z and the iGen, they don't like cars. But shares of Ford down 3%. Jefferies downgraded Ford from buy to hold. RBC downgraded from outperformed to sector perform. Here's what's going on. There's a lot of concern that investors were overly optimistic with Ford's potential regarding EVs. You've got the Mustang, the Mach is doing very well. You also have the orders for the F-150 Lightning, which are off the charts. But Adam Jonas over at Morgan Stanley burst that bubble, about a week ago, when he came out and said he had an underweight rating on Ford and predicted that the stock at the time could lose 52% of its value, dropping down to $12 a share. Emily?
Adam, let's talk about energy and commodities, because many of these areas in the markets have been on a tear recently as energy demand, inflation, and expectations for higher rates have all been in play. And we're seeing a little bit of give back during today's session, at least in crude oil prices. And for more on the market action, we have Rob Thummel, Tortoise Portfolio Manager, joining us now. Rob, thank you so much for your time. Starting off on crude oil, as I was mentioning, we did see some pullback in prices today, but they're still up about more than 20% over the past 6 months, at least on WTI. Is there room for more upside in crude? And if so, what's going to be the driver of that?
Yeah, so Emily, so what you've seen in really all energy commodities is really fairly classic. So you've seen the global economy open back up, increase in consumption for energy related demand and those commodities, and you simply haven't had supply catch up and keep up. So inventories have declined, and when inventories fall, prices rise. And so that's what you've seen. Now, in oil, there's been a little bit of an additional element. Throw on this geopolitical potential conflict with Ukraine and Russia. That has elevated prices a little bit more. So where do we see oil prices going from here? Ideally, we'd love oil prices to remain here or even go a little bit lower, because for global economic growth to continue, you don't want oil prices to rise too much. You want all oil related products to remain reasonably priced. And if we get over $100 a barrel, that causes some concern with regards to longer term demand for oil related products.
Rob, if you have an investor who's considering putting their foot into the energy sector, what should they consider? Do they want to go after an actual extractor of the commodity, or would you want to go after someone like a Schlumberger? And I'm not asking you to pick stock here, but someone who services those folk who are actually pulling gas and oil out of the ground?
Yeah, I might even go take a little different angle. So at Tortoise, we would say go for a midstream company in energy. And you might not know what that means, but that's a transporter of energy in the U.S. So globally, demand for energy is going up, right? And so if you don't want commodity price exposure, buying a pipeline company is a great way to get exposure to the energy sector. The reasons why are this. Number one, a lot of energy stocks, including pipeline stocks, pay a high dividend, right? High dividend income. The yield on a lot of energy and midstream companies is 3-4 times higher than the S&P 500. So that's a great place to get some income. You're also going to get growth in that income. That's important as well, especially if you're concerned about rising interest rates. So from our perspective at Tortoise, we would say buy a midstream company with a 5, 6, 7% dividend yield. I think you're going to be pretty happy with that.
When we look at the S&P 500 sector performance, I'm looking at it right now, and at the moment, the energy index is the only one that's in positive territory so far for the year to date, realizing, of course, that we are still only in January. We had a guest on earlier this week who said that this outperformance in the energy sector may be a little bit long in the tooth. But what's your opinion on that? Do you think there's still potentially a little bit more room to run here, and is this outperformance justified?
Yeah, I think the other side of that trade, I think there's a significant opportunity for the sector to continue to outperform. And here's why. Look at the free cash flow yield of the sector. With rising rates, you've got rising commodity prices, you've got rising rates, you've got concerns about global economic growth. Well, investors are going to be looking for free cash flow and free cash flow yields. And the free cash flow yield of the energy sector is 3 or 4 times higher than the S&P 500. And that's really important as investors really start to do their homework, because you have to be very selective today, right, to make money in the market today. You can't just pick anything. That was in 2020 and 2021. You're going to have to be much more selective. And if you find stocks that have got some really good fundamentals that are still cheap from a valuation perspective, which the energy sector is, not a lot of other sectors are, that's where you want to go as an investor.
I want to get back to that dividend yield you were just talking about, between 5 and 7%. Back in the day before the pandemic, you could look at oil stocks, and I'm talking about the commodity. You could find dividend yield around 4%, but 5 to 7%. Are you able to share with us who might have those midstream, who might have that kind of dividend yield?
Oh, yeah, there's a whole host of them. Companies like Plains All American, ticker symbols PAA, has got a really nice yield. Marathon's energy infrastructure company, MPLX, it's got almost a 10% yield. There are several others. Enterprise Products Partners is another big market, almost a large cap company. Once again, 6-7% dividend yield. Williams Company, WMB. I could keep going and talk to you about this for the next 30 minutes and list probably another 20 stocks with a 5% or higher dividend yield in the energy sector.
When we think about spot prices and, of course, crude oil futures, what do you think is the bigger driver right now of the price action? Do you think it's more on the supply side and what's happening with production, OPEC plus, or do you think it's more on the demand side in this recovery story, pickup in travel and demand out of China, et cetera?
No, that's actually a great question. And normally demand drives the oil price, but over the last couple of years, it's changing, and it's probably going to change, and it's going to move from demand to supply driven. So what's happened is supply has not kept up. So OPEC plus has been trying to raise production and keep up with that higher demand. And frankly, not all the countries have been able to keep up with the forecasted supply increases. And so that's been a challenge and resulted in higher oil prices. The U.S., right? The U.S. has decided that they're no longer going to grow production as much as they have historically. So that means less supply to the market as well. That capital discipline that U.S. producers are displaying will remain in place. We won't see the U.S. grow oil production significantly. So that's going to keep oil prices elevated for an extended period of time.
All right, we'll leave it there. Rob Thummel is Tortoise Portfolio Manager, and we thank you so much for your time this afternoon. Coming up, Netflix and Peloton shares have dropped sharply this week as concerns over slowing demand for these darlings of the stay-at-home trade mount. We'll discuss the outlook for these names and other major tech players with Oppenheimer's Jason Helfstein on the other side of this break.
Okay, tale of two stocks here. We saw Netflix fall. We talked about this about 10 minutes ago, off about 25% after the earnings report, warning about future subscriber growth. And then yesterday we saw Peloton shares fall dramatically because of the report that they were going to halt production on some of their treadmills and their bikes. And yet today the stock is up about 13%. Instead of taking our word for it, let's bring in somebody who understands what they're talking about when you're looking at these things. And that's Jason Helfstein. He's Oppenheimer Managing Director and Senior Analyst. And it's good to have you here. Let's jump in on Peloton right now. Had a doctor joining us earlier and the talk about COVID-19 that, you know, as we get past the peak of Omicron, people are heading back to gyms. I guess what I'm getting at is I'm trying to understand how Peloton stock has gone up today. Any idea?
Yeah, I mean, there's been a lot of negative headlines around Peloton over the past few weeks. Discussion about them, trying to reduce retail store expenses, potentially cutting compensation. They effectively announced that they were going to stop offering free setup and delivery, which was effectively a bike price increase. And then you had this another press outlet reported that kind of citing internal memo that they were stopping production of new equipment. And we all know that they had a lot of equipment, you can tell based on the balance sheet, sitting around after the end of last quarter. And so the company was actually compelled to pre-announce, and the pre-announcement just was not as bad as expected. They basically guided revenue for the quarter in line with the street. Cash flow was actually better, so the losses were better. And then while connected fitness subs were a bit lower, they were 1% below the street, with net adds 12% below. And so, they flat out denied that they were halting production. I think they're gonna, probably delay opening up a new facility in the U.S. So I think the worst case scenario was kind of not playing out, and so you had a relief rally in the stock.
Given the declines that we've seen in Peloton shares over the past several months now, ever since since their last quarterly earnings results, do you see another company potentially coming in here and buying Peloton outright?
I mean, it's possible. Everyone likes to say Apple, and I mean, they do that because if you think about Peloton, it's a premium brand that has a kind of a software hardware combination, and there's like a network effect to it, right? The more people that who use it, the more appealing it is. It's kind of how Apple devices are, right? But if you look, Apple has really, I think the last major acquisition they did was Beats many years ago. I mean, they're just generally not an acquisitive company. They focus on, internal development. I mean, look, maybe an Alphabet. I mean, they bought Fitbit, more around wearables, but clearly that's important for fitness, and they're definitely trailing Amazon when it comes to, I think, connected home. So it's possible, but I don't think investors should be buying the stock for a takeout. I would argue that they are the market leader in this. I think, it's now clear that this is harder to do than maybe people realized, because the pandemic made it look easier, and we can kind of talk about why. But at the end of the day, they'll be the long-term leader, and the valuation is discounting a lot already, and we think the stock will be meaningfully higher from here 12 to 18 months.
Want to take a look at Netflix too. I'm thrilled about Ozark. I want to see what happens to the bird family. That stock falling, 25% after the opening bell today. And I get the concern about subscriber growth, but it's not like Netflix is going to go anywhere. They have so many blockbusters that you gotta have Netflix to watch, and nobody seemed to rebel when they raised prices. So help us understand this drop.
Yeah, I mean, my colleague Jed Kelly is the lead analyst on the stock, but I think when Netflix does try to guide to what they really think they're going to do, they're not particularly good at it. Some quarters they do meaningfully better. Other times it's worse. The U.S. they're generally running for revenue, so they feel they're willing to push through price increases. I think they cited competitive issues internationally, and that's what's driving the stock. But really, this stock isn't a significant focus of mine right now.
Netflix, as usual, is the first of the big tech companies to report quarterly earnings results. Does this report, and more importantly, the reaction that we're seeing from investors right now, does this concern you about what we should be expecting from other major tech stocks after earnings? Because we are getting names including Microsoft and Apple reporting next week.
So again, we focus on Facebook, Meta, Google, Amazon, Uber. The question, I think when we understand that, the market has been souring on momentum growth stocks, between interest rates, then the way that impacts valuation, and kind of when you have a growth stock and you cut the near term growth estimate, it has meaningful implications for the compounding factor, right? So generally, the idea is investors will gravitate back to potentially slower growing companies where there's less risk of what the out year revenue and earnings will be, and then trade at a lower valuation, right? So that might be like, Meta, Facebook, or an Alphabet. And, and kind of up until today or, 2 trading days ago, Facebook was actually performing more like in line with the market. Look, we think there's kind of company specific factors that investors will gauge. I mean, the story around Facebook Meta really is, their ability to deal with Apple's changes to the advertising ecosystem, whereas Google Alphabet is still probably the best reopening play in digital advertising. And then investors are getting more and more comfortable that their cloud business is starting to scale up, and that's a multi-year trend. And I think if you look at both of those companies, either on an EBITDA or earnings basis, they're not at any kind of meaningful premium to the market. And so our sense is that, those companies will be fine. I will also say that inflation tends to be also a positive thing for advertising, because advertising is usually a percentage of revenue. And so if companies are raising prices because of inflation, they generally will spend more on advertising. Granted, tech companies need to deal with like wage inflation as every other company, but we think that they're better positioned. So again, this market has basically been driven by a lack of buyers. And we think, investors are waiting for some clarity around an earnings outlook. And we think, again, in the internet sector, it's really 2 weeks from now, not next week. Right. But there's definitely a focus on what's the outlook from the biggest companies.
Would love to get you back in 2 weeks. And sorry for putting you on the spot with Netflix, but
No
I gotta
worries.
tell you, hey, if you don't watch Ozark,
I know you're a big Ozark fan. I love the show too. Waiting for
it's like
to come back.
Have you seen the trailer? Laura Linney I don't know if I can say what she's picking out of her hair after the.
Listen, I'm a purist. I don't watch the trailers. I know I enjoyed the first few seasons, so I'll just tune in when the next one's on.
Tonight, I'm there. All right, Jason Helfstein, Oppenheimer's managing director and senior analyst. All the best to you. We're going to count down to the closing bell right after the break.
Welcome back. Let's take a look at where stocks are trading because we have about 5 minutes left in this trading session and this trading week. As we can see, it is a bloodbath today. The Nasdaq down more than 2.5% now about 2.6%. The Dow Jones Industrial Average down more than 400 points or more than 1 percentage point during today's session. And the S&P 500 down nearly 2% as we head into this closing bell. Now, taking a little bit of a deeper dive here on the sector action in the S&P 500, leading the way lower, we have communication services, consumer discretionary, and material sectors. But if we take a look to the upside, the consumer staple sector is holding on to slightly positive territory. It's been fluctuating just around the flat line over the past hour or so. The real estate and utility sectors are also outperforming, but again, still in negative territory. Then taking a look at some of the components in the Dow Jones Industrial Average, Disney is the biggest laggard in that index, down more than 6%. It's off of its session lows, but still sharply in negative territory during the session, followed by Boeing, Visa, and Cisco. So definitely seeing some carnage here in some of these growth and technology stocks. That's a theme that we've definitely been seeing over the course of this past week and really for this year to date over the past month or so. Now, also want to highlight what we're seeing in shares of Netflix, because that was one of the main companies to report after the bell yesterday. We got some disappointing numbers in terms of subscriber growth for the fourth quarter, as well as the company's outlook for the first quarter. And investors are punishing the stock because of that. Still down about 22%. Again, off session lows, but only by a couple of percentage points. Coming up next, we've got the sprint to the closing bell. Stick with us on Yahoo Finance Live. Welcome back. We're about a minute until the closing bell this Friday, January 21st, and our market panel is here to break down today's trading action and tell us where the outlook may be headed here for markets. Christina Hooper is Invesco Chief Global Market Strategist, and Todd Jablonski is Principal Global Asset Allocation Chief Investment Officer. Let's get one final quick check of the markets heading into the closing bell. Stocks really accelerating into the close here. The Nasdaq off about nearly 2.7%. The Dow Jones Industrial Average off just over 1%, and the S&P 500 down 1.6%. And here's the closing bell.
Well, always good to have a smile at the end of the week. There's the gavel, there's the closing bell, and here's where we are going to settle. It is a down week. Look at this. The Dow's going to be off about 1.3%. We lost 400 and almost 50 points at the end of the session. S&P 500 is off almost 2%. We're going to settle down 85 points. For the week, the S&P 500 is down about 5%. And year to date, it's down almost 8%. Nasdaq, it is down. We've been in correction territory. It's lost 385 points. It will be down roughly 2.75%. Let's get back to the panel. And Christina, I was listening to different kinds of analysts talk about what we're witnessing right now, and they mentioned that, look, every year you get in any trading session or during trading sessions, you get a natural pullback, 5 to 10%. The question, I guess, for investors that a lot of us are asking, is this that usual in the course of a year where you get a bit of a pullback? Is it that, or is there something else going on? What do you think?
Well, it's not the usual in the course of a year. It is because we're at the start of Fed tightening. In fact, the release of the FOMC minutes a few weeks ago was the unofficial start of the tightening season. And that really has exerted downward pressure on stocks, as it should, as we've seen in past Fed tightening cycles. At the start, usually we see expectation of rates going up, starting a reappraisal process of stocks that creates volatility and that can put stocks in downturns. So the Fed doesn't tighten every year usually, and usually we don't see sell-offs like this. I do think that it's very normal and to be expected given the kind of environment we're in.
Todd, we have the Federal Reserve's next monetary policy setting meeting, and of course the statement and press conference coming out next week. What do you think investors should really be keying into and focusing in on, since we may not be getting a change on policy after this meeting, but we may be setting up for something in March?
I think investors certainly have begun to bake in their expectations into the market. And at the beginning of the year, consensus seemed to be fomenting around 3 moves in 2022, 3 tightenings. Of late, you've seen investors shift their expectations out to 4. And what I note, and I think what other investors should be aware of, is that the gap between market expectations and Fed actions is what really causes market dislocations, the eruptions of volatility, and from time to time, the kind of movements in rates, such as we've seen over the last several days, and in implied vols with the VIX moving a lot. What ultimately I think you see are markets that are absorbing and guessing at a lot of new information all at the same time. That's translating into speculation about the direction and the pace of Fed action.
But Todd, to follow up on this, at some point, I mean, presumably March, everything that we're now anticipating becomes a fact on the table and the reality. And hopefully markets don't continue going down, down, down. But when do you get that pivot? You know, when does the correction that we're witnessing, or I'm going to use the term alignment, to the realities of where valuations should be, when do we start to recognize that that is now in play?
I think it's when investors find validation that their concerns around inflation and the steps to control inflation are being echoed at the Fed. And when those concerns are being echoed and those expectations are being validated, all of a sudden, I think you see a lot of the pressure on long-term rates begin to ease. I think, in fact, some of the discounting that's taking place in some of the big cap growth tech names driving down prices begins to moderate. And I think you have to actually look at equities as an asset class, go back to the beginning of the year, say, what's the fundamental case for this asset class? You should, in our view, we think, view favorably the expectations for equities in 2022, especially given what could be on the table for fixed income in total moving forward from this point.
Christina, given the latest drop that we've seen across the major equity indices as well as individual stocks, do you see any opportunities emerging here? And if so, where would you suggest investors put some capital to work?
Absolutely see opportunities emerging. We may not have hit the bottom yet, but certainly the sell-off in technology has been quite significant, and it has created a pool of tech stocks that have more attractive valuations than they did just a few weeks ago. I also believe that tech is an attractive area, along with other secular growth parts of the stock market, just given that the U.S. economy is entering the slowdown phase of the economic cycle. And historically, that's a time when tech and secular growth and defensives tend to outperform. So this might not happen overnight, but I do think there are some buying opportunities. Perhaps the best approach right now is to dollar cost average in on days of sell-offs.
Christina, my whole investing career has been dollar cost averaging through the 401ks. I'm curious though, because tech for some of us as, kind of average investors, we might, I'm going to use the word mistake, assume that a work from home play is also a tech play. What warning would you give to somebody like me who's making that correlation?
Well, I think you have to look at the fundamentals, and this is going to be a year for discernment. And you have to recognize and understand where revenues are coming from, and of course, where future revenues are coming from, and what your anticipation is. There are some stocks that have been characterized as work from home stocks that are still likely to benefit going forward because of structural changes that are not going to revert back to where we were pre-pandemic. And I anticipate increased, we've already seen some increase, but I anticipate even more corporate spending on technology to accommodate more of a hybrid workforce. Yes, people are going back to work. Some will remain remote, and there's likely to be a large number that wind up being hybrid. So that necessitates more spending on software, cloud computing, all kinds of areas that some of which have been characterized as the be at home, work from home, stay at home, but really are plays on the future as well.
Todd, given the rising interest rate environment that we're likely to be in this year, of course, we did have 10-year Treasury yields pulling back a bit today after reaching the highest level since January 2020, just earlier this month. Do you think now is the time for investors to be getting into bonds? And if so, where specifically should they be looking?
Early, I think, to look at the fixed income asset class and say at these level of rates that the bear flatter that's likely coming doesn't in fact pretend potentially additional losses, let's say, from rate exposure. But what I will say is as we begin to look forward over 2022 is that you could potentially see some stabilization in rate expectations, given declining inflation expectations, perhaps a bit of a moderation too, as you begin to see investors begin to expect that a bit less. When expectations begin to agree in that way, you could, in fact, I think, see core fixed income become more attractive for stability, especially when complemented by high yield, which I'd emphasize non-investment grade U.S. dollar high yield, in our view, tactically looks pretty favorable, even as you wait for that core fixed income to find stability.
Christina, when Todd says stability, when we get the statement next week from the FOMC, is it going to be, I mean, we're all going to look for the language in there that may upset markets or may bring some calm to the markets. Do you have any sense of which might play out when we get that FOMC statement?
Well, I suspect if there's more of a sell-off between now and then, the Fed will err on the side of calm. But let's face it, it has used its words in recent weeks as another tool. And it's been talking very tough, very hawkish. And I suspect that part of that is not just to keep markets informed and try to be transparent, but to have words do some of the heavy lifting, talk tough, but act perhaps a bit more dovish. So I think some of what we get next week will be dictated by what happens in markets this week and just how unstable or stable they behave. But I suspect that the Fed is still going to want markets to understand that it is going forward with a tightening process because it believes it's behind the curve relative to where it was the last time it started tightening. Now, one caveat, though, there are 3 tools now that the Fed's going to use this year. Now, some are scared. They think that means the Fed is more hawkish. But I would argue the ability to use 3 different tools takes the pressure off one tool in particular, which is rate hikes. And so I would err on the side of fewer rate hikes because the Fed has the ability and is planning on also shrinking its balance sheet.
Todd, we've been talking a lot about the Fed, about inflation, supply chain issues, and of course, Omicron and the ongoing pandemic. Do you think there are any other concerns or, on the flip side, potential positive catalysts that investors should be watching out for this year?
Well, I think globally, of course, again, we've been talking a lot about the Fed, but I think that the pace and the different nature by which you see central banks around the globe shift their monetary policy, either tighten in the face of inflation to arrest inflationary woes, or in fact to be more stimulative in cases where that's again the objective. And what I think ultimately that means is that investors should be looking at developed markets and emerging markets for signs of opportunity. We favor the U.S. in our regional equity allocation in global asset allocation, and we do think that at some point the investors will see the fundamental strength in that big cap tech begin to continue. But for now, I think investors should be looking outside the U.S. for potential surprises and information which might cause a feedback loop into investor sentiment into the United States.
All right, Todd Jablonski is Principal Global Asset Allocation Chief Investment Officer, and Christina Hooper is Invesco Chief Global Market Strategist. And we thank you both so much for your time and insight this afternoon. Let's bring back in Jared Blickery with one last thought on the market action this week. And Jared, take it away.
All right, well, let's take a look at the week and thank goodness it was. We can see the Nasdaq off 2.7%, worst month, going for the worst month since November 2008, worst week since March of 2020. And let's take a 4-day look here. You can see the Nasdaq losing 7.5% of its value. That is a steep loss for 1 week. The Dow off a bit less than that, 4.5%, and the S&P 500 in about the middle. Now, I want to get to some of our heat maps here. And by the way, got some crypto news we're going to get to in a second, but here's the Nasdaq 100. Now, you take a 4-day look. Those are some pretty steep losses for the mega cap, and it really emphasizes why we've seen this downside price action. We got Apple down 6%. Alphabet is also down about 6.5%. Facebook down over 8%. Tesla down 10%. Amazon 12%. Nvidia down 13%. I'm not going to go on, but the numbers just keep going up in certain sectors. Then you take a look at the actual sector action. This is again over 4 days. Utilities is the least bad, along with staples and real estate, but that is a very defensive setup. Consumer discretionary, which houses Amazon, that is down 8%, huge loss there, followed by 6.9% loss in tech, and then financials down 6.5%. Communication services, where you have Facebook and Alphabet, that's down over 5%. So really a pretty bad week for a lot of these stocks. And you look at the banking sector, arguably we can extend this 5 days to go back to JP Morgan's earnings last Friday. JP Morgan down almost 14%, Goldman Sachs down 12% over this trailing time frame. Now, I want to get to Bitcoin. Bitcoin, we've been talking about the price action, finally dropped below 40,000. Not a lot of support. We do have a minor one at about 35,000. Let's see if I can find that level somewhere in here. But also the 28 to 30,000 level. That's going to be a big one to watch. So basically here and here, going to white knuckle it over the weekend. And we just got some breaking news regarding MicroStrategy. This is a company that keeps a huge number of Bitcoins on their balance sheet. And the SEC was taking a look at their 10K, and they don't like the way that MicroStrategy has been accounting for the price of Bitcoin. And because there are really no accounting rules that govern digital assets like that, it's just a big mess. And it kind of highlights the need to get additional regulation here, because this company wants to reflect the price of Bitcoin, the current price, in their non-GAAP financial statements. SEC says, according to the strict letter of the law, you can't do that. So just another hiccup for Bitcoin and people, I guess, companies who want to hold it on their balance sheet. Doesn't mean anything in the big picture, no, but it does indicate that the SEC is going through these financial statements, guys, and they might have a few comments for you.
Jared Blickery, thank you so much. We hope you have a restful weekend after this very volatile week. As Jared was mentioning, it's been another tough week for Bitcoin, and our next guest will break down what Americans should be keeping in mind if they're thinking of adding crypto to their retirement portfolios. That's on the other side of this break.
So we were talking about Bitcoin and cryptocurrencies falling today, and we saw Bitcoin at one point was trading below $38,000. I bring all of that up because as part of our retirement series brought to you by Fidelity Investments, we want to talk about the way people can invest in crypto. It's much easier, but also including that in your retirement portfolio. And one of the firms that's making it easier to do this is iTrust Capital. The CEO, Todd Southwick, is joining us right now. And I guess, you know, a lot of us who are very nervous when we see kind of the fluctuations you get. I mean, Bitcoin is really ginormous, but even in Ethereum. How does iTrust make it easier for me to get into this? Because this is a space people want to be in, but also to measure the volatility as I'm perhaps using my IRA, because it's my retirement account. I certainly don't want to lose it.
Yeah, I have a few comments on that I feel might be helpful. I would say, first, we've seen this type of volatility before, and I can't speculate on price, but from our platform side, we have not seen a decrease in the amount of inflows and new clients. We see less transactional activity, but I think it's a good sign for the market that we haven't seen a decrease in the number of people coming onto our platform. In terms of why use an IRA to invest in cryptocurrency, it's the first answer is tax advantages, and especially if you're buying and selling regularly rather than buying and holding, because every time you buy and sell, obviously, is a taxable event. So if you're doing that in a non-tax advantaged account, it's very difficult to make money over the long term with taxes coming out on every transaction. On top of that,
Todd,
for most Americans, sorry
Todd,
about that.
This is Emily here. I wanted to ask, Bitcoin and especially many of these newer cryptos haven't necessarily been long enough to see performance over a multi-decade horizon, especially, that carries implications for those in their 20s and 30s trying to save for retirement decades into the future. How should investors be thinking about this in terms of what percentage or what allocation of their portfolios should potentially be in crypto?
So just let me preface this by, I can give my personal opinion, but the company opinion would be that we cannot give that type of advice. I think if you're a younger investor, you can invest a higher percentage of your portfolio. The older you are, it's a higher risk asset. You're going to want to do less of your portfolio. And looking at the younger market and how it relates to our platform, I think. Interesting factor is, how many new clients are coming in that are opening their IRAs for the first time because it's an interesting new type of asset that in particular appeals to the younger investor.
You're talking about the younger investor, but lots of middle-aged investors, especially during the Great Resignation, leaving companies in which they have to roll over 401k assets. And you can roll those over into IRAs. Are you seeing any kind of momentum from that kind of transfer?
You're going to like the answer. So you would expect us to have a lot more clients in that 25 to 45-year-old age range, but it's actually quite the opposite. We have twice the amount of clients in the 45 to 65 age range as opposed to the other. So, I mean, you could make a lot of comments on the reasons for that. It's part of it that they have an existing retirement account, but I think it also speaks to the seriousness of the crypto market, especially as it started to change in 2020, where we have a much broader type of investor base coming in. And there's, the new term floating around is crypto dad. So we like to think of ourselves as a platform for crypto dad, somebody coming in and making an investment in this exciting new type of asset that, yes, doesn't have a 20-year history, but I think everyone agrees that it's going to be here.
Do you have data showing whether most of your users are more crypto traders and conducting more trades, or are many of these buy and hold longer term crypto investors?
We're at about 70% buy.
What advice?
And what do you think? Go ahead, Adam.
Go ahead, Emily. No, go, Emily.
I was going to ask, what do you think that really says about the burgeoning crypto investor and what this actually means in terms of the future of the asset prices and its utility going forward?
I think, again, like I said earlier, we're not seeing a decrease of inflows of capital coming onto our platform, which just shows that if people are coming in, they're still optimistic and they're holding their dollars on the sideline waiting to come in. If we were seeing a decrease in the number of clients, I think that would speak, more largely to less interest in the cryptocurrency market, and that's just not what we see.
I just want to confirm that I heard the term correctly. Crypto dads, D-A-D-S?
Crypto dads. No, it's out there. You even have the younger guys calling themselves crypto dad. I'm a crypto dad, and it's the difference between the 2014 bleeding edge cryptocurrency investor and a more mature and larger audience of investors that have come in more recently.
Crypto dad sounds like a compliment, whereas dad bod, I wouldn't want anybody to say dad bod looking at me. But anyway, Todd Southwick, iTrust Capital CEO, all the best to you, and thank you for joining us. When we come back, we're going to revisit some of our discussion with Brian Deese, White House Director of the National Economic Council, about President Biden's first year in office and the economic performance that comes with it.
Welcome back. This week marked President Joe Biden's 1 year in office, and to commemorate that, Yahoo Finance spoke with economic and policy experts about progress out of the White House and the ground still left to cover as the U.S. heads into its third year of the pandemic. One of those individuals was Brian Deese, White House Director of the National Economic Council, who discussed the pandemic recovery with us. Let's hear what he had to say.
Well, this is a pandemic-driven crisis, and this recovery is marked by the intersection between the pandemic and the economy, no doubt about it. But you also heard the president loud and clear yesterday saying he does not accept the idea that the current normal is what we are going to live with. And in fact, we are making progress toward an outcome where COVID is not affecting everybody's daily lives and constraining our economy in fundamental ways. And we're making real progress toward that goal. We're not there yet, but we're making real progress. And as we progress on the virus, it helps progress on the economy as well. That's been true when we came into office. It was true last month. It'll be true next month as well. But that's why you see the president focusing on things like our supply chains, where working with business and labor to try to open up our ports, open up our railways and our trucking lines to move more goods through this economy. That's really important to do, and it's important to do in a way that helps minimize the impact of the virus and maximize the ability to move goods and services through this economy. I'll say today we're releasing a dashboard that shows that the number of containers that are sitting on docks for a long period of time is down 60% since November. Even during the high holiday shopping season, that was because of hard work by port operators and companies across the private sector supply chain and our administration working in partnership with them. And that's the kind of thing we're going to keep at going forward.
We hear the messaging about the accomplishments that are facts on the table. The president talked about the success in breaking the logjam at the ports. A lot of people get frustrated with the concept that perception becomes reality, and yet the perception among a great many Americans is overlooking the accomplishments and that things are perhaps not as good as the facts imply they are. How do you break that perception, especially with the midterms now less than 12 months away?
Well, I think what we see is historic progress and work yet to be done. And so as we focus on that progress, less for giving credit and more for recognizing what we need to keep going to make sure that we don't lose sight of or lose momentum behind what is a historic economic recovery. But at the same time, American people are frustrated. It's been a tough couple of years, and COVID and prices, they create uncertainty, and that's a reality for many families. And so what we can do is focus on concrete, tangible steps that we can take to help to address those issues in the short term, while continuing to grow an economic recovery that is showing disproportionate wage gains for lower income Americans who haven't seen a raise in way too long, that's showing disproportionate job opportunities so that people can move or start new businesses. That's the kind of economic opportunity we want to unlock over the course of the year, and I think the actions that we take will draw a line to outcomes that people can see in their lives.
Yeah, I mean, to Adam's point, there does appear to be a disconnect between the accomplishments the president's touting versus the perception of what they believe the president has done. When you look at his support, it's about at 40% right now. I mean, is this an issue of messaging? I mean, we heard the president yesterday say, I need to get out more. I need to get out into communities more. Is that where the White House thinks the divide exists?
Look, I think it has been a tough couple of years, and the American people are understandably frustrated and anxious across the board. And so what the president is making clear is that the way to best address that is, number one, act in their interest and try to deliver on those outstanding issues that have yet to be resolved. On COVID, on prices, you hear him with a clear plan on that. And get out of the Washington bubble and more clearly communicate where we are making progress, because as difficult and as challenging as these circumstances are, it's important, for example, that we note that this past year, we saw 30% more applications for new small businesses in America than we saw even before the pandemic. That's important to try to make sure that people understand there's real opportunity in this economy. There's new opportunity associated with changes that are happening that people are already taking advantage of, and others can too as well in a period where wages are increasing as well. So it's important that we make those arguments while also meeting people where they are and show people concrete actions on the ground. I would say the last thing, you saw a president with a clear plan, with action steps. People may like them or not, but he is acting every day in concrete ways. And he's going to make the case that he wants Democrats and Republicans to join him, but for those who are solely focused on trying to stall progress, he's going to also put to the question that he raised yesterday of what is their plan as well.
So, Adam, we certainly have been seeing this recovery progress in the economy, especially on the demand side, as we've been discussing for months now. I mean, the unemployment rate is back at a pandemic-era low of 3.9%. And that big concern right now for the White House and for the Fed really is on inflation, with consumer prices up by the most in 40 years at the end of last year. President Joe Biden, of course, saying earlier this week during his one-year press conference that this was in large part the responsibility of the Fed to address this as part of its dual mandate of price stability. But I'm curious on your thoughts on where we're headed now as we have this really all these factors coalescing in, again, an election year with the midterms coming up, and what this is going to mean for approval ratings and what it's going to mean for economic activity as we continue to move through 2022.
You know, the political analysts at the DNC and the president should probably be asking themselves a very simple question. What do, the majority of Americans, what do they care about? Rising prices, clearly one of them. What are the big issues for the people they need to turn out at the polls? This recent sell-off that we've witnessed in just the last 3 weeks since the beginning of the year, that's certainly not going to help a lot of Americans who have the good fortune of perhaps having a 401k, who might be a little bit nervous, not only with rising prices, but just lost a little bit of their future wealth. People get nervous. So how do does the administration, how do the Democrats address those issues to the point that the people who will vote in November say, I'm going to give you, it's not the president, but I'm going to give the Democrats, we're going to give you 2 more years in control of the House, and we're going to let you keep control of the Senate. You got to answer those questions for the people who are going to the polls. If you can't, get ready for the change, which Rick Newman has told us repeatedly is coming no matter what. Emily?
Well, and Adam, there certainly have been questions too. And I remember at the press conference earlier this week, again, with President Joe Biden, one of the reporters did ask, what do you think you're going to be able to accomplish before these midterm elections, since there could be a change in the tides in terms of what the Democrats can actually get done? And one of the topics that had been brought up was what's going to happen with Build Back Better. And President Joe Biden did concede that this may actually need to continue to move through Congress in parts, as opposed to in this large package as it has been moving in the past, when we saw back in 2021 the progress and the lack thereof that we had on that front. But certainly all really important things to watch as we have that 1-year anniversary of President Joe Biden in office, these concerns over inflation and concerns over, of course, how economic activity is trending heading into these elections, all going to be in focus. But coming up on Yahoo Finance, big data is hitting the big leagues. The sports intelligence firm Kitman Labs is out with a new platform to help university and professional sports teams use data to analyze athletic performance. We'll have the details on the other side of this break.
The sports world has come a long way since Moneyball and the Oakland Athletics. In fact, data today is big-time sports business, and there's a company that is doing this in ways that sports teams can't get enough of. Let's bring in Stephen Smith, Kitman Labs founder and CEO, along with Josh Schaefer, our sports reporter and producer. And congratulations, Stephen, on your successful Series C fundraise, $52 million. I brought up Moneyball, but what your platform allows teams to do, and we're talking university sports, all kinds of teams. Can you summarize it for us, for those of us who left the story back in the early 2000s?
Yeah, absolutely. We're a data and analytics company that help high-performance organizations to transform the fragmented data landscapes that have been cultivated over the last 10 to 15 years through the explosion of data in this industry, and to transform that into shared understanding, and then to take that shared understanding, leverage analytics, and turn that into shared intelligence that drives the decision-making that creates competitive advantage.
And Stephen, one of the things that I think your company thinks you guys can really benefit from is the growth of data points in sports that are being collected. We have a graph that you guys sent along where you predict that it's going to go from 2.4 million data points collected in 2021 to something like 230 million data points come 2025. Why are you predicting so much data growth? Where do you think teams are going to be looking to pick up more data points?
Yeah, well, we've already seen it. It's come over the last number of years, as you can see, from 95,000 data points in 2014 through the north of 2.5 million data points per athlete per year right now. So most teams are collecting more than 500 million data points. What the growth is coming from, there's a huge drive and sophistication for some of the wearable sensors, optical trackers, different types of systems that are being used to cultivate data that traditionally were less sophisticated, less granular, and they're becoming, they're appearing in every area of high performance sport, from scouting and recruiting through to coaching, sports medicine, nutrition, psychology, general management, operations. It's starting to appear in every facet. And that's what's really driving the change that we're seeing today.
This is Emily here. Your data have been used by sports teams, general managers, coaches, et cetera for now. I'm wondering, given all this data that you have available on your platform, do you see potentially a future use case for making some of this available commercially for sports betting or any other types of functions?
Yeah, I think data can be used for a multitude of purposes, and we're already seeing it being used in all areas of sports. I think it depends on the use case and the type of information. Obviously, some of the information that we're collecting and collating is related to sports medicine and player welfare and athlete welfare. Obviously, information like that will not be used for gambling, but there's a multitude of use cases, from performance data and practice data, that I think can be used for all sorts of fan engagement, marketing, media purposes that, again, will drive the financial side of the business that we're seeing today. And we're incredibly excited about being at the center of that.
When we talk to people who have expertise in data like you and your firm, one of the things they've shared with us is, look, data on its own doesn't really help you unless you ask the right question. Do you help your teams? Do you help the managers form the question based on the outcomes they're looking for? How does that process work?
Yeah, we actually take a very tailored approach to that exact, I suppose, problem that you're discussing. I think every team is trying to do something different, regardless of whether they play the same sport or in the same league. The personnel they have is different. The game strategy they have is different. Their philosophy is different. And that means that how they leverage technology to solve, their particular problems needs to be different. And we take a very unique approach to helping organizations to understand how to ask the right questions of that data, how to cultivate the right data, and then even how to actually turn that into actions and decisions that are tailored for them specifically. And, we've developed our operating system, which, almost like the Salesforce of sport, that can be configured in unique and tailored ways for each different organization to help them to achieve their tailored strategic goals.
Stephen, what sports are you seeing that are most interested in this as far as clients go? I know you guys are pretty heavy in Premier League and different soccer clubs, and I don't know if baseball's been a big thing. We already referenced Moneyball and their interest in data analytics. Has there been a sport that's maybe kind of up and coming that's a lot more interested in data now than they used to be maybe 5 years ago?
I think we're probably seeing it across every sport. Global soccer is obviously a huge market, but even if you look over here to North America, the stakes are higher than ever before. You only have to look to the NFL's recent $110 billion media deal to understand how much performance really matters. And I think that's why we're seeing teams and leagues across football, whether it's at NFL or even in the collegiate level, turn to data and analytics to drive that performance, because the prize is enormous.
All right,
Stephen. Sorry. Go ahead, Adam.
No, Josh, you get the last question.
Stephen, I guess I was just curious what you think is next for you guys as a business. Are you interested in getting into tracking the data yourself with some of the wearable technologies at all? Are you guys in that space, or are you just helping with the interconnection between the teams?
Yeah, for us, it's all about that platform play, right? It's all about, I think, moving the high performance organizations from being data rich and insights poor to, driving this age of performance intelligence. We've just raised a $52 million Series C. We're in the process of adding over 100 new employees over the next 12 months. And we're just really excited about investing in, innovation that's going to help people to take that data, consolidate that together, turn it into intelligence, and drive that competitive advantage.
We appreciate your sharing this with us, Stephen Smith, Kitman Labs founder and CEO, Josh Schafer. See you at the post meeting in a few minutes. When we come back, we've got an update on the Yahoo Finance in partnership with Emory Business School and the John Lewis Racial Justice Award. We have the announcement about the winners.
Welcome back. Emory University's Goizueta Business School held its second annual John R. Lewis Racial Justice Competition this year, honoring the late Congressman and civil rights activist John Lewis. Students in universities across the country took part and were matched with companies looking to address issues of racial justice. This year, teams of students from more than 40 schools applied, and the Yale team was just announced the winner. Vivian Chong, Yale School of Management first-year MBA student and John R. Lewis Case Competition 2022 winner, joins us now. Vivian, congratulations, and tell us about your proposal and your experience in this competition.
Yeah, absolutely. So the problem statement that we were given was essentially to build a racial justice tech hub in a US city of our choice. So we decided that we wanted to build the tech hub in Atlanta based on our research, and build it based on the data that we collected and all of the racial tech gaps that we had identified based on our research. So our 3 pillars include training and upskilling, potential learners, collaborating for innovation to actually build solutions, and then which then upskills them to then enter into jobs in the tech industry so that they can then mentor people back into our tech hub.
So the award that you'll receive, I imagine that will help attract other funds to get the tech hub up and running. Are there timelines by which people can start, the women and different people who would be eligible to take advantage of this will be coming to you?
Yeah, so we had initially proposed to have a pilot phase of 12 months to really experiment the hub with the hub sponsor company, which is IBM. So within those first 12 months, we have allocated a smaller level of funds that we needed to get the hub up and running. But then for years 2 and 3, we would definitely be more equipped to receive more funding from different grants and sponsors once we have a better idea of what we need.
How did your specific idea and proposal come about, and what personal or professional experiences from you or your team members contributed to this?
Yeah, absolutely. So the idea kind of came about because we kind of composed a team based on our interests in the intersection of technology and racial justice. And we wanted to propose a solution that would sustainably target gaps in the tech industry. And so we identified different particular racial tech gaps and also identified the US city that would most benefit for this racial tech hub, which was Atlanta. And actually the connection to Atlanta is a bit personal to me as well. I had lived in Atlanta for the past 4 years, and just being able to witness the collective action within the city. And of course, it's the host city of Emory's Business School as well, who hosted the case competition. It really inspired me to actually want to go to business school to make change that would be sustainable and business-minded as well.
My brother and his wife are Emory grads. They live in Dunwoody, so familiar with the part of the country that I think you have an affectionate bond to. Obviously, you're going to be a part of the tech hub. Do you have a sense of the people who are going to be coming to you? Are we talking about perhaps college students? Are we talking about post-college students? Or is this going to be wide open to get all kinds of people involved?
Yeah, so actually, the learners that we had identified that there aren't being served as much are actually people who may or may not have 4-year degrees, maybe in low-income communities or lower paying work, who are looking to transition into a tech career that might or might not need a 4-year degree. So we had proposed to partner with employment assistant agencies that might not even specialize in placing people into tech jobs. We really wanted to expand the breadth of opportunity to give to people who might be interested in the tech career, but might not have the access and resources to do so.
Vivian Chong is Yale School of Management first-year MBA student and winner of the John R. Lewis Case Competition 2022. Congratulations again, and thank you again so much for your time. Coming up, Adam and I will break down what to watch in markets next week. Stick with us.
All right, as we get ready to wrap up this trading week, let's take a look at what we're watching. And I'm going to lead this off, Emily, simply because we talked about it during the show today. Can't ignore that we have a Federal Reserve meeting. The FOMC is going to have its first meeting next week. We're going to get that statement. A lot of people, we heard Christina Hooper talking to us about, look, if we continue to see this sell-off in the markets, the Fed certainly can't ignore that, and the statement that they put out next week is going to probably have language designed to calm people. But as far as the interest rates going up, the expectation is we'll be set up for the first increase, 25 basis points, come March. So on my radar screen, and it's not just my radar screen, it's lots of people trying to find out what the Fed is going to share with us about future direction. The other thing, though, that Christina pointed out was they have three tools here. They're going to stop the purchase of, we know that, the QE. They're going to be rolling off. That's a big one. So there may not be as much pressure to go. Goldman Sachs has 4 interest rate increases. It may just be the 3. Emily?
Well, Adam, I'll certainly also be watching that Federal Reserve decision, but I'm also going to be watching some key earnings results out from some very major technology companies. Of course, Microsoft being one of them, reporting after the bell on Tuesday. Apple, another one, reporting after the bell on Thursday. And as we can see, there's certainly no shortage of other earnings results from companies in other industries reporting during next week's trading as well. But just keying in a little bit and doing a deeper dive on what to expect out of Microsoft and Apple. Of course, we had an inauspicious start to big tech earnings season, with Netflix reporting subscriber growth slowdown in results delivered after the bell yesterday. But of course, for Microsoft, this report is coming after news of the company's biggest ever acquisition that we just got reported earlier this week, buying the video game maker Activision Blizzard for about $69 billion in cash. Of course, that is going to be something to watch in terms of where the company is going to be heading on the video game side, and more importantly on Microsoft Azure, because we saw that cloud computing part of the company did grow by another impressive 50% on a year-over-year basis in its last quarter. Wall Street does expect this to slow to an about 46% growth rate for this fiscal second quarter we'll be hearing about on Tuesday. And that estimate is coming from Jefferies analyst Brent Thill. But then taking a look as well at Apple, of course, really going to be focusing in on any commentary about supply chain. Chief Financial Officer of Apple, Luca Maestri, had said in late October that the company would likely see a more than $6 billion revenue hit due to supply chain constraints for this December quarter. But nevertheless, Wall Street is still expecting Apple to post its biggest ever quarter for revenue at more than $119 billion based on Bloomberg consensus data. And iPhone 13 demand is likely going to be a big driver of that. So a lot to keep an eye on next week, Adam, when it comes to big tech earnings as well.
Yeah, and let me just throw one more out at everybody. We get on the 27th, Southwest Airlines. It's going to be slightly different than what we've seen from Delta, United, and American, because Southwest, big, I mean, they have the business travel, but they also have domestic, and that's one thing. They're not going to be impacted perhaps quite as big as those who rely on international travel. So we're going to be getting Southwest. Hope to be talking to Gary Kelly next week. Let's see where we settled today after what has been a rough week for a lot of people who get nervous when we are in the red. The Dow settled down 1.3% today, 450 points. It is off about 6% year to date. The S&P 500 off almost 2% today, down 84 points. Year to date, the S&P 500 is off almost 8%, and it's the Nasdaq that is in correction territory, off year to date almost 12%, lost another 385 points today. We get started bright and early Monday, 9 a.m. here at Yahoo Finance Live. Have a great weekend.